Before we start this video, do like and subscribe to our channel and not miss on any updates.
Good evening, Prahlad, Ronak, and Balaji. I hope I'm audible.
Yes, sir, you're audible.
Yeah. So
Great, sir.
yesterday we didn't conduct the class because students were, busy or occupied somewhere. Even today, like out of 30 students we have, only 7 or 8 students said they'll confirm. But whoever joins, we will conduct the classes. And if you want subsequently later on, you can watch the backup also. But I would suggest to join the classes because at least this 1 hour of dedicated time you will spend for the classes and you'll be prepared for the examination. Okay, so that is the idea to conduct, especially IBS on a live basis where we can have interaction. And if you have any doubts on how to approach and all of that, we will be able to guide you. That is one. So today is for the normal 24 attempt, we'll take up selected case studies. Where we'll be solving the case studies covering different subjects. Each faculty will take a case study and his portion he'll cover. For example, I'll cover financial reporting, strategic management, strategic cost management. Similarly, we have Yogita ma'am to cover corporate law. Then we have Aslesha ma'am to cover other laws. Then we have Sriram sir to cover AFM. We have Shivteja sir for direct taxes and indirect taxation. And we have Pranya ma'am for audit. So respective faculties will take up the case study, cover the concept behind the case study, and we will take it forward. This has worked really well in the May 24 attempt, and we expect the process to work for November 24 attempt as well. One specific thing what I would like to highlight before we begin the session is in this specific case study digest, there is a lot of emphasis on strategic cost management related concepts. Okay. So more than 50-60% of the case studies have that. Of course, on an overall basis, the weightage in the examination will be 10 to 15%, but Institute has focused a lot, especially in this new case study digest, a lot more on strategic cost management. That is from my side. Before I start, I would like to know what is your status of preparation across different subjects. And if you're writing in November 24, what is the plan? How is it going? So starting with Prahlad, if you can just share quickly, what is your status and what are you writing in this attempt? Or anybody else who wants to share. We will not put it as a part of the course content. We'll cut it off and only the class will be uploaded. So don't worry about that. It is just to understand where you stand currently so that I can, if at all you need some more guidance, I can add on top of that.
Yeah, yes, sir. I'm Balaji here.
Yeah, hi Balaji.
Yeah, I'm prepared for group 2. As far as the first group is concerned, I'm not yet started, not even touched it.
But when are you writing your exams?
November, group 2.
You are writing only group 2?
Yes, sir.
Okay, then SPOM you have completed?
Yeah, that one completed. SPOM, both law as well as SCPM I completed, sir.
So one suggestion is from my side, because there is a good portion that is tested from FR, AFM, and also audit. You need to plan and prepare. So what is your plan for that? Because for IBS also those become very important.
Okay.
So do you have a specific plan to cover something on that?
No, sir. I don't have any plan.
Okay, so my suggestion, if others are also in the same bucket or in the same boat, my suggestion is whatever theories we discuss in the class, we go and revise. Then for FR, I have given some short notes. Okay, so please go through those short notes which are relevant for IBS, and then I'm uploading revisions for important chapters for main FR paper. That also you can go through. And there are some standards which are repeatedly tested. You will figure out as you see the classes, like on government grants. Then they ask on borrowing costs, they have asked, then financial instrument, consolidation. These are the questions which they have tested enough number of times. So at least be comfortable with those concepts. Okay.
Okay.
So that is my suggestion, because even if your DTIDD is good and audit would be there, audit still you can manage. FR and AFM needs some amount of practice.
Sure, sir.
Right? Okay, sure. Prahlad says he has issue with audio. No problem, Prahlad. That's perfectly fine. So if you can just share what are you writing in the November attempt, and then if you need some inputs, I can guide you. Others, if you want, Ronak and Harshida.
Yes, sir. Okay. No,
Yeah.
you go ahead.
Go.
Any one of you? Okay, Harshida, go ahead.
Yeah, sir, I'm preparing for group 2 and both sets of SQM completed.
But why are you not? So just a question. Why are you not preparing for group 1? This is the question to Balaji also and also to Harshida.
Sir, I'm working
Sir,
full time.
Are you working
yeah,
full
same
time?
conditions.
No. Is it articleship or
No,
is it?
sir. No, sir. No, sir. No, sir.
You are
Not
working full
article.
time.
Job.
Yes, sir.
Job.
So you, Harshida, you're also doing job.
Yeah, sir. Actually, I gave in May 24, but due to audit, it was not successful.
So at least you have some idea of FR, AFM and audit.
Yes, sir.
When did you give? You said.
May 24.
Acha, okay. Then it's still you are at least somewhat you will be able to understand those concepts and prepare.
Yes.
Okay. I think Prahlad also has his audio back. Admit him. Okay, Ronak, if you want to share.
Yes, I am preparing for group 2. I have cleared my group 1.
Oh, nice. Good. When did you
Yeah.
clear group 1?
I cleared it a few years back. Actually, I took a gap after of 2 years, and again
Okay.
now I'm appearing for group 2.
So then for you also refreshing the content is very important. See, in IBS classes, we will not be able to cover all the concepts of all the subjects. Otherwise, it will be a 200, 300 hours classes, right? So
Yes.
what you have to do is, we have given notes for the respective subjects. Please go through those notes and listen to some revision lectures as much as possible. That will help you, get clarity on the concepts. And if once you complete the case study digest, we'll tell you the approach also how to proceed with the case study, and that will take care of your preparation. Okay. Yes.
Yes. Okay, sir.
If your audio is back, you can share, and then we'll start without taking much more time from all of each one of you.
Yeah, I'm also writing only second group. First
So
group,
all the students are only second group. Okay. Okay.
first group I had written long back, like 5 years back.
So that was in the previous syllabus.
Yes, previous syllabus, and now I have come back to CA after a long time because of my boss. I'm working as a finance manager in a listed company.
Sorry.
I'm working as a finance manager in a listed company.
Okay. Good. Nice.
So because
Which company? You can share it with us, no?
this is West Coast.
West Coast Paper Mills.
Yes.
So do you know there is a small fact about West Coast Paper Mills?
About?
I was born in West Coast Paper Mills Hospital, Dandeli.
Okay. Under Maheshwari, madam.
Sorry?
Under Maheshwari, doctor.
No, I don't know, sir. I was born in 1987. I don't know the doctor, of course. Okay, but my uncle used to work in West Coast Paper Mills, so I was born in Dandeli.
Your name?
Suraj Lakhotia.
Okay. I'm working.
You're working in Dandeli or some other
Yes,
corporate office?
I'm based in Dandeli.
Okay. I wanted to visit that place, but I've not been able to visit. Anyways, a good coincidence.
You can inform me anytime. I'll arrange all the things.
Sure. It has been it's a very good coincidence that someone from Dandelion is a part of the class. So nice. Chalo. So we'll discuss this question.
About the notes, where is your notes available in Indigo? This one itself.
Under resources, we have given short notes and summary notes. You should also consider the institutes what they provide, right? Summary notes for respective subjects. Those plus our notes plus the other notes that you're preparing for the class. So generally our students, even other students also, they have taken at least 2 bags full of notes for the exams.
Not bag. They're bringing in suitcase.
Sorry?
They are bringing in suitcase.
Yeah, actually. So because you don't know where the question will come from, what area where you have to pick from. So be prepared that you may have to carry in some cases study material, or in some cases the notes of the subjects that you're referring to. For example, you're taking BT classes somewhere. Carry those notes as it is. No need to worry about summary notes and all of that. Okay. So same way if you're doing.
I wanted a small doubt. I need not clear that costing or this one because of old syllabus students, right?
No, so you are writing group 2, so you have to clear costing, no? Group 1 is only clear. So SCMP you have to write.
No, this time they have given exemption.
No, that is, you have to write after the exams. It's
Yes,
not
after the
exemption.
exam. Yes, yes.
It is relaxed. But the thing is, we have a lot of concepts of SCMP that you have to prepare for IBS. So better spend some time to get clarity of concepts of SCMP also.
Okay, that I'll do.
Okay. So this was a closed group discussion. This will not be uploaded. Okay, so now when
Sir,
you start.
where can we find your revision videos of FR?
Sorry.
Your revision videos on FR. Where can we find?
There is a IndigoLearn CA final channel where you can find the revision videos. I am also doing one more round of short revision videos for 3-4 important chapters that will be available. As and when they are uploaded, we will be posting in the group.
Okay, thank you, sir.
Yeah. Okay, chalo. Thanks. So now let's start the classes. Now, because you're attending for the class for the first time, 2-3 things that you have to keep in mind when you are solving questions based on case study, especially IBS when it comes to. So I'll just we'll start with the case study itself so that you have clarity on what I'm talking about. Okay. So this is the case study digest. They have added new cases to the previous digest, and we'll be covering good number of case studies out of this. Right. So if you look at any case study in the examination also, this approach has really worked. What happens is they'll give you a lot of background text in any case study. What is the company? What does the company do? What are they into? What kind of business? What is the problem? And all of those things. So you'll have a lot of background information followed by 4 to 5 MCQs, generally 5 MCQs, followed by 2 to 3 descriptive questions. Okay. Now, the thing is, and for 5 MCQs to go through the entire case study and then understand and come back to the main question or to answer the question takes a lot of time. So as a matter of practice, what I suggest and what we have been suggesting to the students, and this has worked well as I told you in the previous attempt as well. First, quickly look at the question. So see this case study, if you see, the case itself is some 4 pages, 5 pages. You have a 5-page material to be read. You have to assimilate all the information, and then you have to go to the question. So this may take a lot of time, and sometimes you may tend to miss out. So what we suggest is first quickly have a look at the question. No need to even look at the options. Just have a look at the question and then go back and read the case study. So when you look at the question and then go back to read the case study, you will be able to figure out, okay, this information I can get from this particular paragraph, or this particular aspect is covered in this particular paragraph. That is very important. So first what we will do is, so for this first case study, the case study, we'll quickly have a look at the question, right? Which of the following statements accurately describe characteristic of disruptive innovation of the company? So there are some disruptive innovations. We have to talk about what is or which category does it perfectly fit into. Then, with reference to fare breakup, what should be the total amount of fare and GST, assuming the GST as 5%? So second question is about GST. So when you read the case study, you have to target that paragraph where they have given fare breakup. This will be covered in the taxation discussion. We have expert faculty for taxation. He will be dealing with this. Then, Caber charging a premium for instant booking of prime cars had provided a new value to the customers by making service access easier and more convenient than its basic version. Adaptability to which model created a significant advantage for the organization. So here we are talking about some business model. Right? So we'll look at the various models in which a business works, and we have to select one of those. So we need to know theory or concept of this model. We need to know which subject, which chapter does this model come from. So it is good if you have an index of the notes that you are carrying. So you know, okay, this model comes from this particular chapter, and you can go there. Then determine which classification best describes current growth stage. So here also, what is the growth stage of the business? That is what is the question. So here, if you see, Here we have a model being tested. Here we have a growth stage being tested. Here we have a innovation being tested. So like this, we need to identify the gist of the question and then go to the case study for assimilating the information. Then, which statement is correct regarding the increasing number of directors in accordance with the provisions of Companies Act? So the moment you see number of directors, when you read the case study, there you figure out, okay, this paragraph talks about the directors. So this will be covered by the law faculty. Then, in the descriptive question, this is where you need to put a lot of effort, and also you can take a printout of this case study digest itself, so that in the examination, if a repeated or a similar question comes, you can use this case study digest as a base to write your answers. Okay. Based on the scenario, how did Cabler address customer pains and generate gains? And what specific strategies and features did it implement to enhance the overall customer experience and contribute to social and environment benefit discussed? So here we are talking about customer pains and customer gains. And the next question talks about business model canvas. So we need to spend some time in understanding what is the business model canvas, how is it created, what are the various elements in that, and then you can answer this question, right? Then the last one is based on depreciation claim rejected by assessing officer. So this is more from income tax perspective, right? Now, after having gone through this, let us look at the case study. And after looking at the case study, we will look at some relevant theories and we will solve the question. Cabler Cabs, which is better known by the name Cabler, so this is something sounding similar to Uber, okay, is an Indian startup company, privately held. So this is one thing, which provides online cab services to the greater population of the country. It was founded in the year 2008 by Ikshit Bothra and Saurabh Jain. Cabler initiated its operations and services from Chennai, and now headquarters of this startup company is based in Pune. So this is a startup company. Within a span of few years, the cabs have expanded its base to as many as 85 cities, with around 2 lakh cars operational in its online cab services. In 2012, the company also went forward to provide auto rickshaw services to the middle class clan of the Indian families through its mobile app in cities like Mumbai, Hyderabad, Jaipur, and so on. Okay, so this is the introduction. You definitely have to read this. Now you know it is into the cab business. Then, when you look at the paragraphs, please see each paragraph will talk about some specific aspect. Okay, so here in FY 2022, the market share accounted for 55% and valuation of 6.5 billion. Okay, then they talk about, if you look at the last line, it faced regulatory challenges and opposition from taxi unions in many cities. Okay, so first and last line of the paragraph will give you an indication of what is being discussed in the paragraph broadly, if they have drafted it properly. Cabler business model disrupted the traditional taxi industry by offering a more convenient and efficient way. So now see, they disrupted the traditional taxi industry, so they have a opposition from unions. Now here in the MCQs, there is nothing specific to this problem, and in the descriptive also, I don't see for now anything specific to this problem. Okay, then major customer segments of Cabler are individuals who do not own a car or can't drive on their own. A segment of people who need an affordable ride, they share cab services by pooling a group of people from the common area. Various customers who need a premium ride or a quick ride also book rides with Cabler. It serves the people who are looking for convenient cab bookings, and it is amongst the fastest growing online cab service providers in India and aims to dominate the Indian market. Now see, all of this is more like how they do the business. Now their aim is to become the fastest growing online cab services. Again, if you go back, this has nothing to do directly with the questions asked in the MCQs or in the descriptive. So till here, then it aims to dominate Indian market with innovative, something was asked on innovation, and customer-oriented business strategy, which includes mobile app awareness to the common people through the launch of a customized mobile-specific technique named as app analytics, with the help of which the app can track and measure overall performance of services in particular city or through the driver. So basically what they have done, they have added a feature in the app, and based on the app, they can figure out or they can check what is the performance of the services in the business or in the particular city. Providing ad campaigns on various social media platforms, targeting the right audience, which as per recent study has confirmed that the average customers were of 20 to 25 years of age who are working in corporate companies and need cab service to pick them up and drop to the office premises. So this we can, if you know about Ola, Uber, if you have read about them, you can correlate them. Otherwise also, this is pretty understandable. Then, Caber works as a digital aggregator app platform, connecting passengers who need a ride from point A to point B with drivers that are willing to serve them. Passengers generate the demand, drivers supply the demand, and Caber acts as the marketplace facilitator. Caber has been able to generate strong value proposition for both passengers, drivers to get on board its platform and create disruption. So even here, there is nothing directly which has to do with the case in the question in the case. Certain facilities provided by Caber to its passenger customers are convenient cab booking. So here they're talking about the features. So when you are reading the case, you should know here they are providing some features or they are providing some facilities to the customer. Okay, so this may help us to answer when they have asked us specifically what is the company doing to create, reduce the pain for the customer and improve the game. Okay. Real-time tracking. The ride-hailing service refers to the ability of passengers to track the location of their assigned vehicle in real time using the mobile app. So there is something called as which they can give real-time tracking. They provide passengers with an estimated time of arrival and allows them to see the route the driver is taking to reach the location. So by the time you read this real-time tracking, this part is understood. It promotes cashless rides by giving the option for passengers to pay for their rides, not rides, this is the rides, using digital payment methods such as debit cards, mobile wallets, or Caber money. This eliminates the need for passengers to pay in cash at the end of the ride, offering a convenient payment experience. So here we are talking about real-time tracking. Here we are talking about digital payment. So this is digital payment. So the idea or the thing that I'm trying to tell you here is, as you read the case, you have to bucket them in specific information. And in some cases, the paragraphs will be so straightforward. By reading the first line, you will realize that this information is not required for the case, or this information is required for the case. So you have to do smart reading. Only then you'll be able to complete the cases in the allotted time. Otherwise, to remember the 4-page information itself will become a challenge. Okay. Then the passengers using the app experience shorter waiting time. So this is one more feature. This could be due to factors such as the availability of nearby drivers, efficient routing, effective matching, not logarithms, this is algorithms, that quickly connect passengers with available drivers. Lower wait times contribute to a better overall experience for the passengers. So we talked about first, they have real-time tracking. Second, online payment. Third, shorter waiting time. Shorter waiting time improves the experience for the passengers. So that is a customer gain, not a pain. Okay, they are reducing that pain. Reducing the time spent waiting for the ride to arrive. Its app provides an upfront pricing feature. It shows the estimated fare for the trip before confirming the booking. This estimated fare is calculated based on the factors such as distance, time, and any surge pricing that may be applicable. By providing upfront pricing, they offer transparency. So we are transparent in our pricing. We give pricing that is transparent and upfront. In the Caber app, multiple ride options typically refer to various categories or various types of rides available for users to choose from when booking a ride. These options may include micro, Caber micro. So you have in Ola, you have micro and prime and all of that. Small and affordable car for short trips or solo travelers. These multiple ride options cater to the diverse need and preferences of the users, providing flexibility in terms of vehicle type, comfort level, and pricing. User can select the option that best suits their requirement for each specific journey. So you have some choice that is given. So that is the one more feature that is done. The hiring department at KBR undertakes an extensive search to hire experienced drivers who can be further trained to professionally handle high-end luxury segment customer. So for high-end luxury segment customer, you have a focused hiring. Okay. Now this, if you see, directly is not being asked. Only indirectly we can refer to in terms of what the customer is, what the company is doing to improve the customer experience. Okay. So this part you can come back to it subsequently, because here it is only talking about high-end luxury segment customers and experienced drivers. After hiring its driver, they provide flexibility to drive on their own terms, like setting their own schedule based on their preferences. So whenever the driver wants to drive, they will, they can drive like in the morning, in the afternoons, at whatever time. And also drivers can decide where they want to operate within the service area. So this is about driver preferences. Okay, so here we are talking about driver. Now the reason why I am not immediately reading all of this text is, if at all I have to write about drivers, only then I will come back here. If I don't have to write about drivers, I will not come back here. But is driver important? Do you think driver is important in the overall customer experience? Do you think driver is important in the overall customer experience?
Yes.
It is important, because if you don't get a good driver, what will happen? You will start complaining about poor drive qualities or poor ride qualities. The driver is not good. He's taking a longer route, shorter route. He didn't come on time. So those problems are there. So that can be a customer pain point that they are trying to solve. Okay. So here in conclusion, if you see, they ensure that its driver can deliver a reliable, safe, enjoyable experience for passengers, while also empowering them to manage their work effectively as independent contractor. So there is the focus about drivers, right? Then KBR supports its drivers by facilitating access to vehicle loans, enabling them to become vehicle owners. Now, in the entire question, directly, there is nothing about what they are doing for the drivers. Okay, so that you can, skip and come back subsequently if needed. But before doing that, always I recommend, look at the first and the last sentence. That is mandatory. In the last word they have written, the registration of vehicles is in the name of lessee as per the provision of Motor Vehicles Act. KBR has claimed a depreciation of 5 crores during the previous year 23-24 on the motor cars leased out. So here they have leased the vehicles and they have claimed the depreciation. But the registration of the vehicles is in the name of lessee. Now, who would be the lessee? The one who has taken the vehicle on rent. So basically here we can see there is a lease arrangement. Now, on this specific point, there is a question in the MCQ for income tax. So for that, you'll have to come back to this paragraph, right? Then KBR makes money by taking a cut on each side from the drivers. KBR provides the driver on its platform with a robust supply of right requests to accept. So this is about how KBR makes money. And last, you can see commission rates vary from 15 to 30%. Again, nothing directly related to the questions we have seen. Then dynamic pricing, surge pricing is charged whenever there is a higher demand for cabs than what can be served at the moment. So if there is a lot of demand, they actually charge higher. Okay, so that is what is called as surge pricing, as they have mentioned. The fare goes up based on surge pricing calculation algorithm. If a passenger cancels a ride, after a certain time frame, he is charged a cancellation fee. Okay. KBR app is a very popular app. So this is about popularity. The company offers discount and promotions to the end users that are not our customers to encourage the use of the platform. So if customers are not using, okay, so if the customers are not using, they provide discounts and offers and all of those things, which will help them to get new customers. Like we also provide discounts for people who are trying to enroll with us. They are offered in various forms of discounts. targeted end user discount, end user referrals. So referrals are basically if one party refers to the other party, that becomes a referral. Now, why am I not reading in depth of this is more to do with marketing, offering discounts and all of those things. We have not seen the direct questions related to these aspects in the question. So I would for now not read this. Come back to this if at all I need to include this in my answer. So you have end user referrals, you have market-wide promotion. Market-wide promotion means what? You are doing a lot of promotional campaign, or you are doing some advertisement. You are giving some discounts in the entire market or to all the customers. Referral is to a specific person, like you get cash back when you refer your friend. Targeted end user discount and promotions are basically to target it to specific individuals. Refunds and credits to end users due to end user dissatisfaction with the platform are recorded as marketing expense. So here, if you refund something, then it is treated as a marketing expense. In some cases, reduction of revenue. For example, if the ride has been completed and if the customer raises a complaint, they are saying they'll reduce it from the revenue. Now, technically, if the performance obligation has been completed, the revenue has to be recognized. You cannot reduce the revenue. So that can be one MCQ. Though it is not there, it can be one MCQ. Can they reduce the revenue? Caber offers 24/7 customer support to ensure that the passengers and driver receive assistance at any time. So this is support. Recently, Caber is planning to introduce customized luxury rides to attract high-end customers in all metropolitan cities in India, best known for their fast-paced lifestyle. Due to expansion of business in various segments requiring restructuring in leadership team, for effective management, the board has decided to increase the number of directors. So now here you see they have decided to increase the number of directors. And there is a question related to law on number of directors. So when you're doing that, you can directly come back to this paragraph. The company has 7 directors. With the revised strategy, they want to increase the directors from 7 to 16. So now you have to see whether this is allowed as per the Companies Act, whether they can, they cannot, according to the question. In FY22, Caber market share accounted for approximately 55% and the valuation of $6.5 billion in 23. Sample fare breakup. X books an auto for traveling from Jotwara in Jaipur to Sanganer in Jaipur. Auto driver, a resident of Rajasthan, accepted the ride. Completion of the trip, operator received fare from X. Royal breakup is private fees 800, booking and convenience charges 200. This is from GST applicability. So there is a question on GST applicability. For that, you have to read this, refer to the GST provision, and answer the question. Okay. Now, did you get an overview of the business after reading this case? You have to respond. If you don't want to unmute, you can just type it in the chat box also. That is perfectly fine. Did you understand the business of this particular cab company? So this is similar to something you see in case of Ola, Uber, right? They take cab bookings, customer, there is a surge pricing there based on the elasticity of demand, right? Then they take their commission share. They run a lot of promotional campaigns. Initially, they used to do a lot of referrals and all of that. So it is based on that. Now, the entire case, if you see, and the question. Now you have to relate the question, the options, and then go back to the case or theory to answer the question. Okay. So what we'll do is we'll take each MCQ. If at all it needs explanation of theory, we'll go back to the theory and we'll have a look at the theory as well. And then we will see how to address the given question. Which of the following statement accurately describe characteristic of disruptive innovations of Caber? Now, what is a disruptive innovation? Innovation which disrupts the market. Innovation which is not seen in the market earlier, and now after this company has done, it becomes the a use case scenario in the market. Everybody tries to follow that. A lot of customers gain because of that. That is what is called disruptive. Okay, it actually, so disruptive, when we see, We have not seen something like that before. For example, there is something called 8 minutes delivery, 10 minutes delivery, Zepto. Okay. Now, when we talk about Zepto, we have not seen something like a 10-minute delivery before they came into picture or before they came into existence. Likewise, online delivery and all, before Amazon, Flipkart came into picture, we have not seen a lot of online deliveries, right? So when we say disruptive, we have to see which innovations that the company has done is disruptive. Okay, that is the first thing. Now this, by a general understanding also, you will be able to answer as to whether it is disruptive or not. First, Keber initially targeted niche market to establish its presence. Okay, so first, then Keber offered competitive performance and quality compared to existing products or services. So products or services. So here we have A, B, C, A, B, D that way. So this is actually A, B, C, D, E. Don't go in the exam and say, sir, there is option is not given in the answer. Okay, so you have to, if at all there is a mistake in the question, you have to rectify that, right? So Keber initially targeted niche market, then Keber offered competitive performance and quality compared to existing product or services. Then Keber immediately dominated the market upon introduction. Now we have to see whether each statement validates the way Keber has come into the market or the way Keber has, caused the innovation in the market. Then established companies did not align with the preferences of their current customers and overlooked Keber's disruptive innovations. Lastly, Keber innovations tend to evolve and improve over time, eventually surpassing existing products or services. So now, here if you see, first is they initially targeted niche market. Did they target niche market? So initially, when we say niche market, if you learn in strategic management or strategic cost management, niche market means a small segment of the market. Okay. So first what they did, if you come back to the case, to see the introduction part. They started operations from Chennai and then they expanded its base to as many as 85 cities. So they started from a small market. So when they started from a small market, definitely we can say they started from a niche market, their innovations. So first option fits the criteria. Then, so if first options fit, this option C is out of the question. Okay. Second, Keber offered competitive performance and quality compared to existing product or services. Now, do you think they offered, competitive performance and better quality as compared to existing services? By looking at the case study, can we come to a conclusion that they have given a better performance or they are giving a better quality as compared to existing products and services? Yes or no? What do you think? Did the company provide better performance and quality? See, we have to do some kind of discussion. Otherwise, I'll just explain, do the answer, that will not help. We have to crack these type of questions when it comes to examination. And this is nothing to do with theory. It is a general question. So now, if you come back, so here we listed down a lot of features that they're providing. We also listed down how they are reducing the, let us say, wait times. How you can book cab conveniently. So by providing all of these features, they are actually providing better performance. See, if you have to, let us say you have to book an auto and you have to go and negotiate with the auto driver or the taxi driver, that becomes difficult. So they are giving some, better performance and quality as compared to existing product. This is your traditional setup. The traditional business of auto drivers, the taxi cabs and all of that. So this also they have done. This is the core disruptive area. So option B also is the correct answer. So option B is not there here. It is not there here. So we are left with first one, which is A, B, and D. So you don't need to even go back and relook at the case after you have discussed about or understood about these two options. So this is one technique called elimination. Okay. So when you have four options, if you have eliminated these three, the first option by default becomes the correct answer. Then Keber immediately dominated the market. This is not right. because they didn't immediately dominate it. Now they have dominated 55%. Established company did not align with the preferences of their current customers and overlooked clever disruptive innovations. Right now, here, when we say established companies, it is more about the traditional drivers or the traditional, business providers, traditional taxi drivers, traditional cab service provider company. They did not align with the preferences of their current customer. That is where the new company could come up and they could capture. The new company could come up and they could capture. This is slightly generic. This is nothing to do specifically in the case study. In fact, I have not mentioned that in the case study also. So you have to derive the conclusion in such cases. Yes, the existing companies here, it is more about existing taxi owners or taxi companies, right? You have a lot of current cab drivers as well, other than Ola and Uber. So those things may not have been taken by the existing business. Then clever innovations tend to evolve and improve over time, eventually surpassing existing products or services. Now, this is not the initial part. See, this is evolving over a period of time. Here we are talking about immediate disruptive innovation. So this does not fit into that, right? So that is the first question. Is it clear on how did we approach this question? It is more generic, nothing to do with specific theory or the case study. So you have to see how do we understand the business. If you understand the business, it becomes easier for you to solve the MCQ, right? Then GST, as I told you, will be discussed in IDT. Then cable charging a premium for instant booking of prime cars had provided a new value to the customers by making service access easier and more convenient than its basic version. So they are charging a premium. Adaptability to which model created a significant advantage for the organization. So in the third question, they are talking about which model did they adhere to when they are charging the premium. Now here, premium for instant booking. Premium for instant booking. So what we'll do is, we'll look at these models first. Okay, let me just pull out the material. We'll look at the models first, and then we will see which answer is the correct answer. This will ensure that you simultaneously revise the theory also. Okay, that is the idea. Whenever there is a new theory being introduced, or whenever there is something which is new to you, especially on strategic cost management side, we'll revise that and then we'll come to the answer. Just give me a moment. So here you can see various models. Okay, so you have the digital platform model. So this entire chapter is about business model, and you should definitely go through it once to understand what kind of models we are talking about, right? So here we have the business model, and different parts are there. Free model. In free model, what happens? You give everything for free, in which the core product is distributed for free to a large number of users, and the premium products are then sold to a smaller subset of users who desire premium features. For example, you have a lot of, let us say, free resources available. Okay, we also provide free resources. We give a lot of free resources, and then there are students who come and subscribe to our classes. That is one aspect. Or you can see where YouTube give all the contents for free. But then off late, what happens? What happens when you watch free content on YouTube? What do you get when you watch a free content on YouTube, and what irritates you a lot? Yes, someone? Advertisement. Then what you have to do? You have to pay for it. So this is called the free model, where initially you give something for free, and then to a small set of users, they'll say, pay premium. Spotify. Now you can't even select a song to play. You select one song, they'll play some other song. So then what they are insisting you have to buy the subscription. Okay. Then advertising. This is something what YouTube does. Cross subsidization. They provide a free or a low cost product services to a customer in order to drive higher margin sales of a complementary product. This I have seen. Best example I can give you is of DMart. Have you seen any shop giving discount on milk? When you go to buy milk packets, does the shopkeeper give you a discount on milk packet on MRP? They in fact, they'll say you pay us, refrigeration charges extra. But DMart, what I have seen is they'll give 4 to 5 rupees discount per liter of milk. But then you enter into DMart to buy the low price product, and what happens? You end up buying other 10 different products. Okay, so that is the cross subsidization model. Then open source model. This is more like, we'll give our coding resources, everything for free, which you can use and build upon. So Android, in fact, a lot of this was open source, but now that open source, Google has been able to monetize. Promotion. So in promotion, what do? You are generally, giving a free gift or something like that. Okay. Then you have the subscription model. Subscription model means you pay, let us say, 99 rupees per month. That is a subscription model. Every month you pay, you access the service. You can see this in, let us say, something like Netflix. You can see in Microsoft Office and related aspects. Then you have freemium model. Freemium model means, for example, in our classes, there is a free course section. So where 1 to 2 chapters are free, and for remaining chapters you have to pay. Okay. Then the e-commerce model, where you use a digital market to sell your model. This can be business to business, where one business is selling to another business, something like, let us say, IndiaMart. Then you have B2C, almost everything, like we are B2C. Then Amazon is B2C, Flipkart is B2C, that is business to consumer. Then it is C2C, consumer to consumer. Now, consumer to consumer platforms are like, peer lending platforms, where customer directly interacts with the other customer. Then, or OLX, Twitter, and all of those things, where you can buy and sell. The customer lists the product, another customer buys the product. Okay. Then customer to business. Now, customer to business is more like customer providing services or providing online services to the business. Then we have the hypermarket model. Now, hypermarket model means what? You have models like supermarket kind of a thing, huge markets. Okay, so let us say you have Walmart, you have DMart, all of these. These are hypermarket, means huge market platform places where they sell products to the customers. Okay, so they'll give huge quantity. They have a huge, ability, and they provide goods at a discounted price. Okay, so this hypermarket again can be both physical as well as your online platform. Then access over ownership model. So now this is more about, you can use, or you can actually access something by paying rent. Okay, something like, let's say, Airbnb or something like that, rather than owning it. Okay, so that is what is the access over ownership, or you can rent a bike or something like that. Then we have the service ecosystem model. Now, service ecosystem model means what? Here, the company offers different products which will be integrated, and the customers will become accustomed to use one facet. This is a lock system in which company limits customers' option and thus eliminates competition. Now, this, if I have to give you 2 examples, one classic example is SAP. SAP, when you implement SAP and you add 2-3 more components of SAP, right? Then you cannot move out of SAP. Okay, so that is, once you're used to a particular service, you cannot move out of that very easily. Or personally, if you ask me, I'm conducting this class, I'm using an iPad, I'm using a MacBook. I'm so used to this too, and also my iPhone. So the video is being captured through an iPhone, which is wirelessly connected to my Mac, and iPad is also wirelessly connected to my Mac. Now, I am locked in this ecosystem. I cannot handle an online class using a Windows system. So the entire service is given as an ecosystem. Okay, so that is what is a one more model. Then experience model. This is a model in which company offers unique, stylish, new and innovative products to those who can afford to pay for them. So this is more like luxury. We are giving you some experience. Okay, holiday experiences or luxury experiences. Then you have, let's say some luxury hotels or luxury, let us say airline lounges, executive class. It is about experience. So here it is about the wow factor. It is not about the satisfaction of needs. It is about wow, that is a nice experience kind of a thing. Then we have on-demand model. Now, what is on-demand? They charge the premium for instant access to the company's product or services. Now, if you go back to the MCQ, they're talking about whether it is on-demand. I think they spoke about experience also. Okay, so on-demand means what? So this is app-based riding and cab booking transport business using this particular model. They are charging premium. Same way, you need immediate delivery, pay extra. So because you want everything immediately or on demand, pay extra money. Or wait for 2-3 days and you will get as per your regular time. Okay, so in all of these models, so basically it was a quick recap of the business models. This chapter is very important from IBS perspective. So even if you have not completed strategic cost management, you have to read this chapter once, so that in the examination, if a question comes, you can just go to the chapter and pick it up. So the question is whether it is an experience model. Here we are not doing experience. Is it a subscription model? We are not charging subscription. Is it an on-demand model? Yes, it's an on-demand model. See, a small 2-mark concept, small concept can fetch you 2 marks. And I'll tell you, if you are able to handle MCQs well, this particular paper will go really well for you. Okay, so that is one thing you have to keep in mind. Then, analyzing the facts from the above, determine which classification best describes Cabber's current growth stage. Okay, now there is a Cabber, the company. What is the current growth stage? Now, is it a startup? Is it a scale up? Is it a unicorn? Is it an incumbent? Okay, so startup, when you just start, it is called a startup. Scale up, you are scaling up your business. Unicorn, what is a unicorn? What is a unicorn? Can someone tell me what is a unicorn? I think in the current phase, we should be aware of these common terminologies which are in the business.
Large organizations, like big company.
It's a big company. But why do we call a company a unicorn? Or when do we call a startup to be a unicorn? Valued over $1 billion. Okay, so it is not based on the stage. Unicorn is based on valuation. This is actually AFM, but because the question has come, up and it is a direct question. I will I'm addressing this. Unicorn, please make a note of it. Something which is valued over $1 billion, a startup especially, is called a unicorn. So Byju's was a unicorn. Okay. Similarly, you have Zepto. Zepto is a unicorn. Then you have, let's say, Zerodha is a unicorn. Amazon is a unicorn. Flipkart is a unicorn. Anything which has a valuation of $1 billion or more than that is a unicorn. Okay. It is not to do with the stage. Incumbent is new. Someone who is coming new. Now, where do we get the answer? In the last they are given, it has a valuation of $6.5 billion US. So if it is more than $1 billion, it becomes a unicorn. So it is a startup, but current stage of the startup is unicorn. Okay. So if I know the concept, 2 marks here. If I know the concept, 2 marks here. Okay. This is more generic. And if I know the GST provision, 2 marks here. So like this, we have to target, and it is convenient to score 60 plus in this paper, especially because a lot of weightage is there in MCQ, and some small concepts can actually help you reach that stage. Okay. Then the last question is on number of directors, which will be taken in the law class, right? So we'll pause here. I want you before tomorrow's class, if time permits, just have a reading of business model canvas. Okay, this part from the material business model canvas. Where is it given? I'll just show that to you. I'm not able to pull it up. What I'll do is I'll share the relevant topic in the group. Please have a look at the group and look at what is the how do we make the business model canvas, and we will see how to draw the business model canvas in tomorrow's class. Okay. I hope the session was useful on how to approach the paper. It will be initially, especially for those topics which you have not read or which are reading it for the first time, it will be overwhelming. But trust me, after you do some case studies, you will slowly find comfort in solving the case studies, right? So thanks a lot, and we will continue tomorrow from
Thank you,
the
sir.
descriptive question. Okay, so thank you. So yesterday we had completed the case studies related MCQ related to the case study. Now we'll look at the next remaining two questions, which is the descriptive question. One is, based on the scenario, how did Kaber address customer pains and generate gains, and what specific strategies and features did it implement to enhance the overall customer experience and contribute to social and environmental benefits discussed? Now, this is again more of a generic question, if I have to tell you, but then there is a specific aspect about customer pain and gain. Okay, and this concept is covered in your chapter 1 of the strategic cost management module, that is your SPOM part B. So we have something called as a value proposition canvas. Now, value proposition canvas, what it basically means is, for any question, any problem, or any product you look at, what is the value that the organization is giving to the customer? For example, if you're using any product, any service, what is the value you are deriving out of it? Only then you will make the purchase. Otherwise, if you don't get any value from the product, or if you don't get any value from the services, you will not purchase the given product. Now, what could be the value? There could be multiple value. For example, one values could be, it is helping you to solve some problem. You have some problem, the organization is solving that particular problem. For example, let us say all of you who are, yesterday also we had students who are working somewhere, that is why they are not able to attend the classes, right? Now that is a pain for the customer. Now to solve that pain, we have solutions like online classes, the Zoom discussions that we are having. Now this solves the customer pain. So customer has a pain, we have to reduce the pain, or we have to relieve the pain, or there could be something which adds a great amount of value to the customer. The customer doesn't have a problem currently, but with the product or services, the customer will gain something. Maybe he will gain some experience, or you are using, let us say, instead of using age-old technology for your computers and all, you're using the latest technology, or you're using something, let us say, artificial intelligence or something like ChatGPT. Now, when it comes to all of these, there was no pain. Earlier also, we could do a lot of stuff without ChatGPT, but ChatGPT is giving us something which helps us to, gain, or which helps us to do better in the work that we are doing currently. So you have to offer some value to the customer. Now, in the case of cables, what they are doing, they are offering value in terms of you can book anytime. There is an on-demand service available. You can do payment through online modes, right? Then you can plan your trip. There are premium subscriptions available. You can share cabs. So all of those things are value proposition that is given by the company to the customers. So value proposition describes the benefits that customers can expect from a product and the bundle of product and services that the business offer to specific customer segment to create value. So anything you do, anything you see, there has to be value proposition. Now, to give more examples, earlier we didn't have something called 10 minutes delivery and all of those things. We started in the recent time. There is no pain as such. Almost every one of us, we would go down and purchase stuff, or we would plan in advance and purchase stuff. But with 10 minutes delivery and all, they are able to give us something which is a gain for the customer, right? The value proposition canvas is the tool that will help the organization to design, test, build, and manage the great customer value proposition. So it is more like a build up on the business model canvas. Will come to it. It is more like how can we provide gain to the customer? How can we reduce the pain of the customer? Okay, so the customer has some pain. We are acting as pain relievers. Now, in the case of cables, one of the pain is what? One of the pain is we are not able to get cabs or we are not able to get taxis on time. What is the pain reliever? We have an app with the help of which we can do the booking, right? Then the customer can gain. We are saying we have some gain creators. So our products and services will act as gain creators, which if the customer likes, there is a fit. There is a fit. Now, to understand or to further break down this gain, pain, and gain creator and pain relievers. So there are three parts. One is the customer side, another is the value proposition side. So this is the customer angle. This is the organization angle. From the customer angle, customer has some job or requirement. Now here we have termed it as job. It is basically they want to do something. They want to do something. They have some requirement for for this. When they execute this job, there are some pain points, and we are offering pain relievers to reduce the pain. That is how you have to understand. Okay. Now let us look at each of these. Customer jobs. Customer jobs means what? These are the issues or requirement that the business customers are trying to solve or resolve in their work. Now, when they say work, it is not necessarily a work related to office work or something like that. It could be a work related to day-to-day life as well, right? So that is the customer job. So it is something that they wish to satisfy or a task they want to perform, something in their professional life or in their personal life. That is the customer job. So first component is customer job. Then pains. Now, what are pain? Pain is something that annoys the customer either before, during, or after getting a job done. So waiting for a cab in the given case, that becomes a pain point. What are the pain that the customer is facing, right? Then gains. Gains are the benefits that the customer requires or expects or desires, as well as complementary benefit that he doesn't expect, but will be excited about or surprised by if he gets. So basically, gains means something that the customer wants. So I want something from the product, that is the gain point. And there could be something additional or incidental that is also, something related to gain. So if I get some extra benefit, for example, if I buy an iPhone and I get something for free, that excites me. My basic requirement is iPhone, but if I get something more, that also becomes my gain component, right? So that is the first component or first part of the map where we talk about customer profile. Now, what is the value proposition map? That is what is the organization offering to the customers. A value proposition map describes the feature of a business value proposition that it has designed to address its customer jobs through products and services. So the organization is saying that, yes, you have a requirement. We will fulfill the requirement. You have a pain point. We will relieve your pain. You have some gain expectation. We will give you the gains. So there, what does the organization do? They offer products and services, the goods and services, and they can be pain relievers, which they say, okay, this will solve your specific problem, or they are the gain creators, which is what the customer will gain because of the product. Okay, so whenever you see these pain creators and pain relievers and gain creators, what you have to understand is, what is the problem of the customer? What are we trying to solve? That is the pain reliever. And what is the customer gaining out of our product? That is a gain creator. Now, having understood this, you can go through these some of the examples subsequently after the class. Having understood this, coming back to our question, how did Kaber address customer pains and generate gains, and what specific strategies and features it implemented to enhance the overall customer experience and contribute to social and environment benefit? So multiple things. First, they are asking, how is the pain being relieved? That's the first requirement. So in case study based question, when you have to answer the descriptive part, a lot of answers you will get in the question itself. That is the first thing. Second thing is you have to answer or address all the requirements of the question. Not only pain, pain and pain relievers. They have also asked specifically about how have they enhanced overall customer experience. It is a generic question. And how have they contributed to social and environmental? So they're talking about social as well as environmental benefits. So these 5 aspects we have to address in our overall answer. There is no single right or wrong answer. There is nothing you should be, there is nothing you should be. I think there is some issue with screen sharing. Just a second. There is nothing you should be mugging up. This is not something where you have to mug up. So what you have to understand is you have to discuss about pain, then you have to discuss about gain. Now, what is the pain? Again, you have to give the theory of what is the pain that you have understood. You have seen something that troubles or that creates problem for the customer. That is what is a pain. Now, that is where you have to take the theory with you. If you take the theory with you, you will be able to pick up the theory and describe what is pain and what is a pain reliever. Okay. So first, how we have to approach in this kind of question? Describe what is pain, what is a pain reliever. Right? You can define that. Then, based on the case study and based on your understanding, what are the various pains that we could see? Now, yesterday when we learned about the case, discussed the case, what is the problem? The problem was customers were not able to get taxis or autos, right? They could not get taxis or auto. Now, that is the pain. How did Caber solve this problem? Caber solved the problem by providing app through which they could book cabs. Now, because of this, what happened? The customer's waiting time has come down. Okay. So that is one thing. Then what is the next problem? The next problem for the customer was they do not know where their cab is. Caber provided real-time tracking or real-time tracking of the cabs. So that again has helped to reduce the pain. Then, so if you just come back to the case, and please understand this is for customers. Okay. So here you can see pain of paying, paying things or paying amount in cab. Then they have shorter waiting times. So the traditional business had longer waiting times. Now, when they had longer waiting times, Caber gave this app option, and now you have shorter waiting times. Then the fare, it provides an upfront pricing feature. So they have improved the experience. The estimated fare for the trip is available beforehand itself. Caber offers transparency to the passengers on the cost of ride, helping them to make informed decision. So in general sense, if you look at an auto or a taxi, you have to, it is very difficult to get an estimate of fare. A lot of times we feel that, they might be looting us. Some kind of doubt also comes in our mind. So with this feature or with this option available, there is transparency available. So what you have to do is 2 or 3 pain points, not every pain points, 2 or 3 pain points you take, and 2 or 3 pain relievers you can share, right? That is the first thing. Then gain. Now, apart from the core pain relievers, what are the various other types of gain that Caber has provided? Now, yesterday when we looked at the case study, we saw that they have started providing, auto option. They provided shared cab option. Okay, so that is something which the customer is either desiring, or it is something which unexpectedly comes to the customer. So again, you have to define what is gain. You have to define what are the gain creators and how have they created gains for the customer. So they have been given multiple ride options. That is one option that is they have provided. Then they have so the transparency part and all was covered in pain points. Then with the help of app, they can book the cabs very smoothly. So that is one more aspect that is available. Then you can track the rides. So that is also an additional benefit. It is not only solving the pain, it is also giving us additional benefit. So you can see with the help of app analytics, they can track and measure the performance of the services in a city and through the respective drivers. So how are the drivers performing? Based on that, they can provide good quality drivers to the customers. So that is one more aspect which we can have a look at. Then you have multiple ride options. Then you have flexibility in terms of vehicle type, comfort level, pricing that best suits their requirement. So I can choose what I want to or take as a ride in the app. They are being provided high experienced driver. Then they are providing premium services. All of these become gain for the customers. Okay. Then the third part is what specific strategy and features it will implement to enhance the overall customer experience. So this part we slightly touched upon with the help of driver experience, training the drivers. So they continuously train the drivers so that the drivers are professional. So if the drivers are professionals, then it actually improves the customer experience. If the waiting time is less, it improves the customer experience. Then how have they contributed to society and how have they contributed to environment? Now, from the society angle, they have helped by onboarding a lot of drivers. They have provided employment opportunities of drivers, and also for the drivers, they have given flexible working hours. Like you can log in, log out whenever you want to. Okay, so that gives employment opportunity, which is a contributing factor to the society, right? Then, how have they helped in environment? See, it is not directly given in the case. You have to infer that. How have they improved? See, one is by allowing shared cabs. Okay, so you can actually do carpools and you can reduce the traffic on the road. Second is by mapping the nearest cab available to my requirement, I can reduce the travel time. So that also reduces the traffic burden, right? And based on their analytics, they can decide in which area at what point of time when the cab should be available. So all of these will, in a way, directly or indirectly, have an impact on the environment. Again, the last one is more a generic answer, not a specific textbook answer, right? So that is how we have to answer. With this discussion, what you can do, you can subsequently have a look at the solution. We have covered almost all the points. We have covered, in fact, more points. Now, don't get scared with the length of answer given in the suggested case study, suggested answer. So if you come down to the suggested answer, so they have defined pain and pain relievers here. Then they have said customers experience difficulty finding a taxi. This is a pain point. Cable relieved this pain by eliminating the hassle of waiting on the street or making phone calls to book a cab, offering a convenient and seamless booking experience. With efficient routing algorithms and effective matching mechanisms, Cable significantly reduced waiting times for the passengers. So, not able to find taxi, what is the pain reliever that they have provided, right? Second, concerns over safety and security of rides during late hours. They have handled this by putting stringent safety protocols and thorough background checks on the drivers, ensuring passengers feel confident and secure while using Cable services. So they have invested a lot on driver technology, driver training also, and they have also invested a lot of amount on the app real-time tracking. They provide upfront pricing. So there's a lot of inputs required here or given here. Are we required to write everything? Not required, because time will not be sufficient. See, this, if you write, so this would be around 1, 5, 10, 15, 20, 20, 1, 2, 3, 4. This itself is about 200 words. And if you write 200 words, it will fill up at least a page. So everything may not be required. You have to see based on the number of marks allotted for the question, how many points you have tried, and preferably use bullets to say this is the pain, this is the solution, this is the pain, this is the solution. Okay. Then same way they have explained what are the gains. Then how have they improved the customer experience by providing multiple ride options, economy, premium, and shared ride, allowing customers to choose based on their needs and budget. They expect consistent and high quality service, which they deliver through features like in-app navigation, trip sharing, and 24/7 customer support. Cable's user-friendly app interface simplified the process of booking. So there is a simplified process of booking, right? Then complement various other features. Various other features like your loyalty programs, the rewards program, the loyalty programs, All of these improve the customer experience. Then they offer flexible learning opportunities for its driver. This is to do with the society. Then they help, they provide employment opportunities. Then they have environmental contributions with the help of ride sharing options, efficient routing algorithms to reduce the traffic congestion and carbon emission. So you have to answer in a crisp manner, covering all the 5 requirements that is asked in the question. If you miss out on any requirement, marks will be definitely deducted, right? Then the next question, draw a business model canvas for KBER. So there is something called as a business model canvas. We need to understand that. So this again, when you carry it, it will be easy for you to replicate the thing. There are 9 elements: key partners, key activities, key resources. What is the value proposition? What are the customer relationship, customer segment, channels? What is the cost structure, and what is the revenue stream? Now, if you see this, how do you understand or break this down is, one, if I look at this side, on this side, I have customer relationship, I have customer segments, I have channels. So this has to do with the customer side, the service that I'm providing. Okay, value proposition actually links. What are my key? Who are my key partners? Okay, so for example, if I talk about a key partner in my KBER's case, one of the key partners are drivers. So these are the ones who actually help me to provide service to the customer. So there could be my partners, there could be my vendors, all of those who help me provide or render the service. Key activities, these are the ones, these are the things that I do. These are the things that I carry out to deliver value to the customer. Okay. Key resources. Now, key resources are something that we use. Key resources are something that we use to provide services to the customer. Value proposition is basically what we offer to the customer in terms of saying, okay, this is the value that we are offering. Relationship, customer segments and channels. So customer relationship, how do I improve my customer, or how do I maintain my customer relationship? Customer segment, who are the various customer segments whom I am catering to, whether it is individual, corporate, retail, or something like that. Channels, how do I reach, or how do customers interact with me? How do I deliver my product or services to the customer? Cost structure, what is the overall cost structure? What are the costs we incur, right? Then what are the revenue streams? How do we get the revenue from the customers? Business model canvas helps the firm to map, discuss, design, and develop robust business models. Business model canvas helps users visualize what is important and forces them to address key areas that are relevant from the point of view of strategy. So basically, we can map all of these 9 elements. So what are those various elements? Customer segment. Customer segment describe who the customers of a business are, why they buy from it. Segmentation is discussed in the next section, so it is discussed separately. But anyways, for us to understand segment, whether these are our retail customers, whether these are our industrial customer, individual customers, something like that. Then value proposition. What are the product or services that the business offers to the target customers in order to solve their problem? So basically, what are we offering? What are we offering? Now, when it comes to our business in the context of KBER business, what are we offering? We are offering something like, let us say, booking cab, ability to book the cab on the app, transparency of fare when they're booking the cab, okay, options to share the cab, premium benefits, something like that. So what we are offering as value, that comes here. Then channels, how do we distribute? Whether it is through physical delivery, whether it is through some distributor, retailer, wholesaler. So in manufacturing industry, you will have retailers, distributors, and all of that. But in case of a cab, you have direct app. In this case, in the case of KBER app, it is app only. Same way in case of IndigoLearn, it is through app online. Okay, so that is the channel. Then customer relationship. How do we interact with the customer? So then we may take feedback from the customers. We may take reviews from the customer. We have customer support team that is available. So those are the customer relationship. Then revenue streams. How do we get the revenue? What are the various avenues through which we get revenue? So of course, revenue, we take transaction fee from the drivers. There is surge pricing which is applicable. So that is where we get revenue. Then sometimes if you cancel the ride, there is a cancellation fee that gives us revenue. Key resources, they describe the most important asset in the business that are nearly indispensable. They can be man, material, machine, method, money. But the thing is, these are key. Without this, you will not be able to run your business. Now, in case of our Kaber app, one is the app platform, that is a key resource. Then the staff is a key resource. Okay. Drivers, they are contractual, so they become partners. Okay. So these are not resources, these are more like partners. Okay. So, but our in-house staff, the customer support staff, all of those become our key resources. Key partners, they include suppliers and channel partners who make the business model work. So in our case, one of the important key partners are the drivers. Then we may be relying on, let us say, some kind of technology that could be there. Then we may be, because we are collecting payments online, we need payment aggregators. So all of these becomes the key partners. Key activities are the most important things to do in the business or keep it running or working. The need is to define whether the business is a manufacturing solution, supply chain partner, or a problem solving service industry. So basically, when we say key activities, what are the various activities that is done? So in our case, there is an activity of getting a right request from the customer, informing that to the drivers, getting the drivers, onboarding the drivers onto our platform, right? Then we have a lot of marketing initiatives, market promotions, and all of that. Then we have to improve our app platform. So all of those becomes our key activities. Then cost. Cost includes expenses to operate the business and perform the activities. So cost is basically, as you understand, what are the various costs? So you have cost related to what you pay salaries to the staff. Then there is a cost related to marketing. There is a cost related to app. So whenever there is an app, there you have to invest some amount of money to run the app, right? Then there may be cost related to, if at all there is a, payment processing fees. So that also becomes a cost. For all the drivers and all, you have to maybe take insurance. For all the cars, you have to take insurance. All of these become your cost. So that is how you have to create the model. Now in the examination, depending on how much component you can do either three value proposition between cost structure and revenue stream. So basically, this on one left-hand side, this on the right-hand side, then you can have value proposition here and cost structure and revenue stream. Okay. Now, when they say business model, what is expected is now there are 9 elements. Okay. So if this question is, let us say, for 5 marks or 6 marks or 7 marks, under each category, at least 2 to 3 elements you should be able to write, minimum. If you can write more than that, very good. If you cannot write at least 2 to 3, you should try. Second thing that you have to understand is this business canvas information will come from your understanding of business. Some of these may be not directly given to you in the question, but by looking at it, by looking at the business, you can figure out, okay, these could be the key partners. For example, if you see a cab company, drivers are the key partners. Okay. Then if you take vehicles on lease, the lessors also become the key partner. Okay. So those things can become key partners. So you need to have an understanding of the business to identify who are the key partners or key activities or something like that. So let us look at the business model that is given to us. So first one is key partners, technology providers. They provide technology for what? For our app. Then financial institutions, if at all we are taking money, loan, or if you are raising money, insurance for the cars. API providers, this is something to do with tech. Even if you don't write, it is perfectly fine. Payment processors, whenever there is digital payment, there is a payment processor, like you have Razorpay, BillDesk, Paytm, and all of those. Then local authorities, drivers, and staffing agencies. So all of these are key partners. Then coming to key activities, what they do, communication with the drivers, customers, and partners. So this is the first most important activity. Hiring drivers and handling their insurance and payouts to secure medium. That's the second activity. Then analyzing data, sales promotion, platform development. So even if you're able to write 2 or 3, that will be sufficient. Then value proposition, flexible earning opportunities for its driver partner. So on the driver side, they're saying, we will give you flexible earning opportunity. Safety and security for the customers, convenient and easy transaction, opportunity to get an insight as to the fare and duration of the ride, competitive pricing, complementary benefit, or you can also say on-demand on-demand rides. Then you can see premium services. Okay, that is also a value proposition. Okay, then real-time tracking, that is already come up. So all of these are value proposition. Customer relationship, you have customer support, very important, social media engagement, and review and rating by the customers. Customer segments, they are basically passengers. Drivers is not retailers. So these are only two. Drivers is not your customer segment. Key resources, the app platform, the pricing algorithm, the brand value, and the staff. Channels, only the app. Cost structure, legal cost, insurance cost, platform cost, customer support, salaries, all of these are standard costs. Revenue, right transaction, search pricing, cancellation fee. This is okay. So these are your revenue streams. So now, with these two questions, we understood or quickly revised two important concepts. One is the pain creators and pain relievers, then the gains, right? Those two things we discussed. And then how does the company and the customer has a pain, how does the company relieve the pain? So how both of those interact with one another, that is one more thing what we have discussed. And then in the business model, we understood what are the 9 elements and how do we present those 9 elements if a question comes in the examination. So it is important that as you prepare for this particular integrated business solution, you must have a decent understanding of where is the theory coming from. Just because SPOM is exempt for normal 24 attempt, you should not think that I will not read this paper. This time there has been a good amount of weightage for this particular paper. Okay, so we have concluded this case. We'll conclude it here today. And tomorrow, it will be taken, so the case studies would be taken by other faculties of respective subjects. You'll be getting the update in the groups. And if you're not attending live, a lot of you are not attending live. So we have about 30 students, but most of them are wanting to watch it recorded. You can access it subsequently as well. Komal, if you have any questions, you can ask. Otherwise, we'll end it for today. And tomorrow you will have another faculty taking up the remaining.
From where we are referring these questions, sir, I could not get the questions.
Sorry?
Case study digest, where is it, sir? Where can I
You
find
need
it?
Case study digest. You want the case study digest?
Yes, sir.
I will share the link. You are in the group, right?
Yes, sir. I am in the group, sir.
Okay, I will share the link in the group.
Yes, sir. I do not have it, sir.
Okay, I will share it in the group. And which attempt are you writing?
Sir, this only November
November.
24.
Both groups or one group?
Sir, only the second group.
Second group. So have you already cleared the first group?
No, sir. Last time I have given both the groups, but I scored partially better in second group. So I am just
So you
going
want
for
to
the
write the second?
second.
No problem. No, just asking because a lot of students are only writing the second group. They have not even started the first group. So for them, this becomes very difficult. If you have already written, then it is not difficult at all.
Yes, sir.
Yeah. Okay. Sure. Thank you.
Thank you, sir. Sir, please share the link, sir.
Sure. I'll share it.
Thank you so much, sir.
Thank you. Let's now have a look at the next case study. This is about Becky Bond India Limited, and it is in the fashion industry. Okay, so they have a global reputation. So as we have been telling, when you read a case study, no need to go through everything line by line. First, we look at the questions, and accordingly, we will come back and see what are the requirements. That will save us some time. So here in this question, the first one is financial results. You would have already covered as a part of law. Then unpublished price sensitive information, again law. Again, listing related part related to law. SEBI, again related to law. Separate. Why is it necessary for Becky Bond to create a separate brand for lower price products when expanding in Pune? So this is something to do with strategic cost management and performance evaluation. Then shareholding pattern, again related to law. Coming to descriptive question. Applicable income tax rate is 30%. CFO is of the view that no tax expense should be recognized in the quarter and year to date ended 30th September, as no income tax is payable for the entire year. So basically they're saying in the interim financial statements, we don't need to recognize tax expense. So that is what we have to look at. Is the CFO correct? And if not, please describe your rationale and also state the amount of income tax. Okay. Assess the competitive environment in the segment of fashion industry in which Becky Bond operates using Porter's 5 forces model. Now, this Porter's 5 forces model is very, very important because we keep getting questions on this. We have learned this in strategic management. This is also given in the first chapter of your strategic cost management. Then evaluate the supply chain of Becky Bond, identifying its current weaknesses and suggesting ways to overcome them. This is more generic, even without having a knowledge of theory of supply chain. You can figure out basically while reading the case study, you should be able to tell what are the weaknesses of the supply chain system and what are the ways you have to recommend. You have to provide specific ways to overcome them. Now, in this background, let us go back and read the case. Very big case. So, fashion clothes for men and women, and the company has acquired global reputation for good quality, reasonably priced, well-designed and reasonably priced fashion clothing. So they are into fashion business. Like other fashion clothing companies, they continually design and produce new clothes for the fashion market. During the course of 1 year, the company produces 15,000 new fashion designs. So every year, how many fashion designs? 15,000. And it has a large team of fashion designers. The company's top designers, who are based in Paris and Moscow, have an international reputation. They bring international acclaim and expertise, enhancing the brand's appeal and global market presence. Now, see, in this entire thing, there is nothing which is asked in the question. So we have to learn how to ignore irrelevant information or noise, what we call, when we are reading a case. They have established itself as a leader in the global fashion industry renowned for its innovation, quality, and style. So this is what they are known for. It is built on the success is built on a foundation of meticulous craftsmanship and keen eye for emerging fashion trends. Unnecessary extra English is given in the question. Becky Bond's clothing lines, known for their sophisticated designs and high quality material, resonate well with both fashion forward consumers and classic styles. This dual appeal has allowed Becky Bond to carve out a significant niche in the crowded fashion marketplace. Becky Bond is not just a clothing manufacturer, it is a trendsetter in the fashion industry. So more like a leader. It is a leader in the fashion industry. By hosting fashion shows in major cities around the world and participating in international fashion weeks, they showcase its latest design to global audiences, influencing fashion trends and setting new standards. Even here, nothing much is there. So in examination, how do we handle this? What do you do? Read the first sentence, read the last sentence. Largely, you will get to know what is given in that paragraph. This will save you a lot of time. Okay. Then, the company's distribution strategy is as robust as its design capabilities. They primarily sell its product through a network of retail stores, some of which are company managed, ensuring consistent retail experience that aligns closely with the brand identity. In addition to these dedicated stores, the company also partners with major department stores, securing dedicated space to each broader audience. This dual channel retail approach allows Becky Bond to maintain strong control over its brand while also benefiting from the extensive foot traffic and consumer base of large retail establishments. Now, this, if you have to correlate with any other fashion brand, you can think of a brand like, let us say, Mills Lifestyle, okay? Or you can think of a brand like, let us say, or you can think of a brand like, let us say, Levi's. They don't come up with so many designs. So what happens is, or you can look at, fashion garments like Biba and all of those other upmarket segment. Generally, what happens is they have their own stores. They also have places in departmental stores or malls, basically. So that is what this is trying to tell us. The company operates its own retail store with the number increasing each year, while its presence in the department store is declining annually. Most of these stores are located in Mumbai. Sales from Pune currently account for less than 10% of the company's total sales. As a prototype, the company has also established e-shops for online selling. Becky Bond India Limited stands as one of the India's leading brand, fashion and lifestyle entities with an impressive portfolio of fashion brands. As the country's leading pure-play fashion powerhouse, the company commands over 10.8 million square feet of retail space. See, again, not very relevant for the answer perspective, but still important one. This strong and vast infrastructure ensures that the company meets the growing needs of expanding base of brand-conscious consumers. The performance of company in FY23 is a testament to resilience and determination. After weathering the impacts of the pandemic for 2 years, that is the COVID, Becky Bond India Limited have made significant strides in both expansion and sales growth. surpassing previous year figures despite macroeconomic challenges. So again here, nothing much. The success has been driven by a targeted approach to growth, prioritizing distribution expansion, product innovation, customer engagement, and brand enhancement. Last year, it witnessed a 53% YOY growth, that is year-on-year growth, and EBITDA growth of 34%. Again, parameters wise, yes, they could ask some questions based on performance measures. They could ask question based on their, how the sales have grown and all of that. But again, in this question, nothing much to be taken from here. Although all clothing products are designed by the company's own staff, most manufacturing is outsourced to small manufacturing companies. Now remember, there is a question on the supply chain. I think that is very related. Most of these manufacturers are located in Nagpur or Thane. The company's policy of relying on large numbers of small suppliers has been successful in the past, but more recently, there has been disagreements with a number of suppliers who have been demanding higher prices for their work due to increase in their own cost. So basically, large number of small manufacturers, that is where they rely on. Now there is disagreement with the supplier, that's one problem. This is one problem which we can highlight. The rising price of cotton and fuel in particular have been a cause of concern for the manufacturers. Becky Bond also has its own manufacturing subsidiary located near Pune, but it produces less than 5% of the company total requirement. The strong reputation in the market has been built largely on the success of its fashion design. The company displays its fashion regularly at major fashion fairs. So there's more to do with where are they presenting their fashion fairs and all. Now, is this something to do with your supply chain? Nothing to do with the supply chain. Okay. Then orders are placed with the manufacturers and manufactured items are delivered to a central distribution center that the company operates near Pune. So basically, orders they place with those small manufacturers and the items are delivered to a central distribution center. So if you visualize this, small manufacturers, many of them, the company places the order, all of them deliver the product to a central location in Pune. And then from here, I think they would move to Mumbai and partly to Pune. Goods are either sent to department stores directly from Pune or they are sent to subsidiary distribution center from where they are sent to company's own stores and department stores. However, many department stores reduce their pre-orders of items in year 4, year 5 and place additional orders with the company later in the fashion season when they knew what items were selling well and which were not. So what is happening here? Normally, they are expecting pre-orders, but then the stores are not giving pre-orders. The stores are waiting for the new trends, and based on the trends, they are placing further orders. The company design team have been experimenting with a new just-in-time system of purchasing and production for some of its fashion items. Now, typically in the fashion industry, just-in-time may not work because it is more about innovation. It is not like a standard assembly thing. You have to continuously keep on changing. But yes, for some raw materials, you can actually do a just-in-time order like cotton. When you order cotton or threads or other kind of materials which are required, for that you can definitely implement just-in-time. This JIT system is similar to the system used by international fashion good producers. Only limited quantities of products are manufactured for the start of each season. Members of the sales team in each region check the strength of demand for each product and inform the head office in Pune which products are selling well and which are selling badly. Orders for additional quantity of the popular items are then placed with the manufacturers and distributed as quickly as possible to meet the sales demand. So this is more on the manufacturing side. So what they're saying, all the department stores, we will not produce everything in advance. We'll give you some product. Then what will happen? We'll give you limited quantities of product at the start of the season. So I will send all my product to all the department stores. Departmental stores will figure out which product is working, which product is not working. Based on that, they will give us additional orders. Based on that, we'll manufacture. So that is the kind of just-in-time inventory they are planning to maintain. Experiment with the just-in-time purchasing manufacturing system. So both purchasing and manufacturing system have been only partially successful. So this is one challenge in the supply chain we can note it. Due to long lead time between placing orders with small manufacturers and getting delivery into the distribution center, because they are spread out. You place an order, there are many small manufacturers and you are not getting the products on time. The company was listed on 20th September of year 3 on the BSE. Before the upcoming board meeting post-listing, the CFO called 2 of his team members who are expert in financial reporting and business strategy. Namrata mentioned that the company's board of directors set a financial target to achieve 20% increase in EBITDA to sales this year. It is disappointing that this target could not be met. Now, here, though they have mentioned about performance measures, they can put up an MCQ on performance measure, but here nothing has been asked. And here you have profit before tax, negative 350, 850 profit, 300 loss, 200 loss, estimated. Year ended, they expect it to be 0. Namrata mentioned that SEBI, so this is related to SEBI, so you can, you'll be covering that when it comes to SEBI, you would have already covered it as a part of law. Aarti mentioned that Pune has been identified as an important region for future growth, but there are possibilities for further expansion in Mumbai as the disposable income have improved. So whose disposable income? Mumbai. The design director believes that the company should review its product range and change the emphasis of its sales effort from some product to others. So revamping of which product to sell and which product not to sell. The CFO mentioned that the main competition for Becky Bond are from Zenze, Caterpillar, and BT. Zenze's success has been built on a rapid product development cycle and a fast production cycle based on GIT. It uses a large number of small manufacturers in the same area where Zenzi has a large and modern distribution center. Caterpillar has also been highly successful in the Mumbai fashion market. BT has been left behind these two rivals, but is trying to recover the lost ground through an expensive advertisement campaign and refurbishment of many of its stores. So different competitors, different challenges. BT's turnover has doubled in the past decade, whereas the turnover at the company has risen threefold. Caterpillar has increased fourfold and Zenze by 6 times. BT faces a significant challenge, as does the company. So the company that we are referring to, and which one? BT. They are facing challenges. In the large Mumbai market, their relatively slow design and distribution systems cannot keep up with the consumer demand for fast, affordable copies of the latest fashion trends. Almost half of BT's sales occur in Mumbai. However, the company is developing a strategy for further expansion in Pune, where its brand name is very strong. The CFO mentioned that the board is considering the number of alternative strategies to improve company's performance, including the following. So here is some challenge, something about the competition. Expansion in Pune as quickly as possible to acquire 25% share of the market for fashion goods within 5 years. Strategic problem with expanding in Pune is that customers are used to paying much lower prices for their clothes, and it may be necessary to develop a new line of products with a new brand name to sell at a lower price. So Pune, we cannot charge higher price, we have to charge a lower price. The market for fashion goods is relatively new and still developing as levels of wealth among consumers in Pune rise. In order to gain market share, Becky Bond will probably have to enter into a strategic alliance or a merger with a partner in the Pune. Expand business in the South Mumbai with the company's existing product ranges. So here, for South Mumbai, we don't have anything specific in the question, so you can park it aside for now. Developing new product ranges for existing market. Now see, this question can also be tested based on answer matrix. Okay, whether it is a product development, or it is a market development, or it is a diversification, or it is a penetration strategy. Consolidation strategy based on improving efficiency and reducing cost. These are several ways in which this might be achieved. One strategy would be to consolidate the sourcing of goods and using smaller number of suppliers in order to achieve lower prices in return for bigger orders. Now, if you see, a lot of this is generic. You are expected to have some knowledge of the fashion industry. Even if you don't have the knowledge, it's not a problem. Now, let us look at the question. Why is it necessary for Becky Bond to create a separate brand for lower price products when expanding in Pune? Now, to increase the production cost, see what I'm saying, we have to create a separate brand for lower price product. Why do we need to create a separate brand? See, I have a premium brand. The premium brand price I cannot reduce, because if I reduce it, my brand gets diluted. Okay, so to reduce the thing, I have to create a separate brand. Now that will not, my objective is not to increase the production cost. So this you can cut it off. To align with high pricing strategy of the existing brand, we are not increasing the price, so this is also gone. To avoid diluting of the premium image of the existing brand. So my existing brand is premium, and I don't want to dilute that. That is why I'm choosing. So correct answer is option C. So for this, you don't need to learn theory. It is a general business application. to compete with luxury fashion. I'm bringing a lower price product. How will I compete with the luxury brands? So this option is not correct. Option C is the correct answer. Okay, so let's see. Yes, option C is the correct answer. Then applicable income tax rate is 30%. The CFO is of the view that no tax expense should be recognized in the quarter and year to date ended 30th September as no income tax is payable. Huh? If you come back to the question, they have told us the profits. Profit before tax is 350 negative, 850 positive, 300 negative, 200 negative. All put together, it is nil. Nil means nil tax. But as per the interim financial reporting requirement, we have to calculate what would be the effective tax rate. Effective tax rate, I think the question mentions is 30%. Effective tax rate is 30%. So I have to charge tax based on 30%. So what if there is a loss? It is kind of a creating deferred tax asset. Even if there is a loss in one quarter and profit in the next quarter, when there is a profit, I will show income tax expense. When there is a loss, I will show income tax benefit like a deferred tax. So I will apply 30% tax rate. And what I will do, on 350, I'll apply 30%. So 350 into 30% is 35 into 305. This is a tax benefit. 850 into 30%. So 850 multiplied by 30%. 255. 255 is my tax expense here. Then 300 into 30%. 90 is the tax benefit here. 260 is the tax benefit. So 90 plus 60, 150. 150 plus 105 minus 255. So the claim that we should not provide taxation because the tax payable for the year is 0 is not correct. We have to see what is the effective tax rate, and accordingly we will have to do the provisioning. Income tax expense is recognized in each interim period based on the best estimate of the weighted average annual income tax rate expected for the full financial year. Amounts accrued for income tax expense in one interim period may have to be adjusted in a subsequent interim period if the estimate of the annual income tax rate changes. So for exam purpose, this first line is important. Paragraph, even if you don't remember, it's perfect. The general approach of estimating the effective tax rate for the year should be used even where an entity's result in the current interim period of the year is expected to be wholly offset by the result in the future interim periods of the year. So basically what that's saying is, we have to use a rate, we have to identify an effective tax rate for the year, even if the tax payable is 0. So here, as I discussed in the table, profit or loss for the period, tax rate, and tax charge and tax credit. Now, some of you may have a doubt, sir, for the full year it is 0, income tax is 0, and hence tax rate is 0. There is another way to understand that income tax is 0, tax rate is 30%, and hence the total tax will be 0. That is how you should understand. Right? Then
It's 7:30.
assess the competitive environment in the segment of the fashion industry in which Becky Bond operates using the Porter's 5 forces model. Now, for this, we need the 5 forces. Now, in the 5 forces, what do we have? Threat of new entrants. Correct? Then you have bargaining power of customer, bargaining power of supplier. Then you have threat of substitutes, and you have the intensity. These are the 5 factors you need to remember when you are doing Porter's 5 forces analysis, right? No need to draw the diagram in the examination. Even if you are able to remember these 5 forces, that is more than sufficient. So a quick glance of the 5 forces. Threat of new entrants, bargaining power of buyers, bargaining power of suppliers, threat of substitutes, and rivalry amongst the existing firm. So bargaining power of buyers means the ability of the buyer to dictate terms, including the price. So buyer, do they have more power or less power? Now, generally what happens is, if you have a lot of choices, buyers have a lot of power.
So for a fashion industry, it is not that I'll have to buy a specific brand. Okay, there are so many brands, so many variety available. The buyers have definitely huge power, because if they want, they can move from any brand to any other brand. So unless you are like, I want to buy only Arrow t-shirt or Arrow shirt, I want to buy only this particular brand. That is a very small population. Large part of the population would be like, yes, anything is okay for me. If this is cheaper, I'll buy this. Like we search on Amazon and all. So buyers have more power. Suppliers. Now, suppliers, there are many suppliers. There are many suppliers. When you have many suppliers, when there is diverse. So if there are many suppliers, then what happens? The power is less. If there are fewer suppliers, then the power of the suppliers will be higher. Okay. So bargaining power is higher if the replacement or alternative is not available. Now, in this case, is replacement available? Yes, they can definitely try to figure out replacement, because they're dependent on a lot of small buyers. Okay, they're dependent on a lot of small buyers. Then threat of substitute. In fashion industry, there are a lot of substitutes. Okay, lot of substitutes. You can keep on choosing. But then if I want a premium brand, a specific brand, then there will not be much of a substitute. Then threat of new entrants. Now, as far as new entrants are concerned, can they enter into new business easily? Yes, it is very, very easy to enter into new business. But then, is it easy to establish a chain? Now you have to say, can I establish a chain like, let's say, a Westside or a Zudio or a DMart? DMart is not into fashion, but can I establish something like this quickly? Can I build a brand? Let's say something like a Shopper Stop. Can I make a brand like that? So it may not be very easy. Okay. But then there are a lot of small fashion brands these days, especially because everything is online. You will see hundreds and thousands of brands coming up. So new entrants can come. To capture the premium market, it may not be possible so easy. Right. Then rivalry amongst the existing firm. Now, when there are a lot of players, and when there are a lot of players in the market, there is huge amount of competition. It is very intense. They have given us some examples of 3-4 companies which have great impact on the competition. So competition looks to be intense. Okay. So how do we present? See, again, there is no single right answer or wrong answer. Based on the factors, and for each parameter, you decide whether it is, the threat is high or low, and accordingly you have to bring an answer. So let's look at the solution. I'll give you more inputs on that. Threat of new entrants. While it is possible for small fashion designers to enter the market, new entrants face challenges in finding a sufficient number of retailers willing to sell their products, and the design must appeal to fashion conscious customers. So there is a threat. New entrants can come into the market, but then to establish in the market becomes difficult. There may be a greater threat from small fashion designers and manufacturers who are trying to grow their business rather than from entirely new entrants. So some part of that will definitely compete with us and take away our market share. Bargaining power of customers. Customers are either the end consumers or the department stores. The number of wholesale outlets has been falling, suggesting that department stores are switching to competitors, which may give department stores a reasonable amount of bargaining power. For own store sales and e-shopping, customers will only buy the company's good if they are attracted by the design, giving customers some bargaining power. So both the end consumer has a good amount of bargaining power because they have choices. They can switch to other competition. Same way, our department stores, the wholesalers, the distributors, what do you call, even they have a high bargaining power because they can switch. There is hardly any cost to switch to the newer segment. Bargaining power of suppliers. Suppliers are small manufacturing firms, so they may not have strong bargaining power, except that rising manufacturing costs mean they are demanding higher prices. See, this is a general negotiation, but they don't have great power because we are using small suppliers. We can switch suppliers easily. Threat of substitutes. There are probably no direct substitutes for fashion clothes, although the customers may be able to switch to cheaper fashion goods retailers. There is insufficient information to assess the strength of this force in the industry, definitely. But yes, if you ask me, as far as fashion is concerned, I can switch. We can switch. General tendency to see amongst the customers, they can switch from one supplier to another supplier, unless it is like some great celebrities and all who will buy only a specific designer's cloth. Okay, other than that, switching is easy. Rivalry among existing competition between fashion goods producers seem to be strong, although the intensity may vary between different parts of the world. In Mumbai, the main competition comes from ZenZ, Caterpillar, and BTech. They may compete as much on the fashion design as on the price. It seems probable that competition between firms keep prices lower than they might otherwise be. So they get a generic answer. Yes, there are many competition. The competition can take away your customers. Customers have a power to choose, and there is a lot of competition on the pricing side. So the rivalry amongst the competition is here. Okay. Then lastly, evaluate the supply chain of Becky Bond, identifying its current weakness and suggesting ways to overcome them. Now, what do you mean by supply chain? See, when we say supply chain, from our suppliers, that is our manufacturers, it comes to the distribution center. From this distribution center, it goes to another sub distribution center. And then from there, it goes to the departmental stores or our own stores. Okay, this is the supply chain. Okay, now where are these suppliers located? They are located in Nagpur and Thane. Okay, and it has a small one of its own, own supply, own manufacturing unit as well. Then the suppliers manufacturers are small, but they are many in number. Now, if there are many in number, coordination becomes difficult to get everything from all of these suppliers from as far as Nagpur. See, please understand. So here you need some knowledge of geography also. Nagpur is at the center of India. Mumbai is somewhere here. Pune is somewhere here. So from Nagpur, you move it all the way to Pune, and then you move it to Mumbai. So is it efficient? Transport so much. There's a transportation cost involved. Then just in time has not been greatly successful. That is one more challenge what they have mentioned, right? And they tried just in time, that's not successful. Lead time from the suppliers has been excessively higher. Okay, so these are some of the challenges that we can see as we read the question. Okay, then is it good to have manufacturing center in Mumbai? Of course, Mumbai has a higher cost, but then can we have a manufacturing setup here? So these are some of the business related decisions that you have to take and that you have to evaluate. Okay, so let us look at the supply chain. The main supply chain for Becky Bond is relatively short, starting with the producers of materials for fashion clothes, the manufacturers. These materials are purchased by businesses that manufacture the clothing for Becky Bond. The manufacturers are mainly small independent firms in Nagpur and Thane, although the company has its own small manufacturing subsidiary near Pune. The manufactured goods are transported to the company distribution center in Pune. Becky Bond buys and manufactures clothes that it has designed and distributes them to retailers directly from Pune. Retailers may be department stores or its own store. So this is the explanation of what is the supply chain. What is the supply chain of the company? There are some weaknesses in the supply chain. Most sales are in Mumbai, but most manufacturing is in Nagpur and Thane. So these are far away. Although these areas may be cheaper for manufacturing, cost of transporting the clothes to the distribution center in Pune may be high. There is no information about efficiency of the delivery system, but operating with two distribution centers may be inefficient and slow down the transfer of manufactured goods to the store. Its competitor ZenZ has a manufacturing center in Mumbai and a modern distribution system which gives ZenZ a strategic advantage because of lower transport cost and quicker distribution. Reliance on numerous small suppliers has led to longer lead times and recent disputes over price increases. The supply chain operates solely between Becky Bond and its manufacturers, putting the companies at a disadvantage. The just-in-time system has only been partially successful due to longer lead times from smaller manufacturers. Department stores' tendency to place supplementary order late in the season complicates inventory management. So what has happened? First, they are far off. Second, having two distribution centers may not be sufficient. Third, suppliers are taking more time, resulting in higher lead times. To overcome these supply chain weaknesses, Becky Bond can implement several strategies. Forming strategic partnership with key suppliers can ensure more consistent pricing and supply, possibly involving long-term contracts or volume commitments. So let's say, take key suppliers, form strategic partnership, have long-term commitment, reduce the number of suppliers. Reducing the number of suppliers to a manageable few who can offer better terms for larger orders can help negotiate lower prices and improve lead times. So instead of dealing with hundreds of small manufacturers, what the company can do is the company can talk to, let's say, important 20-30 manufacturers or 10 to 15 manufacturers saying that, okay, we have this requirement. You give us better pricing, you give us better lead times, we will increase the volume. Maintaining a inventory buffer for fast moving items can quickly fulfill supplementary orders from departmental stores without significant delays. So, if some items are fast moving, you can have inventory buffer for that. Streamlining operations to reduce cost, possibly by consolidating manufacturing process and improving logistics, will be beneficial. Invest in technology to enhance supply chain visibility and efficiency. So here again, these are all generic answers. You can pick up 3 or 4 of these and present in your final answer, if at all you get a question. So this is the end of case study number 4. We'll take up the next case study in the next class. Let's now have a look at the next case study. This is case study number 7. This is on the Connect Group, one of India's largest conglomerates, was founded by Ramlal Jain in 1966. Initially starting as a small textile company named Connect Commercial Corporation, it rapidly expanded its operation into diverse sectors such as petrochemicals, refining, oil, telecommunication, retail, and infrastructure. Now, though it's a case study, if you see, started as a textile company, then gradually moved to petrochemicals, refining, oil, telecommunication, retail, infrastructure. This is your Reliance Industry Limited. The business is of Reliance Industry Limited. So one thing what you have to keep in mind is, for a lot of these industries, if you have time, you should read a bit about the industry so that if a question comes in the examination, you are able to capture the essence. Okay, so that is about the company. Now, let us quickly jump into the questions and then we'll come back to what is the relevant part for us. First one is, with reference to the case, which term best describes Exe's strategy of using aggressive pricing? So they have given us multiple strategies. We have to see. This is from strategy cost management. To gain competitive advantage, which approaches were most likely followed by CI? CI acquired DigiCable, which, so basically you have to see with whether it is horizontal, backward, forward. Then this is your AFM related question. Considering the financial distress faced by Connect India, which risk factors should auditors prioritize? This is for audit. Then this is on IBC. Okay, coming to descriptive. Using Porter's 5 forces framework. So in the previous case also we had a Porter's 5 forces framework. This is very important. Analyze how intense competition, competitive rivalry, and the high bargaining power of buyers in the telecommunication market contributed to the decline of CI. So this is talking about decline of CI. How? Because of competitive rivalry and high bargaining power of the buyers. Okay. Then valuation techniques, your AFM, and this is on your income tax. Okay. So coming back to the case, so we have to focus on the strategy and the Porter's 5 forces model. We have to try to fix the concept here. Ramlal Jain visionary leadership and innovative business strategy transformed the company into a significant player in the Indian economy. Following his passing in 2002, the group was divided between his sons, Vansh Jain and Suhan Jain. So this is your Anil Ambani and Mukesh Dhirubhai Ambani, leading to the formation of Connect Industries under Suhan Jain and Connect Group under Vansh Jain, each continuing to grow and diversify their respective business interests. Connect Group is among the India's top. So basically this, if you see, this has nothing to do with the question asked. So once you have scanned through it, just forget it and move to the next line. The Connect Group is among India's top private sector business houses, serving over 250 million customers across telecommunication, power, financial services, infrastructure, media, entertainment, and healthcare sector. They positively influence the life of 1 in every 5 aspiring Indians in more than 24,000 cities and towns and 4,20,000 villages. Again, nothing to do with the case. Connect Group strongly believes that it has a pivotal role to play in the shaping the destiny of the nation. So when you get a sequence of such kind of paragraphs, it is easy or it is better to ignore it itself, because again, this is about the group, nothing to do with the specific question. Then the vision is given to build a global enterprise and great future for the country, to give millions of talents the power to shape their destiny. One of the Connect Group company, Connect India Limited. So this is where the actual case starts. Okay, Connect India entered the Indian telecommunication landscape in 2002. Okay, so if all of you would be pretty young or maybe not born, some of you would have been just born at that point of time, there is a very good campaign by Reliance Industries at that point of time called Karlo Dunia Muthi Mein. Okay, so that was the one where they had revolutionized telecom at that point of time, and they again repeated that in 2016. Leveraging its substantial resources, CI embarked on an ambitious journey to revolutionize connectivity in India by rapidly expanding its network infrastructure and introducing both GSM and CDMA. Now, all of you would not be aware of these technologies. So earlier we used to have something called as GSM, which is SIM card based, CDMA, where the device itself, so a SIM card used to be attached to a particular device. Okay. CI aimed to bridge the digital divide and bring affordable communication solutions to every corner of the country. Positioned as a disruptor in the market, CI challenged the status quo of traditional landline communication, offering consumers a glimpse of the transformative power of mobile technology. Now, if you have not experienced this, this will appear to be something very new because you have been used to the SIM cards, eSIM, and all of those things. CI ascent to prominence was marked by its innovative marketing strategy, which centered around bundling GSM handsets with connected connections. So we used to have Reliance handset. I think it was 501 plan is what they used to call. This strategic move, so basically bundled GSM handset with the connection. The move was not merely about selling handset. It was a bold attempt to democratize access to mobile communication. By offering affordable handset bundle with telecom services, company effectively lowered the entry barrier for millions of potential subscribers. So it was, as I told you, as low as 501 rupees per month. This approach tapped into the aspirations of a burgeoning middle class eager to embrace modern communication technologies. As consumers flocked to avail themselves of these bundled offerings, the demand for traditional landline connections witnessed a precipitous decline. Basically, it's a decline, signaling a strong shift in the telecommunication landscape. CI's disruptive approach had a profound impact on its competitors in the telecommunication sector. So now, this basically is more about affordability for the customer. Traditional landline providers such as RWNL, you can call it BSNL, faced significant challenges as consumers increasingly opted for mobile offerings. The aggressive pricing, so here you can see aggressive pricing because they have asked us about the strategy. Innovative service packages introduced by CI forced competitors to rethink their strategies and offerings. In response, competitors had to lower their tariffs, improve service quality, and explore new revenue streams to remain competitive in the evolving market. CI faced intense competition from major telecom players like BTech, which is Airtel, M-Phone, I don't remember this one, IA Cellular, Idea. Despite their efforts, many competitors struggled to keep pace with CI's rapid expansion and innovation, leading to a reshuffling of market dynamics and heightened competition across the sector. So this was what towards 2002, much before 3G and all came into picture. In 2010 Spectrum auction, CI secured 3G licenses for 3 cities with a licensing fee of 57 million. By leveraging MIMO technology in 2011, CI improved the quality of its 3G services, achieving data rates up to 20 Mbps. In 2013, CI signed a multi-year managed services agreement with Startel to manage services of wireline and wireless network of 120,000 km of fiber and mobile infrastructure in 11 telecom circles in India. So India, you have telecom circles, like, state-wise, you have like, for example, you have Maharashtra circle, Maharashtra and Goa is one circle. Then you have, let us say, the Gujarat circle. Then you have Andhra Telangana circle, Karnataka circle. This arrangement was a smoothened business relationship until 2016, post which CI struggled to pay the dues. This has been the effect of Connect XG that disrupted the Indian telecom industry with its aggressive pricing after commercial launch in September 16 that affected all leading telecom players. Now, who is this Connect XG? This Connect XG is your Jio. Okay, so when Jio was launched, it actually impacted this business. So here it is talking about what? Here it is talking about they got 3G licenses. They tied up with a company called Startel. Here it is about the competitors. By 2016, the company discontinued its CDMA operations, migrating subscribers to GSM and LTE network. LTE is long-term evolution. The same year, CI acquired DigiCable, India's largest cable network, integrating it into a new entity, Connect Digicom, to bolster DTH, IPTV, and broadband services. Additionally, CI acquired Systems Sure Teleservices Limited, gaining SSCL spectrum in the 850 MHz brand and its subscriber base. Nothing was to do with the case. In September 2016, CI announced a merger with FreeCell, So this was free cell. I think this is Aircel, which was expected to help repay 250 billion of debt despite approval from the regulatory bodies. The deal fell through in October 17 due to delays and competitive pressures. The failed merger exacerbated CI's financial distress, leading to the redundancy of employees and discontinuation of voice services in 2017. Now, after Jio was launched, a lot of telecom companies had actually gone off. Now you have only Airtel, Vodafone Idea, and BSNL and Jio. CI's financial problems worsened when it could not pay Startel under a managed services agreement. Startel took the issue to the NCLT to recover 12 billion, which led to insolvency proceedings. Even though a settlement was reached, CI failed to comply, resulting in the contempt of court proceedings. Suhan Jain intervened with a bailout financial aid to prevent legal consequences. So this actually has happened. Mukesh Ambani bailed out Anil Ambani, highlighting the importance of strategic crisis. Management. Auditors were concerned about the risk of fraudulent reporting at CI because of its financial troubles. The company's struggle to meet financial obligations might have led to a temptation to manipulate financial statements to look better. Now again, this is related to your audit part. Despite its promising start, CI journey was fraught with challenges that ultimately led to its decline. Now, this is where there is a question on decline. So this is very important. Intense competition from both established players and disruptive entrants. Who was the entrant here? Jio. Coupled with rapid technological advancement, we have 4G, now we already have 5G. Eroded CI's market share and profitability. Additionally, the company grappled with a substantial debt burden. So because of that, there is a problem incurred during its expansion. Efforts to alleviate means reduce financial pressures through strategic partnerships and merger attempts were thwarted by regulatory hurdles and internal disagreements. In May 2019, CI succumbed to its financial woes, filing for bankruptcy under IBC. So this is about bankruptcy. Okay. And here is what happened after the bankruptcy. In the previous year 23-24, Connect XG, the new company, transferred part of the spectrum for a consideration of 300 crores when 17 years of spectrum period were still remaining. This marked a sobering end to a once promising venture and underscored the volatile and complex nature of the telecommunication industry, where innovation and disruption often come hand in hand with uncertainty and risk. By 2020, a consortium group of companies bid over 250 million for CI's asset. Ultimately, Suhan Jain Connect XG acquired these assets for 3,700 crores in 2021. This acquisition was part of XG's broader strategy to consolidate its market position and expand its telecom infrastructure. As a part of this expansion, Connect XG acquired right to use spectrum for high-frequency bands on 1st of April by making an upfront payment of 1,000 crores. The spectrum was valid for a period of 20 years. In the previous year, the Connect XG transferred part of the spectrum for a consideration of 300 crores when 17 years of the spectrum period were still remaining. After the spectrum was sold, there was news in the industry that Moonlink Telecom was interested in buying the spectrum sold for a whopping amount of 900 crores. However, Moonlink Telecom was embroiled in a legal battle with the government over a disputed amount of 2,000 crores, complicating their potential acquisition. So this is also, if you say, nothing much to do with the case in hand, right? Now, read the case. This case is about telecom industry. In this telecom industry, you can relate this with the Reliance Industries and Reliance Communication Group, that is Mukesh Ambani and Anil Dhirubhai Ambani Group, right? So they came as disruptor. Connect came as disruptor. Initially, CI, that is the name of the company. They disrupted the market. Then over a period of time, they entered into some agreement. They were not able to pay the debt. Then Connect XG came into picture. That disrupted the market further. These players, that is the earlier group, they were not able to cope up with the changing environment, not able to pay debt, and hence it was wound up. That is the crux of the case. Now, what is the first question? With reference to the case, which term best describes Connect XG? Connect XG is a new company. Strategy of using aggressive pricing to enter the telecom market and target the lowest market segment. Additionally, CI's initial strategy to offer GSM handset bundled with their telecom services was an example of which strategy. Now, there are two strategies. One is Connect XG strategy. Now, Connect XG strategy is about what? They have offered at lower price. Then we have the other strategy of CI, the earlier company, where they were bundling the handset. Means you take the telecom service and you bundle the handset with it. So if you see, if you want, typically this is still prevalent in foreign countries. If the phones are costlier, you take a service provider service. You pay a monthly fee and the phone becomes yours over a period of time. Now, what are the options? XG strategy, that is the first companies. New market disruption, CI strategy, low end disruption. Now, what is disruption? This is covered in your chapter number 5. Okay, where you learn about two types of disruption. One is the low end disruption. That is what you provide everything at a cheaper price, and you do that to access the lower segment or lowest segment of the existing market. That is low end disruption. New market disruption is when a new entrant expands the market. Basically, you are expanding your market and acquiring new customers. So the difference is, in a low end distribution, you're disrupting. So the difference is, in a low end disruption, you're disrupting the existing market, and in a new market disruption, you're disrupting a new market, not existing market. Now, exit strategy, are they entering into new market? No. What they're saying is, existing mobile phone users they're trying to attract. So it cannot be a new market disruption. They are using a low strategy, so it has to be low end disruption. CI strategy was new. People were using landline. Now you are asking them to use mobile phone. So they are doing a new market disruption. So first option is not correct. Second option, market penetration. No, it is not right. You are not acquiring more of the existing market. You are entering into the market. You are disrupting the market. Low end disruption for XG, new market disruption for CI. This is the correct answer. To gain competitive advantage, which approaches were most likely followed by CI? So we are talking about CI, right? What are they following? It improved the quality and speed. Yes, so because they wanted to gain competitive advantage and they used some new technologies to gain market share when 3G was launched. So to improve the quality and speed, yes, it focused on enhancing only their call quality. No, they were also looking at internet. Okay, it is not only about call quality, it is also about internet. It acquired additional spectrum. Yes, it did acquire, and of course, subscribers. It started value package, including reduced cost of basic services. This is not been given in the question. So, correct option would be A and C. So, this is not rightly done. You have to read it as 1, 2, 3, and 4. So, 1 and 3 is the correct answer. Option number B. CI acquired DigiCable, India's largest cable network, integrating it into a new entity, Connect Digicom, to bolster its DTH, IPTV, and broadband services. This is the most likely example of which type of integration. Now here, what have they done? They have acquired DigiCable, largest cable network, integrating into a new entity, Connect Digicom, to bolster DTH TV, IPTV, and broadband service. Means already they are into this market, they want to bolster it. Okay, so here, if you see, whether it is horizontal, whether it is backward, forward, diversification. Now, it is not diversifying because they are still in the same industry. That is the first thing. Is it backward or forward? I don't take services from telecom operator. I don't give services to broadband operator. So here, it is not in the same supply chain, but they are at the same level. They are also providing broadband services. CI is also providing broadband services. So most likely case is where you are doing a horizontal integration at the same level. Yes, there can be a thing that it can be talked about in diversification, but it is not in the diversification in sense of supply chain. You are not acquiring a completely, or you are not acquiring a completely different entity where you can say it is a diversification. Here, this term bolster makes stronger the existing product offering. So horizontal integration is the correct answer. Then, using Porter's 5 forces framework, analyze how intense competition, rivalry, and the high bargaining power of the buyer in the telecommunication market contributed to decline of CI. Now, what happened? There are two things. One, there is a lot of competition in the industry. Now, where did the competition come from? Competition came from various existing players. Okay, so the company name they gave, like some tel was there. Then IA Cellular was there. Those were the competition which were there in the market and which has given severe competition to the industry, to the existing companies. Okay, so that is one thing. Then what all led to the intense competitive rivalry? The new company Connect XG that entered into the market. So that also added to the existing competitive rivalry. And because it is a hyper price sensitive market, okay, the competition became cutthroat. In fact, we know how Jio gave services for free. So because of that, the competition actually increased in the market, right? So that resulted in price cuts, continuous price cuts, and because of which the company was not able to survive. That is the first thing. Then high bargaining power of the buyers. Now, why does buyer have a high bargaining power? Buyer has a high bargaining power because the customer can easily switch from one telecom provider to another telecom provider. Especially with the mobile number portability, they can easily move from one service provider to another service provider. Okay, so there is you cannot stop the customers to move to another service provider. That is why they have a higher bargaining power. Wherever you find the cheapest thing, you will go and you will take that connection, right? That is how it is. Of course, the network quality and all of those matter, but price also matters. So because of that, customers started moving to other players which provided cheaper pricing, and they also started moving to other players where they were getting better network, better experiences and all of that, because of which the company faced a downfall. Okay, so let us see the suggested numbers, answers. So here, for competitive rivalry in the industry, intensity of competitive rivalry within the telecom industry was high. So you have to say what kind of rivalry was there. Driven by several key factors, market competition was fierce, with CI facing significant challenges from major players like Detail, M-Phone, ISL. So this information we'll get from the case. The competition intensified further with the entry of Connect XG in 2016, whose aggressive pricing and free services disrupted the market dynamics. This led to widespread price wars, compelling companies, including CI, to drastically lower tariffs to retain their market share, consequently reducing profit margin across the industry. Additionally, rapid advancement in technology such as shift from CDMA to GSM and 4G required continuous investment in infrastructure. So basically, all of these factors led to a very difficult situation in the industry for the entire telecom industry. Then, threat of new entrants. Threat of new entrants in the telecom industry was then they have explained about threat of new entrants. Now, threat of new entrant is not asking the question. You can just read through it to understand. Now, here what happened? New entrant by way of Connect XG, they entered into the market. Because they entered into the market, it became very difficult for them. Bargaining power of supplier. Again, here, this is not asked in the question, so you need not write in the answer. But it's still, you can have a look at it, that what is the bargaining power of supplier. Now, here, one of the major supplier is government. Okay, government provides license. Government provide license for those specific band where we have this spectrum licensing. So government, government can dictate terms. And in the entire telecom industry, what also happened is because of the government, charging those spectrum charges, and they wanted the revenue, the way the revenue used to be computed, AGR dues, if you can read about it. Because of this AGR dues, a lot of companies, especially Vodafone and all, they are having a very, very tough time. Okay. So that is one thing. Buyers. Bargaining power of buyers in the Indian telecom market was high. Now this, how will you get to know? This you will get to know with the industry knowledge. This is not directly given to you in the case study. So you have to apply your mind saying that yes, in the industry, in the telecom industry, the bargaining power of the customer is high. Consumers had numerous options due to the intense competition among telecom providers, allowing them to easily switch providers for better pricing or service quality. As I told you, even if you are there, you will switch it easily. Whenever you want, you will switch to a new service provider. The market was highly price sensitive, with customers favoring low cost option, which pressured telecom providers to offer competitive pricing, often at the expense of their margin. Additionally, with multiple providers offering similar services, service quality became a critical differentiation factor. Consequently, CI had to continuously improve its service quality and customer experience to retain the subscriber base. Now tell me, have they specifically given this in the case study? They have not given this in the case study, which means you need to have some type of industry knowledge, some kind of industry knowledge if you are answering the questions in the examination. Okay? Because in the question, they have nowhere mentioned about service quality. Okay, they have given it in the answer, but they have not mentioned about service quality in the question itself directly, right? In conclusion, the high bargaining power of buyers in the Indian telecom market forced providers to prioritize competitive pricing and superior service quality to maintain customer loyalty. Again, threat of substitutes. Now, threat of substitute means you can, as a telecom service provider, you have multiple vendors providing you, but then you will not replace the telecom services with another service. But yes, with more internet and all coming into picture, the threat of the threat of substitute also there. So you have other communication methods such as internet-based services. You have WhatsApp calling. You have, you can have a lot of VoIP these days. Using internet, you can call. It posed a significant threat as increasing internet penetration made these services more viable alternatives to traditional telecom offerings. Additionally, technological convergence of various platforms, including the internet, mobile telephony, and OTT services, broadened the competitive landscape for traditional telecom services. So, more and more services can be provided. This convergence forced telecom companies to continuously innovate and adapt to remain relevant. Now, what is the meaning of this? If you carefully observe, OTT apps came into picture. Now you have Airtel broadband, Extreme Fiber. You have Jio Cinemas. Okay. So all the telecom providers, they had to switch. OTT started evolving. Now telecom providers also need to provide OTT services, right? So that is what they're saying. So if you don't provide me OTT services, I'll go to Jio, which is giving me everything for free. Of course, now they've started charging something like premium 29 rupees, 39 rupees. But then I will move to other service providers. While the threat from substitute was moderate, the ongoing technological convergence and rising popularity of internet-based communication necessitate persistent innovation from traditional telecom providers. Again, not asked specifically in the question. It is more for understanding that these telecom providers had to evolve into being a multi-product companies offering different types of services. Right? And then this is the conclusion. The 5 force analysis highlights a highly competitive and dynamic environment. CI's decline could be attributed to several key factors: intense competition, threats from new entrants, high bargaining power of buyers. All the bargaining power of suppliers remain relatively low. The rising threat of substitutes from digital communication technology further pressured traditional telecom business models. CI's inability to effectively navigate these competitive forces, combined with strategic missteps and financial mismanagement, ultimately led to its downfall. Right. So this is what you can summarize and write in the examination. So it is very important for all of us to be aware of industries which are being tested, at least in this case study digest. If they give the same case study or similar case study, it is very good. Otherwise, having industry knowledge, especially looking at the latest case study digest, becomes more important. Let's now have a look at case study number 11. So this is about a pharmaceutical company that has multiple divisions. Again, like every time, let us quickly have a look at the question. First, by following total cost-based pricing plus markup for products, what are the disadvantages of this policy for VQ Limited? Now tell me one thing, is this related to the question or the case study? They're simply asking us, if we follow total cost-based pricing plus markup, what is the disadvantage? So we just have to identify the disadvantage of the total cost-based pricing model. It is a direct question and not an MCQ, not a case study based or case study linked question. So this is one thing smartly you have to learn that, okay, some questions may be direct. I don't need to break my head on the case study. If I know the concept, I will be able to answer that, right? So what are the options here? First, so basically what they're saying, total cost based pricing plus markup. So if my cost is, let us say 100, I want, let us say 20% profit. So 20 is my profit. Selling price becomes 120. Now, what is the disadvantage? First, it does not consider if the customer is willing to pay the price arrived at based on the total cost. Now, cost-based pricing or cost-plus pricing, do I consider what the customer will pay? I'm not considering that. What am I doing? What can I charge? What is my cost? What is my profit? What can I charge? That is what I'm looking at. So, this is definitely one of the disadvantages. Then, requires budgeting of production output volume to determine the allocation of overhead. This may not always be accurate. Of course, if I'm doing cost-based pricing, there are some fixed overhead which I have to estimate for the entire year. I have to estimate the output for the year, and based on that, I have to do the allocation. So that becomes a challenging task, right? So here we use predetermined overhead recovery rate. That becomes a challenge. This is also correct answer. Surplus generated from sales cannot completely cover the replacement cost of fixed asset in an inflationary economic condition. Now, what does this mean? This basically means that when I'm charging, let us say, depreciation as my cost,
to recover the cost from the particular sale. But let us say my cost of the machine currently is 1,000. Based on this 1,000, I'm charging depreciation. After 5 years, if I have to replace, this cost will become 1,500. So the surplus that I'm generating or the cost that I'm recovering will not be able to meet my future expected cost of replacement. So that is also disadvantage. Third is also correct. Fourth, pricing using this method is difficult to arrive at due to lack of information. Now, this is not correct because information is available. You know the cost, you know your profit margin, information is available. So this is not right. So what is correct? 1, 2, and 3. Option B is the correct answer. Simple, straightforward. I didn't even, or you didn't even have to look at the case study to get the answer. Then, with reference to the information provided in the case study about the medical representative team requesting doctors not to reveal the side effects of a drug in order to boost sales, as a senior professional accountant in service, what action will be appropriate in this situation? Now, what is this? There are some side effects of the drugs. The medical representative or the sales representative, they're saying that you don't disclose, the doctors, they're saying, you don't please disclose what are the side effects. Now, is it ethical? It is not ethical. So basically, you have to apply your ethical principles. Okay. Now, if you look at the options here, ignore the information since it does not directly relate to your area of oversight as a management accountant. I am in service. I know something incorrect is happening. So can I ignore it? Should I ignore it? Answer is no. So this is no. Ignore the information since you're not receiving the kickback personally, and therefore you are not doing anything unethical. Means kickback means the bribe thing. Okay, kickback is basically something in return. You call it as quid pro quo, kickback, bribe. So you're not getting anything. So should I keep quiet? No, you should not keep quiet. Then actions of the MR team affect public health, which requires you as a senior professional accountant, here basically you're a CA, in service to respond appropriately as per ICI Code of Ethics. Of course, I should respond appropriately as per ICI Code of Ethics. What kind of MCQ is this? With this kind of MCQ, you can easily score marks in the examination. So C is the correct answer. Ignore the information. Since the company does not follow its own code of ethics that it has drafted, hence there is no obligation on you to do so. So this is also incorrect. See, ethical related questions, if they ask you in the examination, simple, straightforward, and you can do it, right? So here option C is the right answer. Second question we have been able to do without looking at the case study. Then, pharmaceutical companies like VCure operate in oligopolistic market condition. Oligopolistic means some small number of firms, but they are large enough in the market to determine or dictate pricing. Okay, so you have monopoly 1 firm, duopoly 2 firms, oligopoly means let us say 4 firms or 5 firms which have intense competition in the market. Like its competitors, VCure Limited follows non-price strategy to market its product over a pricing strategy because now here they are following which non-price strategy, means they are not following price cuts. They are not following price cuts. They are using other strategies. Now, for this, maybe we need some more information from the case study. Then, Division A and Division B of VCure Limited operate under different managers who are assessed based on the financial performance of their respective division. So, Division A, Division B, they operate under different managers. So, you have some manager here, some more manager here. Which McKinsey's 7S elements does this most closely relate to? So now we have 7 elements. Somebody is reporting to one manager, another division is reporting to another manager. Profitability is being assessed. What will be the most likely or most closely related element? So we have hard elements, we have soft elements, and all of that. First, strategy. You are saying division A, division B. You are seeing how the reporting relationship are established. So it is not strategy. Structure. It is a structure. It is a part of your organizational structure. Is it a part of systems? No, it is not a part of shared values as well. Okay, so here if you see again this question, directly by looking at the question, we got the answer. Then VCure Limited has undertaken a core competency analysis to find out how it can improve its value chain. In the oligopolistic condition, the company wants to follow product differentiation strategy. Which of the following parameter is not a test for core competency? Again, direct. If you have learned strategic management properly at your C intermediate level or strategic cost management, if you have done the lessons properly, we are talking about core competency and we want differentiation strategy. And they're saying which of the following parameter is not a test of differentiation. Now, when it comes to differentiation, you have multiple. When it comes to differentiation, you have multiple parameters to look at. First, cost advantage. Now, when I'm talking about differentiation, cost advantage does not come into picture. My core competency, it should be difficult in imitation. If I'm producing a different product, it should be difficult. Relevance to the customer. All my core competencies must be relevant to the customers, and breadth of application in terms of potential market it can open up. So I must be able to apply it across different product portfolios. I must be able to apply it across different markets. So is cost advantage not a core competency? It is also a part of core competency when you have to test. But when we are saying product differentiation, cost advantage becomes irrelevant. These three becomes relevant, this becomes irrelevant, and hence this is the correct answer. Okay, see, 4 questions we could answer even without looking at the case study. Now, if you look at the testing of core competencies, if you look at the study material, you can see that relevance, difficulty in imitation, breadth of application, these are the core areas which will result in core competency. If you have a cost advantage, that also can be a core competency. Okay, for example, if you can offer product at a very low price, that also can be core competency. But because here we are talking about differentiation strategy, this is not the part which will help us in gaining the core competency. The remaining will help us. So A is the correct answer. Right. Now, moving on, let us look at the theoretical question. As a management accountant, please analyze the scenario with respect to the interdepartment transfer from Division A to Division B for the following. Calculate the internal transfer price based on full cost plus 1% markup. Pros and cons of the current transfer pricing methodology. And should the management permit Division B to procure the chemical from the external vendor? So this is about transfer pricing, and it is also about should we make or should we buy? So this by looking at the facts we can answer. Recommend the accounting treatment of the events for the year ending 31st March 23 and 24, and calculate the value of equipment at the end of 23 and 24. A simple, I think, direct question based on your Ind AS. Okay, so that is what we have to look at. So let's look at the case study now. BTech Limited is a pharmaceutical company that has many divisions. One of its division A, produces chemical vials that can be used for storage of medicine. So these vials are basically your bottles kind of thing. Okay. These chemical vials are both internal and external markets. So they can transfer internally and they can transfer externally as well. This Division B is another department of the same company, uses these vials to package some of the medicine that it produces. Following is the information. Annual capacity 30,000. Actual annual production, 30 lakhs, 25 lakhs, internal transfer to B, 10 lakhs, annual external sales, 15 lakhs. So basically, this is the capacity and we are producing less than the capacity. Division A incurs variable cost of production of 900. This is the variable cost. Fixed cost of production of 50 crore per year. Out of this, 15 crore per year is on account of machinery and production infrastructure to be maintained for the internal sales to Division B. This has been procured to produce vials exactly as per the specification of Division B. So there is a specific cost of 15 crore. Okay, so for that, your machinery, infrastructure and all of that, specifically for Division B. As per the company's current procurement policy, since Division A is operating at less than full capacity, Division B has to purchase the entire annual requirement from A. Division A charges Division B at full cost plus 1% markup as its transfer price. This is in tune with the company's overall transfer pricing policy that is used for interdepartmental transfer. Performance assessment of each department manager gives emphasis on the overall financial performance of the department. So performance of the manager depends on the financial performance of the department. Sale price of medicine manufactured by BTech Limited follows total cost plus markup pricing method. We have already discussed that. BTech Limited estimates total production and total cost for a few months before the start of the financial year and determines the sales price. Recently, the manager of Division B has received a proposal from an external vendor where chemical vials can be procured at 1,050 per vial. The product specification would be suitable for the requirements of Division B, and hence they are comparable with the customized production that Division A makes. So there is an external offer. The manager of Division B would like to purchase vials from the external vendor. Now we have to decide whether we should go ahead and buy from the external vendor or not. BTech closes the book on 31st March of each year. Primary assets of Division A comprises of an equipment that is used to make chemical vials. BTech had purchased the equipment on April 1, 2020 for 6 crores. Useful life is 10 crores. On 31st March, the company classified the equipment as held for sale. So Ind AS 105 comes into picture. The impairment testing provides an estimated recoverable amount of 4 crores. The fair value less cost to sell on March 31st March 23 was 3.5 crores. On March 31st, 24, the management changed its plan to sell the equipment, so it no longer met the criteria as held for sale. Recoverable amount as at March 31st, 24 is 4.5 crores. So basically, a 6 crore machine, then we have to depreciate, and then at what is the classification date? On 31st March, they classified this equipment as held for sale, and they got a recoverable amount of 4 crores. Fair value less cost to sell on 31st March 23 was 3.5 crores. Now, based on this, we have to see how much has to be written off from this machinery, and subsequently, when they reclassify it back to normal machinery, what has to be done. You are the CFO at VCure. The sales team comprising of medical representative has been given a target to grow sales by 10%. Pharmaceutical companies like VCure operate under oligopolistic market condition. These companies, including VCure, use sales promotion, that is, use of incentives to encourage patronage like free samples, free trials, loyalty programs as a part of its marketing strategy. The question mentioned that they use non-pricing. So it is not only about price cut, it is about other marketing strategies. During the course of your surveys, you come across certain financial and non-financial inducement kickbacks given by few of MR to doctors who would prescribe a particular drug developed by the company. Okay, so this we have already answered looking at this context. VCare Limited has undertaken a core competency analysis to find out how it can improve its value chain. In the oligopolistic condition, company wants to follow product differentiation strategy. So see, this type of case, if it comes in the examination, it is actually a very, very easy way to score good marks in this particular paper. Okay, now we are left with which question? We were left with this question number 3. Pharmaceutical companies operate under oligopolistic market like its competitor. They follow non-price strategy to market its product over a pricing strategy. Because why are they doing it? First, pricing information is not easily available as there are many players. There are not many players in the market. There are few players in the market. So this is not right. A non-price strategy cannot be easily tracked by rivals and thereby gives the firm a competitive edge. If you are going and doing some non-price strategy, giving some loyalty programs, giving some freebies and all, will the other companies not know? They will also know, because it is a market which has few suppliers. So this is also not right. Pricing strategy lead to price wars which hurt long-term profitability. Now, in oligopoly structure, especially if you see telecom now is with very less players. But when we had 5-6 players or 6-7 players, there price wars. If you follow only a pricing strategy, you have to do continuous price cut. When you do continuous price cuts, you run into losses. You will not be able to survive. So that is why they avoid. So for oligopoly market, this is a true thing where company follow non-price based strategy. Following a non-price strategy is more cost effective compared to pricing strategy. We don't have enough information to judge this. In fact, for non-price strategy also, you have to give a lot of incentives, doctor commissions and all of that. So more likely, this is the correct answer, right? Now moving on to the descriptive question. As a management accountant, please analyze the scenario with respect to the interdepartmental transfer from Division A to Division B for the following. Calculate the internal transfer price based on full cost plus 1% markup. So what will be the transfer price? In that, what we will take? We will take variable cost plus fixed cost. Now in fixed cost, there are two types of fixed cost. One is general fixed cost. One is fixed cost specific to Division B. See, there is a specific cost which they are incurring to cater the requirements of Division B. So that you have to split, you have to recover it only from Division B. General, you will recover from everything. So if you see how much is the cost, variable cost is 900. Fixed cost of production of Division A is 40 crore per year. Out of this, 15 crore per year is on account of machinery and production infrastructure to be maintained for internal sales to Division B. So 15 we will have to recover from Division B only. And the balance is for the entire production, that is external as well as internal. So what you have to do is 2 out of 40 crore, you will split into 2 parts. One is 25 crores and one is 15 crores. This 25 crores you will split or you will divide by the annual production of 25 lakhs. So 25 crores divided by 25 lakhs. How much will we get? 25 crores divided by 25 lakhs, we will get 100. And this 15 crores you will divide by 10 lakhs. 15 crores, so 15 crores if you divide by 10 lakhs, you will get 15 crores is 1500 divided by 10, you will get 150. So 100 is general for everybody, 150 is specific for this 10 lakh units.
So variable cost 900 plus general fixed cost 100. How did we get this? This is 25 crores divided by 25 lakhs. Then 150 of specific fixed cost, that is 15 crores divided by 15 lakhs. So how much we get? 900 plus 100,000, 1150 plus 1% margin is 11.5. So the amount to be charged is 1161.5. Let us see. Yes, 1161.5. Second, discuss the pros and cons of the current transfer pricing. See, when you follow a cost plus profit transfer pricing strategy, what happens? For the transferring department, they will recover their cost. They will also show profit. They don't have incentive. They don't have incentive to reduce cost. They don't have incentive to do full capacity utilization. See, with the given fixed cost, they could have maybe increased their production as well, but they're happy because they're able to recover their cost because they're following cost plus markup. The department A, the division A will always show a profit. Okay, that is what is the challenge. Whereas for division B, it becomes a disincentive. If division A is incurring higher cost, for division B, they are absorbing that cost. Maybe their performance is being impacted. Same material, if they allow us to procure from outside, maybe we will have a better opportunity or better option to procure those products. So let us see. Charging based on full cost allows the supplying division to recover entire cost. Supplying division has an incentive to cater to internal sales since the 1% markup will reflect in the profit. Financial performance is considered during performance assessment. The markup on internal sales will also be perceived as a means of earning profit that can bolster department performance. Good for division A. Problem: entire cost incurred by division A to be absorbed by the total units produced by A. Division A can recoup the entire cost plus 1% markup. Thus, the financial performance will always reflect a profit. However inefficient I am, still I will be showing profit. Division A is not working at full capacity, currently operating at 83% only. The total annual cost of production is 265 crores per year, comprising of variable cost and fixed cost. Out of the fixed cost specific to division B is 15 crores, which is absorbed by the production of vials for division B alone. So what does this mean? This basically means that even if I'm inefficient, even if if there is an opportunity to save cost, I may not be looking at saving cost because division B is absorbing the entire cost if I'm the manager of division A. The fixed cost of 40 crore per year would partially include costs related to idle capacity. Means the machinery not being fully utilized. We are not working at full capacity. However, this cost being passed on to both division B and the external customers, division A is not taking any step to lower the fixed cost since it is able to pass on the cost. See, we cannot say it is not taking. We can say division A may not want to reduce the cost. Therefore, there will be no attempt by division A to keep the cost at an optimal level. So basically what we're saying, cost cutting will not happen. Consideration of producing in-house versus outsourcing of procurement of chemical vials for division B. This is the third question. Now here, there is an external vendor offering at 1050, while division A is charging 1161.5. Now, should division B buy from outside? First consideration what you have to do is, you have to see the impact of variable cost. Variable cost is 900. This 1050 is greater than 900. Now, the next question you should ask is, if we procure from division A, if we procure from outsider, not division A, sorry. If we procure from outsiders, then what will happen to the surplus capacity of 15 lakhs that is being produced? First thing. Second, 10 lakhs it is. 10 lakhs, not 15 lakhs. So what will happen to the 10 lakh unit of surplus capacity? Can we use it elsewhere? That is the first thing. Second, fixed cost. Will I be able to save something on the fixed cost? That is how we'll decide whether we have to buy or whether we have to produce in-house. Just by directly comparing 1161 and 1050, we may not be able to get to the right answer. On a long-term basis also, if I am procuring it at 1050, will I be able to reduce my fixed cost? Will I be able to utilize the capacity somewhere else? That question needs to be answered. Overall, for 10 lakh vials per year, Division A pays 11.5 crore extra just to have the vials produced internally by Division A. Okay. Keeping the long-run business interest in mind, management of VQ Limited should direct Division A to find ways of optimizing its cost and making it cost competitive with external market. Of course, if from outside, if I'm getting something at 1050 versus in-house I'm paying 1161, we have to see whether there are ways to get to reduce the cost. Now, if you see the total cost fixed and variable, it is coming to 1150. The external party is still giving us at a lesser price at 1050. Now, if I'm able to save this fixed cost, part of it, if I'm buying it from outsider, then definitely we should compare how much will be the cost saving and accordingly decide whether we should buy it from outsider or keep it in-house. If there is no expectation that the idle capacity would be utilized in the long run, Division A has to scale down its operation to only that much capacity that can be utilized optimally. So, if we can avoid this fixed cost over a longer term period, then we should reduce our capacity and buy from external vendor because we are getting it at a lower price. Management of VQ Limited can even think of outsourcing the procurement of vials to external vendors. While reevaluating the transfer price with respect to the external market price, company should also adjust the price for costs that are not typically incurred for internal sales. Adjustments may be required for a variety of costs that may be incurred at a much lower price for internal sales. For example, packaging cost, storage and transport cost, administrative cost, no selling and distribution cost, etc. So basically what we're trying to say here is, if I'm selling only internally, the company does not incur all of this cost. And still we are charging 1150 plus 1%. The outside vendor, by incurring all of this cost, is able to give it to us at 1050. So then our cost structure may not be the optimum cost structure. We have to relook at it. Adjustment should also be made to give the effect to the estimated profit margin the external vendor earns from a sale of vial at 1050. Given this adjustment, transfer pricing should be made competitive as compared to the external market. So basically what I'm trying to say here is, while we're evaluating external vendor, see that he's giving to us at 1050, our pricing should be much lesser than that because we are doing it on a cost plus 1% basis and there are no additional cost, transportation, packaging, marketing and all of these costs are not being incurred. So ask Division A to reduce the cost or make it competitive, make it maybe market price based transfer pricing. So Division A automatically has to reduce the cost. If Division A is able to achieve cost reduction and make it competitive, the management may continue its current policy of internal procurement. Otherwise, it will be better to outsource for the procurement for Division B. Okay. So this is the concept where we see whether we should manufacture in-house or whether we should buy from outsiders. Then last one. The primary asset of Division A comprises of an equipment which is purchased in April 2020 for 6 crores. So cost is 6 crores. You can ignore 3 zeros or 2 zeros as per your comfort levels. Useful life of the equipment is 10 years. On 31st March, the company classified this equipment as held for sale. Impairment testing provides an estimated recoverable amount of 4 crores. So 31st March 23. So depreciation for 3 years. This has a useful life of 10 years. So depreciation for 3 years is 60 lakhs multiplied by 3, that is 1 crore 80 lakhs. So your carrying amount is 4 crores 20 lakhs. Recoverable amount on that date is 4 crores. So there is already an impairment loss of 20 lakhs. This is an impairment loss. So first, please understand, before taking something to Ind AS 105, we have to complete depreciation, impairment testing and all of that. This is an impairment loss as per Ind AS 36. The fair value less cost to sell on 31st March was 3 crore 50 lakhs. So fair value less cost to sell is 3 crores 50 lakhs. As per Ind AS 105, we'll value it at lower of carrying amount and fixed cost less cost to sell. Fair value less cost to sell. So 4 crores and 350, you will value it at 350. So loss to be booked is 50 lakhs. So there are two losses to be booked, one impairment 20 lakhs and this on classification of this asset as held for sale. On 31st March of 24, the management changed its plan to sell the equipment, so it no longer met the criteria as held for sale. Recoverable amount as on 31st March is 4 crore 50. Here we are saying it is 3 crore 50. Now, after 1 year, they are saying that the recoverable amount comes back to 4 crore 50 lakhs. Will we directly restate to 4 crore 50 lakhs? We will not do that. What we will say is, before this classification, what was the carrying amount? Then, with that carrying amount, we will see what is the depreciation that we should have charged. And from that depreciation, we should see, and after charging that depreciation, we should see what would have been the carrying amount. And that amount, and we will compare with the recoverable amount. We will not restate it at a higher value. We will not restate at a value which is greater than the carrying amount if the loss of impairment was not charged. Okay. Now, what was the carrying amount before the asset was classified as held for sale? It was 4 crores. This 4 crores has to be depreciated over 7 years. So, carrying amount is 4 crores minus depreciation per year is 7 years. So 4 crores divided by 7 years. 4, 1, 2, 1, 2 divided by 7 years. We get 571428 5 point something. So we can write say 5714286. So what is the carry? What would have been the carrying amount as on 31st March of 24? 4 crores minus 5714,286. We get 342,85714. So this would have been the amount. This 3 crores 42 lakh would have been the amount if the asset was not classified as held for sale. Now, because it was classified as held for sale, we brought it down to 350. Now we are saying the recoverable amount is 450. Can we write it back to 450? No, we cannot write it back to 450. We can write it back maximum to 342 only. So from 350, the value actually goes down to 342. The difference will be recognized in P&L. Now, some of you may have a doubt, sir, why are we comparing with 4 crores? Why are we not comparing with the carrying amount of 4 crores 20 lakhs before impairment? Here, we are not saying that impairment conditions are being reversed. Impairment conditions are not being reversed. Here, what we are saying, we are no longer classifying it as held for sale. So, when before classifying it as held for sale, what is the carrying amount? 4 crores. After classifying it as held for sale, it became 350. This 4 crores would have been 342 after the end of 1 year. Now, recoverable amount is 450, but we will restrict it to 342 only. Sir, what if there is a reversal of impairment? If they said reversal of impairment, then we would have compared with this 4 crores 20. Okay, so this is the answer for this question. Very simple question if you know the concept. So purchase price, depreciation, this is impairment, not fair valuation. We'll call it impairment. And 4 crores is the carrying amount. Then 4 crores is the carrying amount before classification as held for sale. Okay, don't think there is a reversal of impairment. Then depreciation based on 7 years useful life, this is the carrying amount. Recoverable amount is 450. We will not consider this. We will consider 342. So the difference, 350 minus 342, 714 will be charged to P&L. And now you will restate it back to 342. And for the remaining 6 years, you will charge depreciation based on 342. Let's have a look at the next case study. MNO is a renowned powerhouse in FMCG sector. So this is from the FMCG sector, known for its wide range of household products and robust distribution network across urban centers. So whenever you get something related to FMCG, you can remember of HUL or you can remember ITC, right? These are the prominent companies which you can refer to when it comes to FMCG sector. So let us see the question first, as we normally do. The EPS of both companies pre-merger, this is AFM. This is PQR wants to ensure earnings of the members are same as before. That's also part of AFM. Exchange ratio is also part of AFM. In the given case, the accounting acquirer And if the exchange ratio as decided in question 2 is considered, the amount of goodwill comes out to be how much? So now this is, you decide the exchange ratio here. Okay. And based on the exchange ratio, you have to decide how much will be the goodwill amount. Okay. That is what will be the calculation. Then the accounting acquirer and acquiree and legal acquirer and acquiree is which one? So this is generally happens if there is a reverse acquisition, we have to see who is the accounting acquirer. The CEOs of both companies have proposed an alternate method of measuring performance using residual income. The residual income of divisions MNO and PQR of the merged company will be how much? You have to calculate the residual income. This is from a strategic cost management and performance evaluation. Mr. A has approached you for advice regarding his concerns. He wants to know whether such forced acquisition of shares is tenable under the law. So this basically is forced acquisition allowed under law. That is what you have to address based on the corporate law provisions. You are required to compute the amount of depreciation allowable under the Income Tax Act in respect of block of assets carrying 15% depreciation. So this is, with respect to depreciation as per Income Tax Act, and especially what happens when you have this, what do you call, transfer of one entity or another into another entity, amalgamation happens or merger happens, then what is the scenario? Supposing the merger was carried out based on exchange ratio suggested by Mr. A, illustrate the impact of merger on the EPS of the company. This is again your AFM question. So as far as FR and SCMP is concerned, one is question number 3, question number 4, and question number 5 is what we have to address. So let us look at it. Now, as you read the case in such scenarios, we are worried about financial information. So after the introduction, first is about MNO. Second introduction is about PQR is a rising star in the FMCG landscape. As consumer trends shift towards healthier and more sustainable products, MNO Limited recognizes the need to adapt its product offering and market approach. Leadership team at MNO, led by visionary CEO, conducts a strategic review and identifies acquisition of a company. Okay, they want to acquire. MNO embarks on a search for a suitable acquisition, with PQR Limited quickly emerging as a front runner due to its innovative product line. So PQR is the target MNO wants to acquire. MNO decides to acquire PQR Limited by merger, and the following data is available. Number of equity shares 30,500, 61,000. Market value per share 22,110. Earnings after tax 61,305. Summarized balance sheet of MNO and PQR before the merger are as follows. So 700 current assets, 600. Then you have non-current assets. All this is the financial information that will be needed to calculate goodwill. MNO has decided to acquire PQR Limited by acquiring its share. MNO will acquire PQR by acquiring its share. MNO prepared a scheme by which an offer was made to the shareholders of PQR. Offer was made on 1st of March. Offer remained open for 4 months. Such an offer was approved by the shareholders having 92% value of the shares. Subsequently, MNO Limited gave notice to the remaining dissenting shareholders that it decides to acquire their shares. The notice was given on August 23. Certain dissenting shareholders have made an application to the tribunal that acquisition of their shares would not be permitted. However, their application was dismissed by the tribunal. Hence, MNO acquired the balance 8% of the dissenting shareholders. Okay, so acquisition happened. Now, again, this, if you see, much of information is not required, but yes, is a forceful acquisition allowed or not allowed? That is very hard to explain. While other minority shareholders have reconciled to the decisions of tribunal, reconciled means accepted, not the bank reconciliation statement. Okay. Mr. A shareholder holding 5% shares, is furious, angry. He believes that the growth prospects of PQR Limited are far higher than MNO. He believes that the exchange ratio should be calculated on the basis of market value alone. Who believes? Mr. A. He also believes that forcible acquisition of shares is a violation of his rights and amounts to operation of minority. So if at all a question is asked, you have to examine the corporate law provisions. Pre-merger, PQR Limited had a block of asset carrying 15% rate of depreciation. This is for your income tax purpose. Despite the acquisition, it is decided that post-merger, both MNO and PQR will continue to operate as independent divisions, namely MNO division and PQR division. So we have merged, but they will work as independent divisions in the merged company. This acquisition, followed by the decision to keep both the companies as independent unit, is seen as a strategic move that combines the strength of both the entities while preserving their unique values and operational strength. So here, this is more about the operational aspect, nothing specific to do with our question. The company shall have separate COO for both the division, and CO is Chief Operating Officer, and it wishes to evaluate their performance. It has considered computing ROI of both the division for this purpose, return on investment. However, one of the COOs pointed out that it may be possible that divisional ROI can be increased by those actions that will reduce the overall ROI of the company. And conversely, action that decrease the divisional ROI may make the company as a whole better off. So basically, ROI as a factor, if you do, ROI of a division may be higher, but overall ROI may actually be lower. In other words, evaluating divisional manager on the basis of ROI may not encourage goal congruence. So this particular part, they have asked us to calculate based on residual income. Accordingly, for better evaluation of performance, an alternate method of measuring performance using RI is proposed. Following are the details: cost of capital 8%, investment 25 lakhs, 15 lakhs, controllable contribution 2.5, 1 lakh, and 8% is the cost, right? So we have to calculate residual income. What is the residual income? Your controllable contribution is 2.5, 1 lakh, 25 lakhs into 8%, your cost, right? 25 lakhs into 8%, your cost or interest, what you call. So that is 2 lakhs. And 15 lakhs into 8%, 1.2 lakhs. 2.5 minus 2, here it is 0.5, here it is minus 0.2 lakhs. So if I read the bracket, it's okay. So PQR division, negative 0.2, and MNO division, positive 0.5. If you see return on investment, 2.5 by 25, it is 10%. 2.5 by 25, 10%. 1 divided by 15, it is around 6.67%. And your cost is 8%. So ROI is different. Your requirement is 8. That is why here you are getting the negative number. So this question here, MNO division, we calculated positive 0.5 and this is negative 0.2. So this is the correct answer. First answer, fifth one is the correct answer is 0.5 positive residual income for MNO, and MNO acquired PQR. No, we may be sometimes trigged. Yes, MNO is 0.5 and PQR is 0.2 negative. Now, so first one, this is as a part of AFM. Second, third question. If the exchange ratio as described in question 2 is considered. Now, what is the exchange ratio in question 2? Let me quickly look at the answer. Exchange ratio is 2.5. Okay, exchange ratio is 2.5. Now, when we say exchange ratio is 2.5, what does that mean? The acquiring company, MNO, has issued 2.5 share for every share held in or every share held by or existing in PQR. Now, how many shares are there in PQR? PQR has 61,000 shares. This is PQR. Now, 61,000 into 2.5. So, 61,000 into 2.5, if I do 61,000 into 2.5, I get 152,500. This is controlled now by whom? By PQR shareholders. MNO has 30,500. So MNO has 30,500. Now looking at this, who is controlling the combined entity? Though MNO issued shares and acquired PQR, but the shareholders of PQR are controlling the combined entity because PQR now has 152,500 shares. So what happens is PQR has 152,500 shares. MNO has 30,500. When I say MNO, these are shareholders of PQR and shareholders of MNO. Now if you do this, 0, 0, 5 plus 5, 10, 0, 1, 2 plus 1, 3, 8. 1,83,000 is the total share capital. 1,83,000 is the total share capital, right? Out of this, PQR shareholders hold 152,500. So how much percentage do they control? 152,500 divided by 183,000. They control. You don't need to calculate actually. 152,500 divided by 183,123. They control 83%. We will need it to calculate NCI. So non-controlling interest becomes 16.67%, right? So who is the legal acquirer? Legal acquirer is MNO. Legal acquirer is MNO. Accounting acquirer is PQR. Accounting acquirer is PQR. So legal acquirer is MNO. So MNO is the legal acquirer. legal acquirer is here and legal acquirer is here. But MNO is not the accounting acquirer. MNO is the accounting acquiree and PQR is the accounting acquirer and legal acquiree. So option D is correct answer. Slightly, sometimes, we may tend to get confused, right? We may tend to get confused as to who is the accounting acquirer and who is the accounting acquiree. Simply, the one who is controlling will become the accounting acquirer. Who is controlling? PQR. So PQR is the accounting acquirer. Accounting acquirer is here also. It is not there, it is not here. Accounting acquiree, MNO is not the accounting. MNO is the accounting acquiree, but PQR is the accounting acquirer, but it is not the legal acquirer. It is a legal acquiree. Okay, so that is one thing you have to keep in mind. And if the exchange ratio as decided in question 2 is considered, what is the amount of goodwill? Now what you have to see? The purchase consideration. Okay, now what is the purchase consideration? Now we have to check everything from the point of view of the accounting acquirer and not the legal acquiree. Not from the point of view of accounting acquirer, but from the what you have to see? You have to see it from the point of view of accounting acquirer. Who is our accounting acquirer? PQR is our accounting acquirer. PQR is our accounting acquirer, right? Now, PQR holds 83.33% and MNO shareholders hold 16.67%. Now, for this 83.33%, how many shares does PQR have? PQR has 61,000 shares. PQR has 61,000 shares. Now, if 61,000 represents 83.33%, how much is 16.67? So what we will do? We will say 61,000 divided by 83.33 multiplied by 16.67. We get 12,200. Okay, it is there will be a slight rounding of thing. So what you have to do is basically 83.333 if you do and multiplied by 16.6667 if you do, you get 12,200 to something, rounded up to 12,200. Or this ratio 83/16, this ratio is 5. This ratio is 5. 16 5s are 80. So if you do 83.33 divided by 16.67, you get 5. That is the multiple. Okay. So while dividing, rounding off, it becomes 12,200. These are the number of shares which are notionally issued. Which are notionally issued by whom? By the accounting acquirer, that is in our case PQR, to the accounting acquiree or the legal acquirer. Okay. So purchase consideration. Now, how much is the purchase consideration? Purchase consideration is basically 12,200 multiplied by what is the value per share? Market value per share is 110. So 12,200 into 110, what we get is 12,200 into 110, we get 13,42,000. This is the purchase consideration. This is the purchase consideration which is issued or which is transferred by PQR Limited. Right? That is the first thing. Then, now, by issuing this 13,42,000 worth of shares, they have acquired 100% of the shares of your accounting acquiree. That is, of MNO, they have acquired 100% share. Now, what is the fair value of net assets? Have they given us fair value of net assets? They have given the balance sheets. The fair value of assets and liabilities of both the companies are same as the carrying value. So we have to see who's MNO. 700 plus 11, 1800 is the asset. 795 is the liability. So 1800 minus 795, what we get is 1005. 9 minus 9 is 0. So 1005 000. 10 lakhs 5,000. 10 lakhs 5,000. 10 lakhs 5,000. So 1342 minus 10 lakh 5,000, we get 3,37,000. That is the answer. So let us see, goodwill 3,37,000 is the correct answer. Okay. This, of course, 7382 would not be a case because it is more than the purchase consideration. This also would not be the case. Then this we have done, this we have done, this we have done. It has been done. Let's now have a look at the next case study number 17. Max Plus, referred to as herein after referred to as the company, one of the most trusted gateways to medicines, incorporated in Delhi with an aim to eliminate fake and ineffective medicines and supply good quality medicines in India. So this is the company. Okay. Now again, as a matter of practice, let us see what are our questions. As on 31st March, how should the company classify the loan? So there is some loan, we have to see what is the classification. Then assume that it may not be able to get the promoter's contribution by the due date. The company approached the bank in January 24 and got the compliance date extended up to 30th June for getting promoter's contribution. Will the loan be classified as on 31st March 2024 be different from above? So this is a similar question on classification of current and non-current liability. They have taken an existing question and they have actually split into two MCQs. Okay. Then, which of the following is true? Whose supply chain is suitable for retail outlet? Pull model. So we have to figure out which model, okay, which is correct for this entity. Why does Max Plus not use the franchisee model? This we can get only by looking at the case study. During FY 23-24, if the cost of all other common inputs, so common input comes and GST, it is basically with respect to your ITC. Compute the value of CT scan machine for the purpose of levying customs duty. So, sometimes they ask questions. This again, you have to perfect your IDT customs portion. Company has three choices: forward cover, money market cover, currency option. This is from your AFM. For the year 23-24, you are required to analyze whether the situation relating to constructive obligation for payment of bonus is an error requiring retrospective restatement of comparatives, considering that the amount is material. So here we have to see whether it is a prior period error or not. With reference to well outlet, calculate the customer lifetime value per subscriber, given that present value annuity factor of rupee 1 for 4 years at 10% is 3.169 and present value factor, interest factor of 1 for 2 years at 10% is 1.735. So basically they want us to calculate the lifetime value per subscriber. How much are we getting from the customer? Okay, so let us come back to the case. So first is about, your introduction to the company. Generally, from the first paragraph, you will not get much of an information. If you just scan through towards the end, they say entire operation of the company can be broadly classified into two divisions: retail outlet and agency division. Retail outlet division. This chain of medical store operates in 100 cities in India, 10 stores in each city. As per the accepted policy of the company, it does not involve in franchisee model, and all the outlets are operated by the company directly. Also, as per its policy, it does not operate with outlet from own premises, and all are rented premises only, which is under the lease model. They don't have any question on lease. The stock and sales are accounted and managed through a customized and specialized software developed by the company 2 years ago, which is inbuilt with various features like stock at glance, outlet-wise sales, details, frequency of customer purchases, etc. The information security officer of the company is a certified professional, and customer database is protected in all respects. So here there is nothing that is again relevant for our case. With regard to its outlet, the company through its legal wing enters into 3 years lease agreement with landlords for operating its stores in all the cities. As a part of the vendor registration, company captures all the details of landlords like PAN, TDS, MSME registration, GST, and so on and so forth. So this is again, nothing has been asked as such in the case. The company is capable of selecting similar places in different cities having similar lease rents. The company is also capable of finalizing all these contracts with similar terms and conditions. The contract includes the following mixed monthly prices payable at the end of every year for lease and non-lease component. 27,000 lease, 3,000 non-lease. They can ask if at all, they can say if it's a non-cancelable lease, what is the value of ROE asset? That question can be added based on this information. Then the company has ability to forecast demand for its product with high accuracy, and it has sufficient working capital requirement that can help it stock up inventory. Demand is continuous throughout the year, hence the inventory turnover is high. The profit margin earned from its sales are high and generate sufficient cash flow. Working capital needs of the company are sufficiently met by internal reserves. So basically what is happening? They are able to estimate the demand and accordingly they can stock up the inventory. All these factors can enable the company to sell its product on a large scale in anticipation of demand. As and when there is demand, we can supply. Inventory can be stocked up and sold when the demand for it arises. When there is a demand, we will supply. Okay, there is one question on whether it is a push model or a pull model. That is what we have to respond to. Right? Now, when it comes to push model or the pull model, what do we need to understand? If it is a push model, we are pushing the product. We expect that there is some demand, we are pushing the product. Pull model means there is a demand and then we are supplying. Okay, that is the difference. So retail, this is basically your push model. The company is also the leading trader dealer of an extensive array of medical equipments, agency division for equipments. Max Plus direct all its activity to cater to the expectation of the customer by providing them excellent quality products as per their gratifications. On the basis of its strict quality principle, it has been able to serve its customer honestly. This is again philosophy, nothing much to do with the actual case. In the retail outlet division, the company regularly purchases different varieties of medicines through centralized procurement system, and they are distributed to the outlets which are sold to the customers. Unsold medicines are held as stock in hand. However, it buys medical equipment only when the customer gives a purchase order. So when there is a demand, and then we provide the equipment. So this works in the pull model. The delivery of such medical equipment is directly done by the corporate office. During the financial year, Max Plus has imported CT scan machine by air and provided this machine to hospital governed by a charitable trust. And these are the details. Okay, this is for custom duty. Rate of basic custom duty was 20%. Then it was reduced. So basically, depending on when the bill of entry has been filed and all of that, you have to decide which date is applicable, which rate is applicable. For the import of the machine, the company is liable to settle the exporter in 3 months. Hence, at the time of import, the company has entered into a forward contract to hedge foreign currency cash flow without considering other hedging alternatives like option contracts and money market hedging opportunities. Right. So this, here they have asked in AFM, they can ask for the accounting treatment when it comes to FR. Wellwell outlet is located in a town with many colleges and universities around it. The town has a substantial student population, most of whom are health conscious and regular buyers of health products. Business for this particular outlet has been slow in recent years due to the advent of online pharmacies that offer convenience, discount, and time-saving benefits. However, the management continues to believe that students would still prefer the personal service, immediate availability, and expert advice that only a physical pharmacy can offer. Accordingly, management have framed a plan to attract students by offering discount on health products. The average time a student spends at the college or university is 4 years, which is the average duration for any course. So a student spends 4 years at the university. For a nominal one-time subscription fee, Wellwell plans to offer students discount on the health product for a period of 4 years. A lot of these days, you have offices and companies which give you discounts. By attracting more footfalls, Wellwell targets to cross-sell its wellness product and health supplements. This would keep it sustain a reasonable revenue each year. Wellwell would attract attention to the plan by initially offering a free health checkup. So first you call them for free health checkup, then take all the data. Wellness product and gift vouchers. This one-time initial expense, net of one-time subscription fee collected, would cost 5,000 per student. That is what you will incur. On subscription to the plan, the purchase of each student are expected to be as follows. Spend on health product year 1 and 2, 2,000, 3 and 4, 1,500. Spend on wellness product 4,000, 3,000. Spend on health supplement 2,250, 750. Only 50% of subscribers are expected to visit pharmacy in the years 3 and 4. So everybody will not visit, only 50%. Across all years, only 75% of the subscribers who visit the outlet are expected to buy wellness product. Only 25% of the subscribers who visit are expected to buy health supplements in years 1, 2, and 10% of them in years 3 and 4. So basically here what they have told us is, under each category, how many users or how many subscribers are expected to visit. And once the person visits, how much is he expected to buy in which year? Okay, how much is he expected to buy in each year? That is what has been given. Now, why is this information relevant? This information is relevant because in one of the question, what they have asked us is, what is the lifetime expected value from the customer, right? So that is what they have asked, and this information is relevant. So how do we read this? Only 50% of the subscribers are expected to visit the pharmacy in year 3 and 4. So here, only 50% is the revenue that you will be getting in year 3 and year 4. Okay. Then, across all years, only 75% of the subscribers who visit. These are what visit. So here, For example, in the first year, in the year 3, we are saying only 50% will visit. Out of this 50%, only 75% who visit are expected to buy wellness product. Now, what does that mean? What that means is, if you look at the wellness product, 3,000. 3,000 is the expected purchases of each student that is expected is 3,000. Okay. Now, out of this 3,000, will I get all the 3,000? I will not get all the 3,000. How much will I get? They're saying that only 50% will visit in year 3-4. So, in year 3-4, if it is 3,000, only 50% will visit. Out of that 50%, only 75% will buy. So 50% into 75%, expected value is only 37.5%. So like this, we have to calculate the expected value for each of the, each of the component of the matrix. So what we can do here is, if we just plot it out properly, only 50% of subscribers are expected to visit the pharmacy in year 3, year 4. So year 3, year 4, it is 50%, 50%, 50%, which means here it is 100%, 100%, 100%. Across all years, only 75% of the subscribers who visit the outlet are expected to buy wellness product. Wellness product, only 75%. Only 75%. So, in year 1 to 4,000 into 75%, 4,000 into 75% is your expected value. Is your expected value. This you will multiply with the present value factor to get the present value. Right? Then only 25% of the subscribers who visit are expected to buy health supplements in year 1 and 2. So health supplement in year 1 and 2, how much? 25%. In year 3 and 4, how much? 10%. So this ultimately becomes 5% here. This becomes 37.5% here. This becomes 25% here. And this becomes 75% here. Right? Then what about the health product? They have not given any information. So 100% here and 50% here. Now, how do we calculate expected value? I will do for one, and for remaining you can, for calculate on your own. So let us say for health product year 1 and 2. So the expected sales is for health product in year 1 to 2 is 2,000 multiplied by 100% multiplied by the present value factor, annuity factor. For years 3 and 4, it will be 1,500 multiplied by 50% into the relevant present value annuity factor. Right? Then for wellness product, it will be 4,000, this number, multiplied by 75% multiplied by present value annuity factor. Like that, for all the products, we can calculate and determine what is the net revenue of the, or what is the present value of the expected revenue from all of this. Okay. Then financial reporting consideration. As Max Plus prepares its annual financial statement for the year ending 31st March, several critical issues have come to light that require consideration. Firstly, during the financial statement preparation process, it discovered that a provision for constructive obligation for payment of bonus to selected employees in the corporate office, which is material amount, which was required to be recognized in the annual financial statement for the year ended 31st March, was not recognized due to oversight of fact. There is some fact, they have overseen it. Now, if there is an oversight of fact, what is this? This is an error. This error means you have to correct it retrospectively. The bonus was paid during financial year ending 31st March 23 and was recognized as an expense in the annual financial statement, which is incorrect. Right? Then, in November 23, company entered into a loan agreement with a bank. The loan is repayable in 6 annual installments starting from November 28. One of the loan covenants is that amount equivalent to the loan amount should be contributed by the promoters by 4th of March, failing which the loan becomes payable on demand. As on 4th of March, the company has not been able to get promoter contribution. On 5th of March, the company approached the bank and immediately obtained a grace period up to 30th of June to get the promoter's contribution. The bank cannot demand immediate repayment during the grace period. This development highlights the importance of accurate financial reporting and proactive management of loan covenants to maintain financial stability. Now, what has happened? Now, what has happened? The promoter was supposed to get the money on 4th of March. Okay. Did they get it on 4th of March? They have not got it on 4th of March. Now, if they have not got it on 4th of March, it becomes payable on demand, right? But what they have said, they have gone to the bank and they have got a grace period of the 30th of June. Till 30th of June, the bank cannot demand immediate repayment. Now, tell me, if the promoters do not get the money by that date, can the bank demand payment? Yes. So, there is an obligation on the company that after 30th of June, the bank can come and demand the payment. So what if the promoter gets in the money? If the promoter gets in the money, that's a different thing. But as of the situation which is given today, the promoter have not gotten their money. So till 30th of June, we have time. If you don't get money by 30th of June, then what happens? You will have to repay it immediately, right? So the grace period ends on 30th of June, which is less than 12 months from the end of the balance sheet date. So on that day, you will classify this as a current liability. So the loan will be considered as a current liability. Assume that it may not be able to get the promoter's contribution by the due date. The company approached the bank in January and got compliance date extended to 30th June for getting promoter's contribution. Will the loan classification as on 31st March 24 will be different from one above? Right now, what they're saying, in January itself, they got the compliance date extended to 30th of June. Here, in the first case, the compliance date is 4th of March. Compliance date is 4th of March. You have breached the condition. Here, compliance date itself is 30th June. Have I breached the condition? I have not breached the condition. So if I breach the condition, that is different thing. Here, condition is already gone. Condition is already breached. We are in the grace period. But here, condition is not yet breached. It may be a future breach of condition. So this will be classified as a non-current liability. See, loan will be classified as a deferred tax liability. What kind of question is this? Will be considered as provisions. If you don't have options, you add this nonsense options in the question. So the loan will be classified as a non-current liability. Then, which of the following is true? Push model supply chain is suitable for retail. Yes, we have understood this. Pull model is suitable for agency. Yes, we have understood this. Risk of pull model supply chain is overstocking and locking of working capital in the inventory. See, in pull model, you will supply when there is demand. So there is no locking of inventory. This is incorrect. High inventory turnover ratio implies working capital gets locked in the inventory for a longer period of time. If your inventory turnover ratio is higher, it means your working capital is blocked in the inventory for lesser number of period or lesser duration of time. So this is also not correct. 1 and 2 are right. So option D is correct. Why does Max Plus not use the franchisee model for its retail outlet? Now the question is, why does Max Plus not use? First, to avoid legal complication. That is not what is hard. But that is not what is the reason. To maintain direct control. So if you see the reason, you can control the entire operation. Due to lack of knowledge, there is no question of lack of knowledge because of the high cost of franchisee fee. That is also not mentioned. So to maintain direct control is an appropriate answer. For the year 2024, to analyze whether the situation relating to constructive obligation for payment of bonus is an error requiring retrospective restatement of comparative, considering the amount is material, right? So now, which standard is applicable? You will apply Ind AS 8 here, right? By applying Ind AS 8, what you will define? What is a prior period error, right? So if there is any error in the preparation presentation of the financial statement by ignoring or not considering the facts which were known or which would have been known at the time of preparation of financial statement, those errors which are material, they have to be retrospectively adjusted. Then if you do a retrospective adjustment, as per Ind AS 1, you need to prepare 3 balance sheet. One is opening balance sheet as at the beginning of the current period, then previous year and current year balance sheet. So 3 balance sheets have to be prepared. Though it is a constructive obligation, you have to do the rectification. Then with reference to well outlet, calculate the customer lifetime value for per subscriber given present value interest factor for annuity of ₹1 for 4 years at 10% is 3.169 and of ₹1 for 2 years at 10% is 1.735. So this, we have already done the calculation broadly. We can directly look at the solution. So here we have the cost of attracting customer 5,000. This is a negative number beginning. Then net revenue from health products. So they have given us years 1 to 2, years 3 to 4. It is not year 1, 2, 3, 4 separately. 2 years are combined here and 3 to 4 are combined here. Basically, we'll assume that you are obtaining this towards the end of the period. Now, the revenue given here is 2,000 per year, 1,500 per year for health product. They have given in the question. 4,000 and 3,000, 2,250 and 750. Now, with this, you have to multiply this with the probability. 100%, 50%, 75, 37.5, 25 and 5%. What we have already calculated here. That is the probability. As we are discussing, we calculated the probability, right? 100%, 50%, 75%, 37.5, 25 and 5%. Then we need to calculate the present value factor. Now, if you ask me, the easier way to do is for year 1 and 2. So whatever revenue I'm getting in year 1 and 2, if I have to bring it to present value in terms of annuity, basically what it means is 1 divided by 1.1 plus 1 divided by 1.1 to the power of 2. And for year 3 and 4, what it means is 1 divided by 1.1 to the power of 3 plus 1 divided by 1.1 to the power of 3 plus 1 divided by 1.1 to the power of 4. If you do this number, that is 1 divided by 1.1 plus 1 divided by 1.1 to the power of 2, it is 1.7355. 1.7355. And this number to the power of 3 plus 1 divided by 1.1 to the power of 4, it is 1.434. You can directly calculate. But they have given this number in the question. What are they given? For 4 years, sum of annuity factors of the entire 4 years is 3.169. And for 2 years is 1.735. So first 2 years is 1.735. Full 4 years is 3.169. So for 3 to 4 years, can I say it is 3.169 minus 1.735? That gives me 3.169 minus 1.735. That gives me 1.434. Same number. So that is the annuity factor you will consider. 1.735, 1.434. After that, it is simple. Revenue multiplied by the annuity factor multiplied by the probability, you get the net present value. This is not net revenue. This is present value of net revenue. 34701076. You do all this calculation, you get 12,394 minus 5,000. You get 7,394. That is the lifetime value from the customer for a 4-year period of subscription. Okay, so this is how we'll calculate. Now this again is, even if you have not read this, as a concept, or if you don't remember, it is simply calculation of present value of cash flows, which you learn at multiple different places, and with that knowledge also you can solve the issue. Let's now have a look at the next case study. This is case study number 25 on a company named Fresh Foods. Okay, it's a popular fast food giant in Bangalore, formed by partnership of 3 friends. So again, like we normally do, we'll quickly glance through the questions. First, which of the following is true regarding Keyman insurance policy? Now, this type of question you anyways will discuss as a part of taxation. But again, this can be directly answered without breaking our head in the case study. Then, Fresh Food has approached Indie Bank Limited for a term loan of 5 crores. For this, they need to submit prospective financial statement. So this prospective financial statement, whether and Fresh Food has approached CA Annual for examination of prospective financial statement. So this is based on its standards with respect to audits, your audits and related services, etc. There you will be covering. Which of the following statement would not be true regards product pricing for individual food items? So this is about food items, whether we can use standard costing, target costing, product pricing to be used to determine expected revenue for yearly budgetary planning, which can be determined based on relevant costing techniques. Right, so this is based on how should it be priced. Then, which of the following will not be a value added activity? So there are certain activities which add value. There are certain activities which do not add value. We have to identify that. Then the partners have identified certain critical success factors for fresh foods, like tracking menu offerings that maximize customer satisfaction, customer service related parameters like complaints, customer response time. Which of the following is true about CSF? Again, this part they have just added some context. Question is, which of the following is true about CSF? So three questions for your strategic cost management or strategic performance management you have to address. Compute book profit, that is for taxation. Fresh food is in the service industry where it is essential to link strategy to the management of human resources. The partners would like to have a framework based on the building block model. Very important model. You have to read this a couple of times so that you can create a building block if at all a new question is asked in the examination to assess performance management. Using performance management system as proposed by the model, evaluate the following questions. So this is on the performance management. First, what dimensions of performance should fresh food measure? Dimensions are the goals that the firms want to achieve based on the overall strategy. So you have to look at the strategy and see what are the goals you have to measure, how to set the benchmark for the dimensions, and what are the characteristics of reward systems needed to motivate the employees to achieve the standards determined by fresh foods. Okay, so more focus on performance management and performance measures. So let us quickly glance through the case as well. Now here, they have told Ajay, Biren and Chand, they are working, Ajay and Biren is working partner, Chand is a non-working partner. Then for previous year, these are the net profit. This is to do with more of your tax, the book profit calculation. A general survey published in a food trade magazine highlighted people's perception about the food served by food joints across the city. Current food platter was found to be predominantly unhealthy. People want healthier choice in their menu when they dine out. At the same time, they do not want to compromise on the taste. So this is what the public wants. Then the partners have decided to use this as an opportunity to entirely revamp fresh food as a specialty restaurant that offers healthier variety of food clothes catering to health conscious customers. Ajay, Biren and Chand are having a meeting to discuss this venture in further detail. So they are having a meeting to discuss the venture in more detail. The partners should restate their mission as spread health and happiness through the craft of cooking, catering to the discerning palate that forge long-lasting bond with our loyal customers. So a lot of case studies, if you see, they are using fancy English. Now, catering to the discerning palate. The partners would restate their mission as spread health and happiness through the craft of cooking, catering to the discerning palate that forge long-lasting bonds with our loyal customer. Palette is generally used to draw, so draw means it's not about draw. Basically, where you mix the colors. Discerning is which you can, see, that is what it means. But anyways, this is the mission. Basically, they want to spread health and happiness through cooking. A menu focused on vegan and vegetarian food options, emphasizing the natural, organic, and high quality of ingredients, would give us the niche segment of loyal customers. Vegan is a new concept where they're talking about not even consuming animal product, even milk, ghee, and all of those that will not be consumed. So, for example, if you have, let us say, if you use paneer, you have an alternate vegan option called soya paneer. It's not actually a paneer, but use soya bean as instead of paneer. Okay, tofu, what they call, I guess. How would we be able to assess the market size? The food industry is largely unorganized, and within that, there is no data available for ventures like ours. So again, here it is more of a discussion for you to understand what they want to do. You're correct. There is no easy way to measure the market size. So let us set to conquer this uncharted territory. At this nascent stage, nascent means initial stage. Let us first begin serving this menu at our restaurant only for lunch and dinner. Our restaurant has a capacity to seat 50 customers at a time. Our restaurant should be filled with at least 90%, if not during the peak hours when it is open. If you are overbooked regularly, we can consider expanding. Catering to health conscious customer is not a novel idea, means it is not a new idea. Many have tried it out before and failed. Investment in kitchen infrastructure, redoing ambience and decor to match the product offering would cost us at least 5 crores as initial investment. Again, nothing great directly to tell us or help us to answer the case study. We would need to raise a term loan for the bank for this. We need to generate sufficient profits to repay the loan. So here, basically now they've started discussing about the loan, right? So loan, and there is a question on prospective financial statement. That is where you can link this to. Yes, we are in the business to make money. So let us re-engineer our menu. Let us segregate items based on the popularity and profitability. Class A items will be highly popular and profitable. Class B items on the list would be highly popular but not profitable. Class C would be profitable but not popular. Class D are the ones over time show that they are neither popular nor profitable. The segregation will give us ample information on which items to focus should be our focus areas while knowing how much margins they would generate. So here what they are doing is they're basically categorizing their menu options to figure out which are popular and which will give them a lot more profitability. I expect to generate a turnover of 60 lakhs in the first year of operations with an increase of at least 3% each year. While this gives us the first mover advantage, we need to constantly re-engineer our menu to beat our competitors, who may also start replicating our model and menu. For this, let us take constant feedback from our customer. So here they're talking about what? Revenue. They are aware of that competition may come up, continuously talk to the customer and ensure that you continue properly. This is told by Chand. This should be possible only if we have expert chefs and a team that can handle specialty dishes, catering to different customer preferences in a cost-effective manner. Popularity is also driven by the quality of food that we serve. High quality standards drive growth. So if you want growth, you need high quality standards. Periodic weekly quality checks would be required. So here there is a focus on quality. So why am I writing all of this is subsequently when they're asking performance measures, we should know what is the performance measure they are talking about. External certification from government food inspectors and other recognized agencies would also be required to be met. We need to keep a formal record of quality issues identified by the customer or the team. Yes, quality has to be matched with service. Ours is a customer-centric business, hence personal interaction with the customer should have good people management skills. Complaints should be handled in a professional yet personable manner. So here we are talking about complaints. Okay, when a customer complains, what happens? Service also means that order given by the customer should be delivered correctly as per their expectations. So again, here it is about quality. Errors in order taking process, stockouts due to unavailability of material should be avoided at all cost. It should be our aim to deliver the food within 15 minutes. So here we are talking about within what time. And the food should be both warm and fresh. Rejected raw material, customer rejections of food delivered also need to be tracked. So here we are also talking about returns. COVID pandemic taught us an important lesson on maintaining a robust supply chain that can deal with disruption. For critical resources such as raw materials, labor, our firm should have multiple partners. So you have multiple vendors and not be dependent on a single vendor. Not just that, our internal process should make efficient use of resources. The order taking system and food delivery system should work in sync and support each other. So here we are talking about efficiency. Our core team of chefs should be adept, means they should be smart enough or they should be able to do things in that manner at minimizing waste. So basically they should be skilled and preparing unique dishes in an economical way. We need to build a kitchen infrastructure that can support this, providing, so basically we want to support them to work in an economical way, providing them with appropriate space, machines and tools for cooking and storage. As regards to our marketing process, we may need to use technological solutions like social media platforms to reach out to potential customers. So how will they do marketing? How will the kitchen be there and all of that? High staff attrition is a perennial problem in our industry. Staff attrition means staff leaving. Expert chefs are our key to success. So here, very important focus is there on expert chefs and your attrition problem. We should explore the possibility of taking out key man insurance policy and key employees, including the partners. This should not only boost the morale, but also help in retaining them. The specialty chefs may also enjoy working with us if we give them sufficient scope for innovation. Wonderful. I'm excited at the range of possibilities this venture can offer. Let's get started by putting in place a system for performance measurement of various parameters. It was decided that Ajay would be in charge of restaurant operations, management activities like material labor procurement, kitchen operations, supply chain and quality control, and any other business operation. Biren would be in charge of finance, administration, and marketing. Vegetarian will be in charge of activities like negotiating settlement dates with vendors. I don't know why did I say vegetarian. Procuring loans at effective rates, promotional campaigns to build the firm's visibility. Chand would continue to be a non-working partner, giving strategic insights and if needed, additional capital infusion if the business needs. There will be separate departments created to form a proper organization structure with clearly defined authority and responsibility. The periodic management of the menu, which will define the food choices based on the profitability and popularity among the customers, will be decided jointly by the partners. Partnership deed is being modified accordingly to reflect the need. So here also nothing much is there. Okay. Now, which of the following statements would not be true? Very careful, would not be true as regards to product pricing for the individual food items. Which item would not be true? First, standard costing techniques may be used to compute the cost of individual food items. Now, can we use standard costing to compute the cost of individual food items? Of course, because let's say you want to serve some item. Let's say you want to serve pasta. For pasta, how much quantity of pasta is needed? How much quantity of, let's say milk, cream, vegetables is needed? All of that you can have a standard cost and you can measure, right? So this is a correct statement. Target costing techniques may be used for managing profitability of food items having popular close substitutes, even if they are not as healthy that are offered by competitors. Now, what do we do in case of target costing? We determine that, okay, this is the selling price. Now, this selling price is comparable to the substitute. These are percentage profit. Sales minus percentage profit is my target cost. So, can we use target costing to estimate profitability? Of course, yes. Then, product pricing to be used to determine expected revenue for yearly budgetary planning, which can be determined based on relevant costing techniques. Product pricing, which will be used to determine the expected revenue for the yearly budget planning, can be determined based on relevant costing techniques. Now, relevant costing techniques is basically seeing what are the relevant costs. Okay, and considering the relevant cost, we are taking the decision. Now, this relevant cost alone is not your estimate of the annual pricing. See, when you have to do the product pricing for the entire budget period, you have to look at not only the relevant cost, you have to look at other costs also. You cannot just say, I'll just consider variable cost and decide the pricing. You have to consider the variable cost, you have to consider the fixed cost, you have to consider the allocation of overhead. All the cost has to be considered when you have to do the annual budget. So option C is not a correct statement and hence is the correct answer. If the price quality perception or the unique value perception for certain food item is high, customer will be less price sensitive for those items. So if the quality sensitivity is higher, if I like a product, if I like the quality, then even if there is a change in price, even if there is an increase in price, I would be okay to pay a higher price. I will not be very price sensitive. Now, you would have seen in the case of, let's say, Apple iPhones and all, people have long queues, people stand in queues for hours together to get the phone. They increase the price, people still buy the phone. Okay, so that is how it is. Then, which of the following will not be a value-added activity? Value-added means you procure something, you procure some material, you do some activity, you add value to the product. Okay. So, which of the following will not be a value-added activity? Which of this activity will not add value? Not add value to the customer. First, inspection of food items on a regular weekly basis to ensure quality standards are met. Now, you want a samosa. Okay. When you want a samosa, whether that samosa is inspected or not doesn't make a difference to you. Your value comes from the samosa. So the material, bringing out the material, preparing the samosa, delivering that to you, all of that adds value. Inspection, though it ensures the quality, does not change your value perception. Okay, so quality testing does not directly add value. So first one does not add value. Then using Kaizen costing methodologies to reduce the turnaround time in delivering the order to the customer. Again, I get the product. Now, if you're using Kaizen costing techniques and you're speeding up, it is good for you. But that product as such does not have additional value because you have reduced the turnaround time. So this is also then using Kaizen costing methodologies to reduce the turnaround time in delivering the order to the customer. Now, if the turnaround time is reduced while delivering the product, customer will say that, yes, you have got some value to that particular product. You attach some value to that product. So this is a value-added activity. Redoing the food items as they did not match the customer specification that were given while placing the order. So if you are redoing the items again, then do you think it will add more value? It will not add more value. I will get what I'm expecting. So this is not a value-added activity. Wait time of batch food item for baking process as the ovens in the kitchen are occupied in baking other batches of food items. You are unnecessarily, taking more time. The product that is being prepared, you are, keeping it in a waiting status because the capacity is fully utilized. Will that add value to the customer? This will also not add value to the customer. So 1, 3, and 4 will not add value. Option A is the correct answer. The partners have identified certain critical success factors for fresh food like tracking menu, offering, maximize customer satisfaction, customer service related parameters. Which of the following is true about CSF? So, which of the following is true? These factors contribute to a reducing cost. Critical success factor does not necessarily reduce the cost. So, this is not the correct option. These factors are fundamental to strategic success? Yes. These factors need to be only financial factors? No. These factors concentrate on achieving short-term goals? No, they are short-term as well as long-term. So, option B is the correct answer. Right? Option B is the correct answer. This you could have solved directly if you would have learned about CSF either in strategic management or your strategic cost management and strategic performance management. Now, this question is focused on building block model. Let us quickly have a look at what is the building block model. A quick recap will actually help you also to revise. So here you can see the building block model. Okay. So you have different parts, you have standards, you have dimensions, you have rewards. Yeah, the question is about dimension. The question is about dimensions. So you have to see all of these, dimensions that you can see on the screen. For each of those dimensions, like your, dimensions related to quality, flexibility, innovation, resource utilization, financial performance, and your comparative performance. Competitive performance, not competitive performance. So determinants are what? Determinants are what? These are the ones which will give you results. Okay, so for example, quality, flexibility, innovation, resource utilization, they will give you the results. And the results can be financial performance, means you have improved financially, or a competitive performance, right? So the question is about the partners would like to have a framework based on the building block model to assess the performance management. Using performance management system as proposed by the model, evaluate the following question. What dimensions of performance should fresh food measure? Dimensions are the goals that the firms want to achieve based on its overall strategy. So, what are the dimensions that the firm should measure? That is the first question. How to set the standards for the dimensions here in the first part? And what are the characteristics of reward systems to motivate the employees to achieve the standards determined for fresh foods? Now, coming to the dimensions, financial performance, right? Now, when you talk about dimension, you talk about financial performance. How much is the return they want? How much is the profitability they want? Right? In the question they have given us that they want to earn certain rate of return. Then on competitive performance, how do you want? Let's now have a look at the next case study. Case study number 25. This is on fresh foods. Okay, like usually what we do. Quickly a glance at the question. Which of the following is true regarding key man insurance policy? This is something to do with your taxation, which you would have already covered. Fresh Foods has approached Indie Bank for a term loan of 5 crores. For this, they need to submit prospective financial statements. So this is with respect to your audit. Which of the following statements would not be true as regards to product pricing for individual food items, right? Now, here we have a question which talks about pricing for individual food items. So that is one more question. Then, which of the following will not be a value-added activity? Now, when we say value-added activity, the question says, which of the following is not a value-added activity? Now, this we can directly answer without even looking at the case, because we have to answer which is not a value-added activity. First, inspection of food items on a regular weekly basis to ensure quality standards are met. Now here, I'm inspecting food on a regular basis. It will ensure quality, but will it add value? Will a product enhance? A product will not enhance. The features in the product will not change. So this is not a value-added activity. Second, using Kaizen costing methods to reduce the turnaround time in delivering the order to the customer. If I reduce the turnaround time, will my customer be happy? They will be happy because I'm adding value to the customer. It is directly impacting the customer. So this is a value-added activity. Then, okay, so we have to choose 3 options. We don't need to read remaining because we have eliminated number 2. So once you've eliminated number 2, so this is out, this is out, this is out. First option remains the correct answer, but still redoing the food items as they did not match the customer specification. Again, It did not match the customer's requirement. We are redoing it. Will it add any value? That will not add any value. Then wait time of batch of food item for baking process as the ovens in the kitchen are occupied. Now, why is a customer worried? What is the occupancy in the kitchen? It is needed for the customer. So this is non-value adding, this is non-value adding. So this type of questions, what I say is directly you can answer even without looking at the case. The partners have identified certain critical success factors for fresh foods like tracking menu offerings that maximizes customer satisfaction, customer service related parameters like complaint, customer response time, etc. Which of the following is true about CSF? What is CSF? Critical success factor. Now we have to see which of the following is true with respect to CSF. First, these factors contribute towards reducing cost. CSF is success factor. Will they reduce cost? No. These factors are fundamental to strategic success. Yes, critical success factors. The name itself suggests that they are critical to success. These factors need to be only financial factors. CSF can be financial as well as non-financial. These factors concentrate on achieving short-term goals. Not only short-term goals, but also long-term goals. So option B is the correct answer. Again, this MCQ, without looking at the question, are we able to solve it? Yes, we are able to solve it. Calculate the book profit for the purpose of income tax. That is as per Income Tax Act. Then, fresh foods is in the service industry where it is essential to link strategy to the management of human resources. Strategy, human resources. The partners would like to have a framework based on the building block model. So we'll have a look at a building block model. We'll discuss quickly about that. To assess the performance management. Using performance management system as proposed by the model, evaluate the following questions. What dimensions of performance should fresh food measure? Dimensions are the goals that the firm wants to achieve based on its overall strategy. So what dimensions of performance should the fresh food measure based on what? Based on this building block model. That's the first one. How to set the standards for the dimensions determined, and what are the characteristics of reward systems needed to motivate employees to achieve the standards. Pretty technical, theoretical, but if you know that this particular chapter, this particular concept comes from which chapter, that is which thing. Now, when we talk about building block model, that is covered in a chapter, strategic performance in the private sector, strategic performance measures in the private sector. So there, this building block model specifically talks about linkages between the corporate strategy and the management of human resources, right? So if you, at least if you know the concept, it is good. Otherwise, where is this particular concept given in the material. From there, you can pick up and write the answer. Of course, you have to relate that to the case study. Okay, so now let's look at the case quickly. Fresh Foods is a popular fast food joint in Bangalore. Fresh Foods is a popular fast food joint in Bangalore. It was formed by the partnership of three friends, Ajay, Biray, and Chand, A, B, and C. A and B are working partners. C is a non-working partner. They reported a net profit of 3 lakhs. Okay. Now, this information, salary, depreciation, interest, by the time you read, you should figure out this is related to taxation. A general survey published in Food Trade magazine highlighted people's perception about the food served by food joints across the country. Current food platter was found to be predominantly unhealthy. Platter means something which is spread out. Okay. So when there's a platter, so you have a plate on which you have spread out multiple things. That is called a platter. You would have seen, platter for starters or something like that. People want healthier choices in the menu when they dine out. At the same time, they do not want to compromise on taste. So they want health also, they want taste also. The partners have decided to use this as an opportunity to entirely revamp Fresh Food as a specialty restaurant that offers healthier variety of food choices. So they want to offer health. Now, here also, this only talks about general direction of the business. It does not specifically talk about anything that will help us to answer the case. The partners would restate their mission as spread health and happiness. Okay, they have not asked anything about mission. Through the craft of cooking, catering to the discerning palate that forge long-lasting bonds with our loyal customers. Slightly hi-fi English. Palette means the plate on which you spread colors. If you have seen artists, they have a plate like this where they put colors. That is called palette. A menu focused on vegan. Vegan is vegetarian without animal products. So no milk, paneer based out of milk, etc. And vegetarian food. Vegan, vegetarian food options emphasizing the natural Organic and high quality of ingredients would give us a niche segment of loyal customers. This is mentioned by Chan. How would we be able to assess the market size? This is a question which is asked by Ajay. Again, nothing directly related to the question. The food industry is unorganized, and within that, there is no data available for ventures like ours. You are correct. There is no easy way to measure the market size. So let us set to conquer this uncharted territory, means something which has not been done before. At this nascent stage, nascent is initial stage. Let us first begin serving this menu at our restaurant only for lunch and dinner. Our restaurant has a capacity to seat 50 customers at a time. Our restaurant should be filled with at least 90%, if not more, during the peak hours. So 50 customers into 90%. If you are overbooked regularly, we can consider expanding our offer. So start as a pilot phase, do it in your own restaurant for lunch and dinner, and then subsequently expand. Catering to health conscious customer is not a novel idea. Many have tried it and failed. Investment in kitchen infrastructure, redoing ambience and decor to match the product offering would cost at least 5 crores. So initially you need 5 crores as initial investment. Now this, if you remember, there is a question on funding for which you need to submit prospective financial statement. That is something related to this. We need to raise a term loan from the bank. We need to generate sufficient profit to repay the loan. Due to overall uncertain business condition after the pandemic, the bank may in turn expect us to maintain certain level of debt service ratio or interest coverage ratio. We have to earn at least 18% return of interest. So here, or return on investment, this 18% return on investment, this will be one of your performance measures to measure your performance. Since our menu offerings are going to be unique and healthy, we have some leverage to charge higher prices. So this is a general discussion on finance target profits, target return on investment. Yes, we are in the business to make money. So let us re-engineer our menu. Let us segregate items based on their popularity and profitability. Class A items will be highly popular and profitable. Class B items on the list would be highly popular but not profitable. So A, highly popular. B, highly popular but not profitable. Class C would be profitable but not very popular. D are the ones over time show they are neither popular nor profitable. This segregation will give us ample information on which items should be our focus areas while knowing how much margins they would generate. I expect to generate a turnover of about 60 lakhs in the first year with an increase of at least 3% each year. While this gives us the first mover advantage, we need to constantly re-engineer our menu. Also re-engineer, now also re-engineer to beat our competitors who may also start replicating our model and menu. Okay. So this is the second thing. This should be possible only if we have expert chefs and a team that can handle specialty dishes, catering to different customer preferences in a cost-effective manner. Popularity is also driven by the quality of food that we serve. High quality standards drive growth. So if we give high quality standards, it will drive growth. Periodic weekly quality checks will be required. External certification from government food inspectors and other recognized agencies would also be required. We need to keep a formal record of quality. So this is purely focusing on quality. Yes, quality has to be matched with the service. Ours is a customer-centric business. Hence, personal interacting with the customer should have good people management skills. Complaints should be handled in a professional yet personable manner, for which our customer-facing staff should be trained. So here we are talking about how should we handle complaints. If at all we get complaints from the customers, how should that be handled? Service also means that the orders given by the customer should be delivered correctly as per their expectation. Errors in order taking process, stockouts due to unavailability of material should be avoided. All of these are general business discussions. It should be our aim to deliver the food within 15 minutes after placing the order, and the food should be both warm and fresh. Rejected raw materials, customer rejections of food delivered also need to be tracked. Again, our formal record needs to capture these errors, inability to deliver orders, and delay. So basically, they're saying we need to provide good quality, deliver on time, deliver warm and fresh. If there are rejections, then you need to maintain a record of that. All of those things, especially with respect to quality parameters. COVID pandemic taught us an important lesson to maintain a robust supply chain that can deal with disruption. For critical resources such as raw material labor, our firm should have multiple partners who can provide for the requirement. Okay. Not just that, our internal process should make efficient use of resources. The order taking system and food delivery system should work in sync with each other to avoid errors and stock out. So order taking and delivery mechanism. Our core team of chefs should be adept means intelligent, smart, at minimizing waste and preparing unique dishes in an economical way. We need to build a kitchen infrastructure that can support this, providing them with appropriate space, machines, and tools for cooking and storage. As regards our marketing process, we may need to use technological solutions like social media platforms to reach out to potential customers. High staff attrition is a perennial problem in our industry. So staff attrition is high and there is a question on human resource. Expert chefs are our key to success. Should we explore the possibility of taking out a key man insurance policy on key employees, including the partners? This should not only boost their morale, but also help in retaining them. The specialty chefs may also enjoy working with us if we give them sufficient scope to innovate. So basically, how to retain employees is being discussed here. I'm excited at the range of possibilities this can offer. Let us get started. Okay. It was decided that Ajay would be in charge of restaurant operations, supply chain management activities like material, labor, procurement, kitchen operation, supply chain and quality control, and other daily business operation. Biryan will be in charge of finance, administration, and marketing. The vegetarian will be in charge of activities like negotiating settlement dates with vendor, procuring loans at effective rate. I don't know why did they say vegetarian. He would also be or something like that. I don't think vegetarian suits here. He will be in charge of promotional campaigns to build a firm visibility. Chand would continue to be a non-working partner, giving strategic insights if needed, additional capital infusion for any business needs. There will be separate departments created in form of proper organizational structure with clearly defined authority and responsibility. The periodic management of the menu, which will define the food choices based on the profitability, will be decided jointly by the three partners. The partnership deed is being modified accordingly to reflect the usage. Okay, so this is nothing much here. Right. So now, which of the following statements would not be true as regards to product pricing for the individual food items? Now, for individual food items, which of the following would not be true? First, standard costing techniques may be used to compute the cost of individual food items. The question is, would not be true. Would not be true. Now, can we use standard costing to compute the cost of individual food items? Yes. Second, target costing may be used for managing profitability of food items having popular close substitutes that are offered by competitors. Now, what is target costing? Target costing, you take the sale price, then you say, okay, this is my profit. Whatever is left over is my cost. Okay. Can we use target costing to manage profitability? Of course, yes. Then product pricing to be used to determine expected revenue for yearly budgetary planning, which can be determined based on relevant costing technique. Now, relevant costing technique is what? Where we say this cost is relevant, this cost is not relevant. Can we make budgets based on relevant costing? We cannot. Okay. So, we cannot determine budgeting based on relevant costing only. So, this is the wrong option, but the correct answer. Means which is not correct. This is not correct. So, this one. If the price quality perception or the unique value perception for certain food item is high, customers will be less price sensitive for those items. So if you provide quality, the price sensitivity automatically comes down, right? The third, fourth, and fifth you have already done. Sixth is taxation. Seventh, fresh food. Let us read this question again properly. Fresh food is in the service industry where it is essential to link strategy to the management of human resource. They want to have a framework based on the building block model to assess performance management. Using performance management system as proposed by the model, evaluate the following questions. So you have to evaluate the questions based on the building block model. Now, when we talk about building block model, a quick recap of building block model. And building block model, you have standards, you have dimensions, you have rewards, right? Now, this question is specifically on dimensions. Now, what are the dimensions? Dimensions are two parts, determinants and results. Determinant is something which will determine the result, and result is something which is the outcome. So, for example, determinant could be, let us say, innovation. Now, with innovation, your competitive performance can improve, right? So, determinants are the ones. Determinants are the ones which actually influence the results. That is one part of dimension. And the results are the one which is the outcome of the determinants. Now, outcome can be based on the financial performance, that is how you improve based on revenue, profitability, and all of those things. Second one could be how does this help you to improve in the competitive landscape, right? So, what dimensions of performance should fresh food measure? So, dimensions they're talking about. So, which dimension should we measure? We should measure the dimensions which are both financial which dimension should the firm measure? They should measure both the dimensions, that is your determinants and the results. In determinants, we have quality, flexibility, innovation, and resource utilization. In results, we have financial performance and competitive performance, right? So those are the things we have to see. Then, how to set standards for the dimensions determined. So what could be the standards? For example, financial standard, there was one number given, 18% return on investment. So like that, we can determine the, we can determine the benchmarks. Then what are the characteristics of reward systems needed to motivate employees to achieve the standards determined for fresh foods? Now, what do we need to do? What do we need to do to ensure that the employees are motivated? So what should be the characteristics of reward? Now, rewards can be in terms of, let's say, you motivate them, and the performance should be based on, let us say, controllable outcomes. So you will measure performance of employees only based on the controllable outcomes and not on the non-controllable outcomes. So you'll make someone responsible only for the controllable part. So for example, if I'm doing some work, I will be measured against the aspects of the work that I control. If I am responsible for teaching, let us say, financial reporting in this IBS paper, I will be evaluated only based on financial reporting. That is what is called controllability in terms of measurement, right? So let us understand and have a look at the answers for dimensions. Dimensions include financial and non-financial goals. Dimensions are categorized into results and determinants. Results are tracked as financial measures, competitive performance. So this we already discussed briefly. Determinants are tracked as quality, flexibility, innovation, and resource utilization. So first one under results is the financial performance. Right? Now here, what is the result expected in the partnership firm? The partners want profit. The partners want profit. Fresh food is a closely held partnership. This you can ignore. So partners are interested in earning profits that have been benchmarked at an overall return on investment of 18% each year. Now this is given in the question. They are expecting 18% return. Partners want to retain the current capital structure. They may take loan from bank for funding their expansion. So this is again talking about how will they source the money. And they have also mentioned that if required, the third partner C, Chirag, he will also contribute if required. They expect certain conditions to be laid down in terms of debt service ratio and interest service ratio that may need to be maintained for a period of the loan, period for which the loan is outstanding. So this talks about the financial results or financial outcomes. Now discussing about finance, profit margins are then talking about other financial aspects. So basically what we are doing in the overall financial performance, how are we evaluating or discussing what is the overall financial position, what is the financial result that is expected, how is the financial profitability and all of that. Profit margins in the industry are under severe pressure due to inflationary trends. Despite having leverage of charging premium prices to the customers, fresh food has to track the profitability very closely. So again, what are we doing in the financial measurement part? Overall basis, profits will be difficult to get, and also there is a risk that competition will come into the next part. Profits will be derived from periodic financial statements that get prepared as a part of accounting function. So how will we measure the profit? Accounting function by preparing P&L as per accounting, or by preparing management P&L as per management accounting. Other financial performance dimensions like gross profit ratio, net profit ratio, operating margin, ROCE, cash profit, changes in cash reserve, etc. So this we are saying how will we measure, right? First part. Then competitive performance. Fresh food wants to be a niche joint in a highly competitive segment. So here we are evaluating how does the competition look like. Okay, how do we stand against the competition? How is the overall competitive scenario? Right? How do we want to differentiate our product? All of that we'll explain in the competitive performance part. Their basis for competition is providing healthier food choices to customers based on vegetarian and vegan diet. So this is they're saying, how will they differentiate themselves from the customers? However, comparison of peer performance is restricted on account of limitation in terms of availability of information due to the unorganized nature of food industry. We want to do this. How do we check ourselves against the competition? We don't have enough information. At the same time, to begin with, one of the measures that can be helpful will be the utilization of the 50-seat capacity at the restaurant and the capacity utilization at 90%. That will actually help them to see how are they performing as compared to competition. In due course, based on popularity and profitability of the venture, it can consider expansion. Segregation of its offerings into various classes would help the management identify a good mix of popular and profitable items. Since the restaurant is proposed trendsetter within the industry, it will retain a competitive edge until its peers start replicating the same. As this segment develops within the industry, one other measure for competitive performance could be re-engineer the menu to maintain the variety and uniqueness as compared to its peers. Information to develop a robust menu offering could be gathered from published research sources like trade magazines, etc. So this is an additional item what they have mentioned. Generally, the competitive landscape. Now, you may have a doubt. So, do we need to write so much? It purely depends on the time that is available to you at that point of time, because you have 1 hour to answer one case study. Okay. In that 1 hour, about 10 to 15 minutes will go off in your reading case studies and all of that. Then you will have to answer the MCQs. Then whatever time is left, we will divide according to the marks and then write the answer. Just because the material has given such lengthy answers, if you have to copy this itself will be 2 to 3 pages. Okay, so please be mindful. Then comes to determinants. Now, what are determinants? Determinants are something that influence the result. For example, quality. If I provide good quality, I can attract more customer. If I get more customer, my revenue improves, right? So that is a determinant. So as far as quality is concerned, so what are the different dimensions? Quality, flexibility, innovation, and resource utilization. As far as quality is concerned, firm is focused on offering high quality food to its customer. High quality standards drive growth. Periodic weekly quality checks, external certification. So all about quality from that paragraph, you can actually modify and you can write. Fresh work should focus on both product and service quality parameter and continuously work on improving them. Innovation. Now here innovation is what? New menu, doing vegan and vegetarian diet. Hey, healthy and delectable vegetarian and vegan food choices is the unique selling point of fresh food. This requires innovative efforts from chefs, segregation of menu into various classes based on popularity and profitability would help management identify food choices to focus on. As I told you, innovation has to be constant. So that is the part related to innovation. Then flexibility. Now in flexibility, what do we see? They have to change menu as per the changing taste and preferences of the customer, right? They cannot say that, because we have decided this first menu, this has to continue as it is. As and when you see that, yes, the customers are wanting something different, customers have different food choices, there you have to ensure flexibility. And not only that, you also need flexibility in operations, the way you operate, because you want to scale up in the future subsequently, right? There also you need to show flexibility. Now, how are they trying to get flexibility in operations? They're trying to get by having multiple partners and high quality chefs. Growth in scale of operations combined with a competitive business environment implies that the firm should have some flexibility in its operations. The ability to build a robust supply chain that can deal with disruptions is very important for continuity of business operations as well as future growth. So one part is how will they cope up with sudden changes or higher requirement in business operations. Then for raw material labor, the firm should have multiple partners. Appropriate investment in infrastructure in the kitchen, design and decor of the restaurant should be done to build flexibility in operations. Then menu should be changed. There also flexibility is needed. All of these things you can. Then lastly, the resource utilization. Resource means how efficiently are we using the resources. So resource utilization here, it could be in terms of chefs. Here it could be in terms of your waiters. Then in terms of delivery. How can we efficiently utilize our resources? Also, how do we minimize the wastages? There is a point in the case which said chefs should be in a position to minimize the wastages. The ability to deliver food within 15 minutes of placing the order requires high level of coordination of order and food delivery system. Errors in order taking process, stockouts due to unavailability of material should be avoided. Not just this, chefs have to prepare the food, economizing the cost and minimizing food wastage. They would not just require skills, but also right tools in the kitchen to make this happen. Some non-financial indicators to be tracked can be overtime, idle time of kitchen, ordering and delivery staff, turnaround time, table occupancy rate, breakage and wastage of material. See now, these few things are given, few things you have to add on your own based on your understanding of the industry. Right? Then coming to the next part, which talks about the standards. Now, standards in the benchmarking model is divided basically into three parts, right? Those three parts are equity, achievable, and ownership. So, talking about ownership, who owns the entity and how is the organization structure formed, right? That is what talks about the ownership. And when we set standard, the employees to whom the standards are being given to, whose performance measure would be evaluated, they must own it. So that talks about ownership. A clearly defined organization structure with well-defined roles will help the company assign authority and responsibility amongst its staff. This creates ownership for different functions. So basically, each staff owning their work and their targets. Okay, so ownership here is being responsible for results. Ajay in charge of restaurant operations, Biren in charge of finance administration, while Chand is giving strategic direction and capital infusion, clearly defines the roles of each partner. So for each partner, there is a clearly defined role. They must now decide on key performance metric that will help them to rank the business performance. Ajay, representing the concerned departments like kitchen and customer service, will be accountable for the quality of food. Ajay is accountable for quality, stock out, supply chain management issues, etc. Biren in charge of marketing will be in charge of generating maximum coverage for the business through social media, promotional campaigns, conversions of potential customers into actual customers, etc. Similarly, ability to get maximum credit period from suppliers, managing loans at effective interest rate, etc. will be performance parameters for regarding as far as performance parameters for Biren regarding the finance function. Now, when we talk about Ajay being in charge of quality, this impacts the quality dimension. Same way, resource utilization dimension for Biren, flexibility dimension for your Biren in terms of getting higher loans, also financial performance. So those are where the standards are related to dimensions. Then achievability, benchmark and targets will be useful only if they are achievable. Being a partnership firm, each of the partners have a stake in the performance of the firm, and they would have to have they need to have a clear understanding of the benchmark. So they have to be achievable. The actual results must be achievable. For example, some parameters like quantity sold and turnover of food choices under each of class A, B, C, D categories can also be tracked. So these are things additionally tracking to ensure that the goals set are achievable. Benchmarks can be set as to how many new food choices have been developed. So how many new foods have been developed. Then you can put benchmarks like what is the average delivery time, turnaround time, rejections ratio, multiple things which are there which can be set. So how many new food choices and how many have been class A, that can be given. Chand can give inputs as to whether these benchmark and targets are aligned with the firm's overall strategy. If the target is set very high, the staff can get demotivated. If too low, they will not raise the bar on performance. So we have to set up balance. Okay. Then equity. Equity means the benchmark should be equally challenging for all parts of the business. Means there has to be equitable distribution. It is not that only category A food items and chefs for them, only they are challenged or only they are burdened with responsibilities. Others are not. That should not happen. So you'll explain what is equity. They should customize its performance measure for each function like kitchen staff, order, customer service staff, finance, advertising staff. For example, while turnaround time to meet customers' order would be relevant metric to the kitchen, the effectiveness of the promotional campaign would be the relevant metric for the marketing department. So you give equitable responsibility and the measures also should be equitable. They should not, no business or no component in the business should feel that I am taking extra burden because of me, the business is running. That should not. While Ajay and Viren are working partners, they should not view Chand, the non-working partners, as non-contributory resource, because Chand equally has high stakes in the business performance because he'll contribute capital and he will also have strategic inputs. Then the third question was on rewards. As far as rewards are concerned, we have to see what should be the characteristics of the reward. So reward should motivate you, they should be clear, and they should be controllable. Again, so in this type of question, when we talk about, let us say this, the building block model, what you have to do is you have to explain the theory at least in 2-3 lines, apply the theory to the scenario. That is what will help you to score the marks. So motivation, does the reward system drive people to achieve target? Does it motivate you? It is mentioned that high staff attrition is a perennial problem within the industry. So a low reward system for the sake of keeping costs low would not include staff to work towards the goal. So that is very, very important. While some part of the compensation may be fixed, other parts can be made variable. So there could be a fixed compensation, there could be a variable compensation. For this, the performance measurement indicators have to be communicated and understood by the staff. So there should be clear communication and explanation of the performance measure. Bonus of the marketing staff can be aligned to the sales generated. So this is what will make them motivated. Chefs can be rewarded bonus based on turnover generated by the various categories of food choice as well as qualitative measures. Key man insurance and key personnel is also a way of motivating. Better job prospects in a growing environment would also be good motivator. Fresh food plans to hire specialist chefs who have scope for innovation within the business mode. So they want to hire specialist chef who can do innovation. So when you allow them to do innovation, then they will automatically be motivated. Similarly, customer facing staff are going to be given periodic training on customer management. Management should track various metrics in this regard. Reward and recognition system should be good motivator. Then clarity. It should be clearly communicated. What is your compensation package? How much will you be earned? How will your performance be measured? All of that has to be clearly communicated. And controllability. Now, controllability is very important because you should measure the performance of an employee based on the factors that they control. You should reward an employee based on that. You should punish the employee based on that. So, unlike the traditional understanding, rewards need not be based only on financial element that the staff can control. There may be non-financial elements for which rewards can be given. Both aspects, however, need to be controllable by the staff concerned. So you have to put a reward system only according to who controls the outcome. For example, chef can come up with a popular menu. If the pricing of the product managed by the partners is such that it results in a loss to the fresh foods, the chef may not get much deserved bonus. This is not a good reward system. So what this basically means is, chef has come up with a good menu, but pricing decisions is based on the partners. Menu may be good, food may be good, cost may be appropriate, but if you keep the prices low, you cannot say, chefs, because of you we have lost. So that is where controllability comes into picture. Now, in this type of question, as I told you, what you have to do is explain briefly and apply briefly to the scenario. Okay. So, any more doubts? Any doubts in this? I think it's a straightforward thing. We'll meet the next day with another case study. Let's have a look at the next case study. This is case study number 26, and this is on a company called Mantrupti Limited. So, as usual, again, first look at the questions. First, in case of MTL, amount of cost of insurance would be determined as this is related to your customs. Then, can management of MTL present the third statement of P&L as an additional comparative in general purpose financial statement? Now, this we have already understood as per Ind AS. You can present if you want to. Okay, there is no restriction, right? So you can present. Now, this answer is not dependent on what is given in the case study. Now, first we have to eliminate which of the following is the wrong answer. So no is not the correct answer. So this will definitely not be the correct answer. What will be the correct answer is one of these three. First, yes, an entity may present comparative information in addition to the minimum comparative financial statement as required by Ind AS, as long as that information is prepared in accordance with Ind AS. However, entity shall present related note information for those additional statements. This is the first one. Second, yes, but an entity shall present comparative information as at the beginning of the preceding period in addition to the minimum comparative financial statement. Now here,
one thing what we have to understand is if you have to prepare a third financial statement, it has to be in compliance with Ind AS. Okay, so this does not talk about this, whereas this talks about this. And lastly, yes, an entity may present comparative information in addition to the minimum comparative financial statements required by Ind AS, as long as that information is prepared in accordance with Ind AS. The entity does not need to present related note information for those. Now, do we need to give the note information? Yes, we have to give. So this is also not the right answer. Option A is the correct answer. Right. So such kind of questions are actually our bonus questions, which we can answer even without looking at case study. Then, can management of MTL present such third statement of P&L only as additional comparative in the general purpose financial statement without furnishing other components like balance sheet, statement of cash flow, statement of change in equity of the financial statement? Now, what is this question asking us? The question is saying us the entity wants to present 3 P&Ls. We'll present 3 P&L, but for other statements, we'll present only 2 statements. We don't want to present other statements like balance sheet, statement of cash flows, statement of changes in equity. Now here, what we need to understand is what does Ind AS require us to do? If you're presenting 3 P&L, you also need to follow it up with remaining statements, 3 balance sheets, 3 statement of cash flows and other aspects. So the question is, can they present only additional comparative P&L without furnishing other things? The answer is no. So either this or this. This is not the answer or this. Okay, first. In such case, a complete set of financial statement need to be presented with respect to such third statement of P&L in addition to the minimum comparative financial statement required by Ind AS, as long as that information is prepared in accordance with Ind AS. So this is the correct answer. Second, the other options, let us see. An entity cannot present only such comparative information at the first place in addition to the minimum comparative financial statement required by Ind AS. So the question of furnishing other components does not arise. Now, what are they saying? We cannot present such comparative information at the first place. They're saying you cannot present the third balance sheet. Is that the answer? That is not the answer. Then, in such case, a complete set of financial statement need to be presented with respect to the third statement of P&L in addition to the minimum comparative financial statement, as long as that information is prepared in accordance with Ind AS. However, the entity may present related note information only for the P&L. See, we have to give everything in completion. So this option is also not right. Option A is the correct answer. See, even without looking at the case studies, we are able to solve the questions. Then MTL is required to file the financial statement through XBRL. This is related to a corporate law. Then, in the coffee and tea industry, which factor represents potential challenge of existing competitors intensifying their rivalry by innovating and differentiating their products, thereby posing a threat to MTL markets? Yes, so again, this question you can answer directly without looking at the case. Now, what are they saying? Existing competitors intensifying their rivalry. Where do we get this intensification or intensity of competition, rivalry of competition? Where do we get that? We get that in Porter's 5 forces. Now they're saying whether it is bargaining power of suppliers, bargaining power of buyers, threat of new entrants, so competitive rivalry. Nothing to discuss. Competitive rivalry, the correct answer. Right? So we are done with the MCQ questions. See, sometimes if such kind of straight questions are given, it becomes easy for us to score marks in the examination. Now, descriptive, explain the rate of duty. Okay, this is related to your customs. So this entire thing is related to your indirect taxation. Analyze issues involved and give your views on whether or not the auditor could accede to the request of management. This is related to audit. How do external market dynamics impact Mantrupti Limited's strategic choices and competitive stance within the coffee and tea industry? Consider aspects such as the level of competition amongst industry players, influence of suppliers and buyers on operations, potential threat by new market entrants, and the availability of substitutes. How these factors shape the market positioning and strategic decision in response to industry challenges and opportunities. So the question is directly saying use Porter 5 forces model. Directly they're saying use Porter's 5 forces model. Now, what are the 5 forces model? What are the aspects? You have to see what is the bargaining power of buyers, what is the bargaining power of suppliers, threat of new entrants, substitutes, and competitive rivalry. Right? Now, in these 5 factors, we have to evaluate with respect to the company. So what we'll do is we'll quickly glance through the case, what is the scenario and all of that, and then we will see how do we structure this particular answer.
In bustling heart of Kolkata, West Bengal, lies MTL, an unlisted public company established in 1994. They have carved a name for themselves as a distinguished manufacturer and retailer of diverse selection of coffee and tea powders, catering to a discerning clientele across India. So they are into tea and coffee. Now, as far as we have seen the question have been more direct on the customs duty part. It has been more direct on the auditor's request, management request, and also on the porter's 5 forces. That's a direct part that you have to focus on. They take pride in state-of-art processing and packaging facility. They source finest coffee beans and tea leaves from around the world, meticulously selecting them for quality and freshness. The rigorous production process adheres to stringent quality control and control measures, ensuring that every cup of coffee or tea brewed from their powders delivers an exceptional taste. The unwavering commitment to quality has not only earned them the trust and loyalty of their customers, but also has established them as a leading brand in Indian coffee. So here also, there is nothing much we have to focus on from the answer point of view. Understanding the evolving preferences of their customers, MTL offers a comprehensive range of coffee and tea products. Their portfolio encompasses classic instant coffee blends, aromatic loose leaves, selection of flavor varieties. So they are continuously innovating. So here also there is nothing much. With the vision to establish a strong national presence, MTL is actively expanding its distribution network. They are forging partnership with leading retailers and supermarket, making their products accessible to a wider customer base across the country. Additionally, they are exploring strategic collaboration and international trade opportunities to broaden their market reach and solidify their position as a prominent player in the global coffee and tea market. Okay? Their ability to source the finest coffee beans and tea leaves from around the world gives them leverage in negotiating favorable terms with their suppliers. So, because they have the ability to source the finest coffee beans and tea leaves from around the world, they can negotiate favorable terms with their suppliers. Means the threat or the bargaining power of supplier is not high. Okay, so that is what this sentence is trying to tell us. So the suppliers don't have a great bargaining power, whereas this company can bargain better with the supplier. So bargaining power of supplier is low. The companies has a good bargaining power with the supplier. Their meticulous selection process for quality and freshness further strengthens their bargaining position, potentially enabling cost savings and ensuring consistent product quality. However, the bargaining power of buyers cannot be overlooked. Despite MTL's reputation for delivering exceptional taste experiences and its diverse product range, catering to various preferences, buyers still will influence, particularly if they have alternative suppliers to choose from. So buyers are exercising or have some kind of power over the seller or over the company. Therefore, MTL must carefully balance its pricing strategy and value proposition to maintain customer loyalty while safeguarding the profitability. So basically, buyers have some bargaining power. In the competitive landscape of coffee and tea industry, MTL faces significant rivalry from both an local and international play. Means the competitive rivalry is high. The intensity of competition is high in this industry. With numerous competitors vying for market share, intensity of competition is palpable. Palpable means, it has, so when they say when they say palpable, it is basically, when you have to fight a lot or you have to run a lot and you don't get breath, that is what that means. Established brand as well as emerging players constantly strive to differentiate themselves through product innovation, pricing strategies, and marketing initiatives. MTL's strong brand reputation, diverse product range, and commitment to quality position it well amidst their competitive milieu. However, the potential for price wars and aggressive marketing tactics loom large, posing challenges to maintaining profitability and market share. So there is a huge competitive rivalry, and they have said what they would do. They have to leverage its strength, state-of-art processing facility, customer-centric approach, etc., to protect their position. But here we are required to write what are they facing in this given scenario. On July 1st, they imported consignment of coffee. So this is related to your customs. Okay, so as you answer customs, you can focus on this. MTL is an Ind-AS compliant company. It has paid up capital of 5 crores and turnover of 500 crores, presents financials for 3 years. This MCQs we have already answered, so we don't need to worry about this. MTL is required to file XBRL, that is related to XBRL. The management The management of MTL on analysis of additional information. So this basically is related to this paragraph only. Analysis of third year statement. It was observed that issued debentures in 21-22, which were to mature at the end of 5 years. They were given an option of one-time payment of 50 per debenture on account of interest, which was to be immediately paid by the company. As per the option exercised by the debenture holders, company paid interest upfront to them, and the same was claimed as deduction in the return of the company. This is related to income tax. Interest was shown as deferred revenue expenditure. Okay, we don't have any account specific question on this or accounting specific question on this. This could be related to audit. DRT are the auditors, so this paragraph is for auditor. To a query to CFO, they inform that the amount has not been recognized in audited financial statement, something related to this. They amended the accounts, approved the same. So basically, all of this part from here till here would be your, this is XBRL till here onwards. This is for your auditing question, right? Now, what are we required to do? We are required to evaluate as far as our strategic cost management and strategic performance management is concerned, the 5 forces model. Now here, competitive rivalry, they have directly told that competitive rivalry is intense. Bargaining power of supplier is low. Bargaining power of buyer is moderate, not very high. Then threat of new entrants. New entrants have come into the business, so that is high. Threat of substitute is also high because something like tea and coffee, buyers have lots of choices. So there is a lot of threat of substitute, right? With this understanding, let us see how to present the answer. Bargaining power of buyers. The bargaining power of buyers in the coffee and tea industry is moderate, while MTL commitment to quality and diverse product range attract customers. So there we are saying the company attracts the customer, but buyers still wield influence, particularly if they have alternative suppliers. This is directly taken from your case study. Okay. Price sensitivity and availability of substitutes can also impact buyers' bargaining power. MTL must balance pricing strategies and maintain customer satisfaction to preserve the market share. So what did they say? First, they said, what is the bargaining power of the buyer? Then they said, why is the power moderate? Then they gave a recommendation on what can be done, right? Then bargaining power of supplier. MTL's bargaining power with supplier is relatively high. Now, don't get confused. Here we are not saying that supplier's bargaining power is high. So in actual correct way of doing this is the bargaining power of supplier is low. That is how you have to present. Okay. Because its ability to source the finest coffee beans and tea leaves globally. The stringent selection process for the quality and freshness strengthens their position, enabling them to negotiate favorable terms with the supplier. This is as per the case given. However, fluctuation in global commodity prices and dependence on specific suppliers could pose challenges and impact MTL's cost structure. Now here, because this is not a problem, we don't give any specific recommendation. Then, the threat of substitutes in the coffee and tea industry varies depending on customer preferences and trends. Coffee and tea have enduring popularity. Substitutes such as soft drinks, energy beverages, and health-focused alternatives pose a moderate threat. So now there are two things. One is substitute for the product of the company. Second is substitute for tea as such. So both aspects you should be covering. As far as tea and coffee brands are concerned, there are not many other substitutes available. As far as other beverages are concerned, if somebody wants tea, tell me, no, they would want tea. If somebody wants coffee, they would want coffee. Okay. MTL can mitigate this threat by emphasizing the unique taste, quality, and experience offered by its product and innovating. Then, threat of new entrants. They present a moderate threat of new entrants for MTL. Then again, why? Because the market is accessible due to popularities of these beverages. MTL established brand reputation and extensive network and investment in state-of-art processing facilities acts as barriers to entry. Now, this technically is not a barrier to entry. It is more like, though new players may come, we can still fight. We can still survive in the competitive market because we have existing state-of-art facility. We have good distribution network. Innovative startups or established players from related industry could pose a potential threat by introducing new product or leveraging existing resources to penetrate the market. So there is definitely a threat. Now, what should the company do? The company should continuously innovate. The company should continuously be in the liking of the customer to survive this particular threat. Then competitive rivalry, they have said it is intense with numerous local and international players. Again, this comes directly from the case study. Vying for market share, established brands and emerging startups continuously innovate to differentiate themselves to product offering, pricing strategies, and marketing initiatives. MTL's strong brand reputation, diverse product range, and commitment to quality position it well amongst the competition. So it is in a good position. However, price wars and aggressive marketing tactics remain potential challenges requiring MTL to adapt and innovate. So this directly has been picked up from the case study text. Now, how do you answer in this type of scenario when you have to apply a model? See what are the various dimensions of the model. Then how much can you explain about that particular dimension? So for example, here you could add more about what is the meaning of bargaining power of buyer, what is the meaning of bargaining power of supplier, what is the meaning of threat of new entrant. Then pick up relevant information from the case and then present the answer, right? So that is how you have to approach. Let's look at the next case study number 28. This is with respect to BL Limited. Again, let us quickly have a look at the question. First is on EVA, economic value added. Then we have income tax. Then we have something on SCM. BL Limited has developed 8 new drug formulations in the current year. Which of the following performance indicators will be appropriate to measure the CSF for developing commercially successful innovative drug formulations? Okay. Now, what are they asking? Commercially successful innovation. So we want commercially successful new drug innovation, and for that, what should be the proper critical success factor? First, percentage of profit earned from launch of new drug formulations. Yes, new drug formulations, it is talking about percentage of profit, and we want commercially successful. Now, when we say commercially successful, it has to be commercially successful, it has to be profitable. Then, number of new drug formulations launched. This talks about new drug, but does not talk about commercial success. Investment in R&D. Investment in R&D cannot measure how many new drug formulations have been developed. Market share of the company again is independent of new drug formulation. So commercially successful is given by the first one, right? Then this again, you can directly pick it up from the answer. Then using the balanced scorecard framework, link performance measures to the 4 business perspective. So in balanced scorecard, we have the financial perspective, customer perspective, internal business, and learning and growth. First, improve EPS and share price by 15%. This is to do with financial perspective, straightforward. Enter new market segments where existing drug formulations can be sold. So you want to enter into new market segment where existing drug formulations can be sold. So you want to expand. Okay. So is it learning and growth? Not learning and growth. Is it internal business perspective or customer perspective? Right. Now this, it cannot be learning and growth for sure. It is not also to do with business process. It is about reaching more and more customers. But still, if you are confused, if it is not very clear, you can look at other combinations and then come back. So one goes with D. So when one goes with D, so this option is ruled out, this option is ruled out. So 2 goes with C. So see, directly we can say 2 goes with C. Then it is about 3 goes with what? Improve production capacity by 30% in order to support increased sales in the new market segment. So you want to improve the production capacity. You want to improve the business process. So 3 will go with B and 4 will go with A. So option C is the correct answer. Then BL Limited has identified a critical success factor for its organization. Have an excellent quality product. Which of the following would be the most suitable key performance indicator? So we have a success factor. We need the performance indicator for that success factor. Reduce the number of defects identified by quality control in customers by 15%. Reduce the average time taken to deal with complaints about quality by 10%. Now, what is the CSF? Excellent quality product means at the beginning itself, the quality has to be excellent. Okay. Now, if I reduce the average time taken to deal with the complaint, this does not talk about quality. This talks about after sales service. Increase sales by 15%, not related. Increase the number of training hours. Again, that does not directly say that the quality has improved. So only thing which says quality has improved is option A. That is the correct answer. See, all 3 questions, without looking at the case study, we are able to solve, right? And the remaining questions are based on EVA and towards your body. Okay. Moving to the next case study. Case study number 29. Here, again, let's quickly jump to the questions and then we'll come back. First is on website design audit, tax audit report. To ascertain the taxability of supply of services, GST. Remedy available against the order passed by assessing officer, again, related to taxation. What kind of technology advancement is represented by the scenario involving RFIN, bank's implementation of a blockchain-based system in partnership with the bank? So this is to do with the blockchain system. Okay. Now, when you use the blockchain system, what do you get? Now, we have to see in what context have they used this blockchain system. Then calculate the NFs to do with AFM. Connection with the bank, provide some steps for performing audit of blockchain system. So this, I think, you would have covered as a part of audit itself. Compute the cost of inventory of GMSPL. Substantiate your answer with appropriate reasons and calculations wherever required. So this is the part which I have to deal with pertaining to FR. Inventory. It is slightly descriptive and it is good to have an understanding. Okay. So here is the thing. Mr. Ravi, the manager of RFIN Bank, gave an order to GM Stores Private Limited on 1st of January for 1,000 custom-made corporate gifts to be provided to their prestigious corporate clients about blockchain systems. Some information is there. Okay. On 3rd January, GMSPL purchased raw materials to be consumed in the production process for 6,50,000. So you have to highlight raw material 650. Okay, raw material 6,50,000. Including 50,000 refundable purchase tax. It is including, so you will remove the refundable taxation. Okay. Then the purchase price was funded by raising a loan of 6,55,000, including 5,000 of loan raising fees. The loan is secured by inventory. Now, inventory, does it take substantial period of time to get ready for its use? No. So this part you will ignore. During January 2024, GMSPL designed corporate gifts for the customer bank. Design cost included. Cost of designer 6,000, labor 4,000. This we will include 6,000. So here also it is 1,000. Here also it is 1,000 and 4,000. Okay. During Feb 24, the production team developed the manufacturing technique and made further modification necessary to bring the inventories to the conditions specified in the agreement. The following costs were incurred in the testing phase. Materials net of 3,000 recovered from the sale of scrapped output 21,000. So cost of material 21,000. Then labor 11,000. This is cost of building that system or design prototype. Depreciation of plant 5,000. Okay, right? So 21 plus 11 is 32 plus 5, 37. This is also included. Then during February, GMSPL incurred the following additional cost in the manufacturing of the gift. Consumable stores you will add, labor you will add, depreciation you will add. Customized gift were ready for supply on 1st March of 24. No abnormal wastage occurred in the development. So here what is to be done? All these costs you have to include 650, 50, 6,000, 4,000, 21, 11, 5 and 55, 65 and 15. Right? So if you look at the solution, it's 6,55,000. Loan raising fee is not included, and it will also not be, the borrowing cost will also not be included. Cost of conversion, yes. Production overhead, yes. Depreciation, 10,000 design, 37,000, part related to this prototype building that we have calculated. That was this 21 plus 11 plus 5. Right, all of these costs included makes it 7,82,000. A simple, question. If, they ask this for, let us say, 5 marks, 6 marks, you should be able to score the marks here. Let's now look at the next case study number 36. This is with respect to Stalin hotels. Okay, so they have budget hotels, they have comfort resorts. Okay, so let's look at the question first. For the budget properties, identify the listed activities to the 5 primary activities of Michael Porter's value chain model. So they have given activities. You have to classify them. Which of the, which activity falls under which category of primary activity? Right, that is what we have to answer. First, storing vendor delivered freshly laundered crockery, bedding, and laundry for future use as per guest requirement. So the vendor will deliver the products, the washed clothes, utensils, and all of that. You are storing it. Now, the storing part of it, Now, as far as the Porter's 5 forces are concerned, we have inbound logistics, we have operations, we have marketing. Now, as far as Porter 5 forces are concerned, we have inbound logistics, we have operations, we have outbound logistics, then we have marketing and sales, and then we have service. Now, this is what vendor is delivering. So it is a part of inbound logistic. So A goes with 3. So if A goes with 3, this option is gone, this option is gone. We are left with these two. Now here if you say B is with 1, B is with 1. C, D and E is where we have to decide. So B, it is very clear. Ensuring cleanliness and safety of rooms, working order of facilities offered like TV, etc. This is related to your operations. Review of food items to remove the ones past expiry to ensure customer satisfaction and safety. So that is that is one way you have to review the food items and remove the ones past expiry. So whatever is not needed, you have to remove. Okay. So that would most likely fall under outbound logistics. Free shuttle service to attract guests to stay at the hotels, and front desk activities handling complaints and customer support. So complaints and customer support is a part of your service, and free shuttle service to attract guests is a part of your marketing and sales. So D goes with 2. So if D goes with 2, option B is the correct answer. As regards to stay in comfort resorts, the parameters relating to high quality cleanliness and food service can be classified under which attribute of the following under the Kano model? So in the Kano model, you have things like, the threshold attribute, indifferent attribute, delight attribute, right? Which one does the parameters relating to high quality cleanliness and food service can be classified? So we have to see the comfort hotel, how they serve the customer, and then we can decide. Resolution of board, this is related to corporate law. EVA, like an AFM. Then which of the following statements would be true with respect to EVA? Then risk of outsourcing cleaning and food services for the luxury resort properties. So what are the risks of outsourcing? Now when you provide outsourcing, when you do outsourcing, what is the risk? What would your suggestion be if the management determines that guest experience primarily influenced by cleanliness of facilities and food service is a very important CSF? Then what would be your suggestion? We have to read the case. How is the risk different from outsourcing cleaning and food services for stay in budget hotel properties with that of stay in comfort resort? Now what you have to understand is, as compared to a budget hotel and a comfort resort, the expectations are higher, right? So accordingly, we have to see. What benefit does stay in limited derive by operating different properties under 2 separate brands? So these are the 4 brief questions, most likely for about 8 marks or 6 marks. 8 marks is what I would expect for 4 into 2. Then identify the total cost to be capitalized under IAS 16, property, plant and equipment for stay in comfort resort being developed in Goa. This is a standard question. Okay, so we are done with 1B. Now let's see about for stay in comfort, parameters relating to high quality cleanliness, under which Kano model does it fit? So we have budget hotels. They operate as budget hotels, operate under the brand Stay in Budget. It provides accommodation for cost conscious travelers visiting the city for short stay lasting for a day or 2. Typically, a room in Stay in Budget hotels would provide comfortable beds, high speed internet connections, air conditioning facility, coffee machines, fridge, and free television service. Food service based on a limited menu is provided on the premises. So very, very basic stuff. It has few conference rooms that provide space for guests to hold meetings. This saves them time otherwise wasted in traveling in congested city roads. They provide free shuttle service to and from the airport. Oh, so service shuttle is from airport. Okay, that's how it was a part of marketing. Proximity to the airport, free shuttle service, and convenience of conducting work at the conference rooms have been marketed to attract the guest. The guests also comprise of people who are in transit between airports, also when there are long duration delays in flight operations. So this is about the budget hotel. In all, Stay in Limited has 15 hotel properties spread over 15 cities. All of them function under Stay in Budget brand, creating to cost conscious travelers. In all these establishments, since the location of the hotel is near the airport, real estate cost both for ownership and rental is high. Hence, instead of having an in-house establishment for cleaning and food service, the company has outsourced these services to specialized vendors. So the reason why they're outsourcing is maybe they don't have space to do it in-house. This will reduce additional space requirement needed to maintain the facilities to provide these services. This will keep the cost of operations within control. Since the hotel property is in the city, there is ample availability of vendors providing this service. Cleaning services includes cleaning of kitchen crockery, bedding, laundry, and housekeeping of premises. Similarly, the entire set of activities related to preparation of food has been outsourced. Food also has been outsourced. Vendor service has been satisfactory, barring few instances where guests have complained of unhygienic rooms or non-palatable food service. However, due to high guest volume and quick turnover of guests due to short stay period, this has never been the issue in the business. The business has been profitable. They have sizable market share. Competition has increased in the past. Price wars have put pressures on profit margins. Room rates are increasingly being determined by the market. Okay. Then comfort. Management plans to continue to operate in the budget hotel to maintain its market presence. At the same time, to sustain business in the long term, the management of Stay In Limited has forayed into developing properties for luxury resorts under a separate brand called Stay In Comfort. Target guest segment are vacationing tourists interested in enjoying a laid-back time at scenic places. These guests would not mind paying premium for availing good quality service. Maintaining cleanliness of premises and food service are critical activities in the operations of luxury hotel. Now, there's one question which talked about cleanliness. For comfort, so that is a luxury brand, related to cleanliness and food service is which attribute? Is it performance, delight, threshold, or indifferent? See, delight means I'm not expecting, but I get. Okay, so that is delight. It is not delight. Customers are expecting. That is a basic performance attribute. So, then, is it a performance attribute, threshold attribute, or indifferent attribute? Indifferent means customers are not bothered whether you give or not. So this also is not right. This is something which the customers want bare minimum. That is their threshold requirement because they said it is an important part of it. So threshold becomes the correct answer. Right. Now coming to the other questions, here it talks about outsourcing comfort for comfort luxury resort. Then moving on. Unlike cities, the location of this resort is in more sparsely population. Sparsely means less populated areas. While these are vendors providing cleaning and food services, there are very limited options. So it is away from the city. Customer satisfaction is paramount, very important to sustain and grow business in the luxury resort segment. With the ability to post reviews online on booking portals, any negative review can reach very easily to a large number of guests. This can negatively impact the future business. Stay In is developing property in Goa. Below are the expenses. For this, we have to calculate as per Ind AS 16. Now, moving further, property is acquired from an unrelated party. Then this is about the board meeting. Then operations started as per expected timeline in the third year of operations. And the following information is made available with respect to your operating and all of that. This will help you to calculate your economic value. Right. Now, coming to the questions. First, the risk of outsourcing cleaning and food services for Stay In Comfort luxury resort. Now, there are multiple issues. First, there are limited number of vendors providing those service. If the vendors do not provide great service, then there is an impact, or there could be an impact that customers post negative review about us online. And if they do that, it can actually be a problem. If they do that negative publicity, it can actually be a problem. So your answer should be around the risk. Risk of outsourcing is the vendor may not do a great job. We have limited vendors. The customers are expecting cleanliness. See, if you travel by train and if you stay in hotel and you don't get clean sheets and all of that, it actually is a huge nuisance to a lot of travelers. So that is the risk involved. Okay. And because it will be most likely a 2-mark question, don't write one full page. Okay. Don't write one full page. Half a page is more than sufficient. Then what would your suggestion be if the management determines that guest experience primarily influenced by cleanliness of facilities and food service is a very important CSF? Now, if cleanliness and food service is very important CSF, should we outsource them? Because when we outsource them, there is a risk. It is better to keep them in-house, especially for the luxury category. Keep them in-house so that you can control the quality, because that is a CSF, that is a success factor. If that is the most important factor, we should not be outsourcing. So your answer should be around those lines. Then, how is the risk different from outsourcing cleaning and food service for the budget hotel as compared with that for comfort resort? Now, for budget hotel, even if there are 1 or 2 negative reviews, because the customer turnover is high, customers stay for 1 day, 2 day, for a lesser number of time, it does not impact the brand much. Okay. And they are budget conscious, so you don't expect a lot of things. Like, if you are budget conscious, you don't expect a kind of 5-star service. But if you're staying at luxury, if you're expecting luxury, if that is the threshold, then you're expecting much, much more. So that is why the risk is different, because even if the vendors provide some low quality service or one odd case where the quality is not appropriate, the budget customers will not mind, whereas the comfort customers will mind. So that is the problem. What benefit does stay in limited derive by operating different properties under 2 separate brands? Now, when you operate 2 properties under 2 different brands, the customer expectation is very clear. What you're telling to the customer is, if you come to a budget hotel, you will get budget services. If you come to comfort hotels, you will get comfort services, or you will get luxury services, right? Then, if you are operating in a budget hotel, the target customer is different. If you are operating for a luxury hotel, luxury resort near the holiday places, the target customer is different. That is the second thing. Then one more impact is, if a customer leaves a bad review, for example, for the budget hotel, that will not impact the luxury traveler, because the luxury traveler is not looking at the budget hotels, right? So that is how different brands, most of the companies do. Premium brand and economic brand, they try to keep it separate. Okay, so let's have a look at this answers, how to write. Risk of outsourcing cleaning and food service under the luxury resort model. In luxury resort, the target guests are travelers on leisure. The primary model would be good quality of service. Maintaining cleanliness of premise and food service are critical activities. Therefore, customer satisfaction on this metric is paramount to sustaining growth of the business. So this is coming from the case. With the ability to post reviews online on booking portals, any negative review can easily reach a large number of potential guests. These can negatively impact future business, and staying comfort brand has to deliver the quality of service that it provides in terms of cleanliness, right? So this is the background. Now, if you write this itself, it will be 1 page, not 1 page, maybe 3/4 of a page. So don't write too much. Just summarize that and write. Outsourcing these services to well-established vendor is advantageous since the focus remain on improving guest services. It may also be cost advantageous in many cases. However, there are a number of risks. First, required quality for the comfort resort property should be delivered by these vendors. Detailed SLAs need to be drawn up to ensure this. Stay-in should be able to monitor the performance. In case of non-delivery, the agreement should provide for redressal. This could vary from compensation for any loss in the business to immediate termination of service. So this is a mitigation measure. What they have given in the suggested answer is the mitigation measure. You have to highlight the risk that the vendor will not provide things on time, risk that the quality of service may be poor. Just imagine you give it out on laundry with the limited vendors, and if the laundry doesn't come back on time, then it becomes a problem. Okay. Stay-in should ensure that it can easily and economically switch service providers if required. It has to identify alternate vendors who can provide the same level of service. Since the resort locations where the number of vendors providing these are limited, it increases the risk of outsourcing these services. The other risk in outsourcing could be instances of where well-performing vendors could go bankrupt and shut shop. In such cases, resort operation could be immediately impacted since such services can no longer be available. Again, so basically what is saying, if the vendor doesn't provide this service, or if the vendor shut down, it becomes a problem. If I was to write the answer, it would be more about on-time delivery, quality of delivery, and we don't have any alternative options. Okay. Then second one, if the management decides that the guest experience is a very important CSF, it may choose not to outsource these activities. Now, why? Because quality control and poor customer service may wipe out any cost savings attributed to lower expenses from outsourcing. So while doing outsourcing, you may save on cost, but if you save on cost, at the same time, it may have an impact on the quality. Control over factors such as input material, performance of service, equipment use, training of staff, and other essential activities can ensure that the required service quality can be achieved. Better service enhances guest experience through these critical activities. So compared to outsourcing, it might be a costlier option, but since the customer are paying premium, we should provide the quality, premium quality. Then Difference between risk of outsourcing for comfort and budget is driven by the difference in the focus and target customer of the business model. Budget focus on providing value for money. Stay-in provides higher customer experience to quality of service for the guest staying at for longer vacation. Due to high real estate cost for the budget hotels, both for ownership and rental, cleaning and food service has been outsourced. That is the reason. Okay, and whereas as far as comfort is concerned, for the guest experience, which is primarily influenced by cleanliness and food service, these activities become core, hence the outsourcing risk is higher, right? So this is what explains the difference. Then because the guest turnover is high, the instances of dissatisfaction among guests as regards to quality and food service within certain limits will not negatively impact the business because these are non-core and can be considered for outsourcing. But here it is core and should not be considered for outsourcing. Then how does branding help? It helps potential customer determine their expectation from each of the properties. Based on these expectations, customers' appeal can be distinctly determined for each type of properties. This will help them choose which property could potentially satisfy their expectation better. Thus, by operating different properties under stay-in budget or comfort, Stay-in Limited has created a brand strategy that can effectively communicate their product and service offering to the potential customers. So this is for the fourth one, right? Now, exactly same answers, very difficult to write. If you get the same questions, you can actually refer to the case and give the answer. But try to catch the essence of what you're trying to answer. Okay. And don't expect much in these type of questions. Even if you get 4 to 5 marks out of 8 marks, it should be more than sufficient. Then property, plant and equipment. Okay. What all are to be included? Purchase of land, it has to be included. Site preparation cost, it has to be included because you're incurring it for constructing the building. Direct material cost, yes. Direct labor cost, including 20 lakh that was incurred during a labor strike. So it will not be 3 crores, it will be 2.8 crores. Testing the safety of the construction of the resort site. Is it required? Yes, definitely required. This will also be a part. Consultation fee related to construction of resort required. Yes, definitely required. Relocation expense of resort manager from Mangalore to Goa. This is not required because you are just moving one employee from one place to another. This is nothing to do with directly attributable to construction of the property. Hence, this will not be considered. Then administration and general overheads allocated to the project by corporate office. So this is corporate office expenses being allocated, again, not directly linked to the construction of the project. This will not be considered. So this you will consider and calculate the cost of property, right? A standard question from India 16, 6 marks or 7 marks, whatever is, whatever is this tested for, you should be able to score out of out. Now in these kind of things, what happens is generally for each item marks is allocated. So even if you get some items right, you will be able to score the marks.